Good morning. All right, so JP Morgan. Good morning. Shoot. JP Morgan with a beat, PNC with a beat. Bought some Morgan Stanley pre-market. Four minutes ago. Bought some Morgan Stanley 4 minutes ago. 3670, excuse me, 8673 filled. All right, so Boeing is off a little bit this morning, $12, back down to 200 on comments that they are pausing some production. I guess they had some issues with some of the smaller parts that didn't meet standards. They had three manufacturers, and that's it's pulling it down a little bit lower. But for the most part, the markets look pretty good. We got 320 as major resistance for the Qs. 320. It's very large area call strike at 320. Very prominent. Pretty significant. If you check the Gamma channel, you'll see the chart that I'm talking about. At this point, we see little reason to think there'll be much going on until next week. We continue to look at the OPEX pin holding below 420, 4,200, S&P 500. The call wall did shift lower from 420 to 412 on the spiders. We've been hovering around that 412 level for the past couple of days, plus or minus. We hit the highs pre-market at 414. Call flow was pretty impressive yesterday. Not a whole lot of puts being bought. Traders were focused on 0-day, obviously. That 0-day activity that we saw yesterday helped move from one gamma strike to the other, 4100 to 4150. And it's Friday, so I'm not expecting a whole lot. I'm not expecting a whole lot today.
As an investor, just go to GE to play it as a way to play the growth in aerospace. You can't fly at GE unless you're in that monkey's paw. The way you made that transition, not that of course you don't always do this, you would have thought that GE made airplanes. GE's got a really good business, and it's time to rethink your going. GE's got 102 billion market value, but it trades at a huge multiple. You know that, right? We see businesses going to do better.
All right, let's get ready for the opening bell. We've got about 7 minutes to go. I'm your host, Cousin Vinny, coming to you from theclosingprint.com. It is Friday the 14th, and we're not expecting a whole lot of activity today. Financials are leading, so we'll probably focus on financials quite a bit. I have XLF, as we mentioned yesterday, XLF, the 33s, the 3350s. And I had some leftover 35s that were just a couple of pennies, 2 cents. But the others, going to see some nice activity today on the bank earnings, Also have some Deutsche Bank January 10 calls. Those are in the money. I've had those for over a week. Deutsche Bank looking for that to continue higher. Generally today, I'm not looking for a whole lot of movement. It's a Friday. Let's see, Deutsche Bank. You can see what I'm looking at on Deutsche Bank. Looking for it to get above the 50-day, 1125. The comments we've been making recently that if the banks and Jamie Dimon say anything less than, awful, if you will, that would most likely see a grind higher in banks. They came out, they beat. I didn't catch what Jamie said. Something along the lines of seeing improvement, but there was some concern about tightening credits in the future, obviously. All right, let me just make sure Woody's up and running here. Hope everyone had a great evening. I did as well. A little stormy weather this morning. I like stormy weather. As long as there's no tornadoes in there. Okay, so this morning, Austin Goolsbee, not crazy about his politics, but he's a Chicago Fed. He was talking on CNBC this morning. Sounded pretty positive. I think if he was the Fed president or chair, he would be suggesting not raising rates, giving a couple of months to see how the economy works. I think really what stuck in my head was something a lot of professionals have been talking about. They'd rather listen to what Jamie Dimon has to say, someone that's actually in the economy per se, versus the Fed, Jay Powell with their dot plots. Mohamed Alarian also having some comments around that discussion. Anyway, that's all just speculation and discussion amongst knowledgeable people. We got to see what price is doing. Price action right now is fairly flat. We're off 6 handles, more or less. Tornado suctions. Yeah. I was talking to my daughter this morning. She drove to school and she texted me after she got to school. She said she just made it on time, but that the rain was so bad she could hardly see with the windshield wipers on heavy, on super fast. And I said, yeah, we need to have a conversation about tornadoes, what to look for and such. She's like, tornadoes? What do you mean? Always good to understand tornadoes, inflows, and all the other stuff. If you're from that area, what's he talking about? It's a Friday. Markets, I don't do a whole lot on Fridays as a rule. I do a lot of repositioning or thinking about risk. I don't see, there was a lot of call buying yesterday on the S&P spiders, S&P, and the Qs. The Qs have major resistance overhead. Rain-X helps a lot. Yeah, I'll have to do that for her car. Okay, so here is the Qs. You can see 320, there's a major call wall there. I don't see us getting above that level. That'll be resistance for now. We have 2 minutes to go for the opening bell. 2 minutes to go. We're at 317.50 on the Qs pre-market. We're down $1.70. Looking for some opportunities. Looking for some opportunities on the FANG stocks. Those have all dipped. If we get any kind of pop, I'll look for an opportunity there. Waiting for buy signals. I want to see how we open, and I want to pay attention to Grover's grid of signals. Don't want to act before I see green lights and buy signals. All right, so let's get ready for the opening bell. SPY. Okay, we're trading down here at 412.79, that orange box right there, pre-market. Okay, I'm thinking that let's focus on the banks today. Banks, there goes Morgan Stanley, gapping up there. All right, good. Google on the move. That looks like shorts covering on the FANG stocks, shorts covering. All right, we're getting a nice rally here already. Qs are starting to rally. Give it a few minutes. The morning opening range, first 15 minutes, algo's taking care of imbalances. I'm not really doing much. The Qs are rising pretty quickly here. Qs. Okay, SPY. Kramer's voice is just so scratchy on the chalkboard. Fingernails on the chalkboard. All right, so looking for follow through here, Morgan Stanley. Looking for the banks to continue. Okay, Deutsche Bank. Oh, XLF. Want to keep an eye on that. XLF. The 33s doing very well here. 35s. 33s. All right, so we're looking for a follow through today in the XLF. Yesterday, towards the end of the day, we talked about the 3350s, which saw a tremendous amount of growth in contracts being traded. It's like 139,000 contracts that all transferred to open interest. That was towards the end of the day. So it was very obvious that they were positioning for earnings. Somebody knew something. All right, Microsoft holding, looking for a bounce. Shorts covering on the FANG stocks, probably what we see the first 15 minutes or so. XLF looking for a break higher. XLF. Okay, I took some 33s off. I sold half of the 33 call. Looking for more upside. Gonna trail the rest of these. Okay. Visa. Visa ripping higher. Visa. Visa's going. I think, David, I think you mentioned it. All right, Visa's going here. Nice move on Visa. Okay, so far, shorts covering. That's all it looks like for now. If you were looking at Meta, we were looking for dips to the 90 MA. Meta, not quite there. 215 is the, looks like the 90 MA is at 214.60. First 15 minutes, I'm not doing much of anything except taking profits off the table. and then reassess the markets. JP Morgan looking good. Higher, looking for JP Morgan to continue. Big gap up on JP, looks good. I have the June 140 calls. Also have some 135s. Those are up quite a bit today, $3.45. The 140s are up $2.28 per contract. IBM's higher, IBM higher. All right, there goes IBM on the move here. Visa, still going, Visa. I'm going to take a look at Visa here. Visa, expansion day, probably. Volume yesterday was 7.5 million shares, well above average. Looking for Visa to continue. SPY's on the move, Q's on the move. Buying a dip. All right, let's see. ConocoPhillips, COP. Let's see what the energy names look like. All right, so following through, but not mustering a whole lot of interest at the moment. Crude oil is up. Crude oil, USO. The Bitcoin stocks, keep an eye on your favorites like Mara and Riot. Those should continue, I would think. Mara and Riot. Bitcoin. Continuation here. I guess Sam Bankman-Fried probably grimacing that this has recovered so much since the lows at 15,500. Doubling. That's unfortunate. If he had only had a little bit more savvy when it came to management, risk management. I think their risk management was drinking beers around the pool. JP Morgan, still going, JP. JP Morgan still going. I'm going to take some profits into strength. See if I can't get a better re-entry here. All right, taking some profits off into strength, JP Morgan. JP Morgan taking some 140 calls off. I'm trying de-risking is all I'm doing. Okay. That was a nice profit there. Starbucks on the move. Starbucks on the move. Okay, let's take a look at Starbucks. Grinding along. All right. So initially, if you remember, we bought some Starbucks down over here during the summer last year. We talked about um, enterprise value versus sales, enterprise value versus EBITDA versus all metrics, basically. We're trading at a discount, and you don't get much of a discount in Starbucks very often. If you go back over the years and you look at Starbucks, very few times where you've had an opportunity like these that we saw last summer. Okay. Most of the time, Starbucks will trade above enterprise value, above EBITDA, above sales, etc. So this dip was really good. So anyway, the point is that we bought shares down there. We continue to hold shares. And on dips, I'm looking to buy. Also has some calls on Starbucks, the 107 call. 107 call. And we'll continue to trade Starbucks. I don't see any reason to sell Starbucks coming out of a nice base. Just take profits on occasion on rips. It's not ripping right now, it's just grinding. And then buy back on dips along a bullish path. It looks like we're coming out of a flat sort of cup handle base type of setup. Okay, most of the financials, whether it's credit cards like Visa or others, all pushing higher. Visa, the 250 calls were really active yesterday. There's 16,000 in open interest. There's only 27 contracts have traded so far. So whoever was buying Visa yesterday prior to JP Morgan, they're still holding it. So that's one way to look at the open interest. Okay. I bought some of those 250s too. I think, David, you mentioned it, right? All right. Good morning, everyone. 15,000 of that was open. 15,000 was from yesterday. Okay, Visa looking for more upside. Or a nice push higher. S&P still going here. All right, we're still going here. S&P, the Qs. All right, looking really good. All right, so if you bought any of the dips on the FANG stocks, they are ripping. Oh, wow. Look at Google. Google ripping here. Looks good. Meta, Apple going green. Apple has a 180 target. Canaccord, I think it was 180 or was it 188? I forget, but looks good. Apple going. Lots of open interest, so they're swinging a ton of calls, and very few have traded in terms of profit-taking volume. Sure. Yeah, Joel, no problem. Starbucks looking good. All right, we got pretty good muscle so far, looking okay. Apple on buy signals. Apple buy signals. All right. Nice follow through the Qs. All the FANG stocks doing very well. Tesla, nice move on Tesla. About to go green on the day. Google, nice move on Google. Caterpillar making up for Boeing. A little bit. Caterpillar, I have shares of Caterpillar. All right, XLF doing very well. About to go off the screen here. XLF, I have the 3350s and some 33s left. I sold some 33s for a nice gain, and the rest are a free trade now. The 3350s had 139,000 in open interest. Most of it was traded yesterday towards the close.
Forecast 62.1 on the prior 62, the range of 65 to 57. Hit the US business inventories month over month. Forecast 0.3%, prior minus 0.1%. So for the breakdown from University of Michigan, you get their 1 year inflation prelim. Forecast 3.7%, prior 3.6%. 5 year inflation prelim, forecast 2.9%.
Okay.
Prior 2.9%. The conditions prelim, forecast 66 on the prior 66.3, and the expectations prelim.
Apple's still going.
5 on the prior 59.2.
Deutsche Bank at 11. Deutsche Bank, I have the 10 call, January 10 call on Deutsche Bank. Fully expect Deutsche Bank to get back into area overhead where it started this drop. All right, so I'm looking for another $1.50, $2, maybe more over the next few trading days. Deutsche Bank. I want to limit my exposure to banks. If there's calls available or puts, if I see weakness, I'd rather be in options so that I know my maximum potential loss. Amazon on the move here. Amazon. Okay, we're talking about Amazon making it above this level, breaking higher. Same conversation with Disney. Disney needs to break above the 50-day. Same thing with Amazon. It's above the 50-day. Needs to get above the 200-day now. Google last week on Thursday came in, killed it with options. Some of you traded with Cayman. Meta, nice. Had a nice move yesterday. Grover caught that one. Sold before the close. Took some nice profits. Not doing a whole lot today, but we're seeing a lot of action here that suggests that dip buyers are present. Not a whole lot of blocks. Most of the blocks are on the Qs. We got 5 blocks on the Qs, 2 on the SPY, and nothing on IWM yet. So that tells me maybe take a little more profit off, as institutions don't seem to be that active, even after a beat. Even after a beat, JP Morgan, PNC. Let's take a look at PNC because I know Yoda, you were looking at PNC yesterday. Interesting. They didn't buy. Morgan Stanley. I bought some shares pre-market. I plan on adding to it. Morgan Stanley. There was a I forget the guy's name, expert in banks, talking a lot about what banks he would sell, which he would, some that he would not own, and others that he would want to buy. Morgan Stanley was one, price to book, and talking about its wealth management and other divisions looking the best, along with JP Morgan, of course. JP Morgan, strongest balance sheet out there. JP Morgan having a good day. Okay, let me take another look at JP. I took some profits off into strength on JP Morgan. It's doing exactly what I'm looking for it to do. I'm bullish on JP Morgan. It gapped up. Okay, whenever you get this kind of gap, I always take profits. I mean, that's just a given. I'm still bullish, but I want to wait for it to consolidate in this area now. So I'll be interested in JP Morgan again. Next week I'll be watching how this trades. But this kind of move here, the options are killing it. It's up 7% on the day, just the shares alone. Nice base above the 200-day. I'm expecting a lot of the banks to do that. As you know, the more of any sector, the more stocks in any sector that work together, the better your odds. I mean, it just makes sense, right? Here's JP Morgan gapping up. All right, we're up 7%. And the options are up. I don't even know what it was. It was quite a bit, though. So the idea is the more stocks in a industry group that you're trading, let's say you're trading banks. I'm trading banks. Also like Visa, like the financials. The more stocks you have in a group that move together, that's a good sign. All right. So look at all the banks. They're all green. Okay, so they're all moving together. So what does that tell me? It tells me focus on the banks. Pretty straightforward. Make it simple. Make it simple. Your investing will make you'll do a lot better over the years. The more you simplify, the more complex you make things, the harder it is to get untangled, I find. Anyway, you got all the banks moving higher, so that's a good thing. Let's see what other sectors are looking good here. Financials are the top dog today. Actually, semiconductors just took the lead just now. Just as I flicked over SOXL on the move, SMH don't look as good as far as trends. I mean, it's just sideways. Intel, there was some activity on Intel. This is day 8 on Intel. If you count the days, Star is very good about this. Home Depot looks good. Home Depot, nice little flat base here, saucer sort of base. Once it gets above the 50 and the 200-day, this thing's probably going to run 50 points. I see 50 points. Star. All right, the SPY and the Qs are just going. They're killing it. They're killing it. All right, so that's good. I'm not buying the FANG stocks up here. The place to buy it was after the short covering turned into more concerted buying. Everything started to move together. Again, FANG stocks, if you look at the FANG chart, what's that tell you? All right, yesterday this held. Okay, had a big bullish candle, almost a bullish engulfing, and a very bullish pattern, 921.50 pointing up and to the right. What's the 200-day doing? 200-day is flattened over the last couple of months. Now it's turning higher. And trust me, there's still so many people out there that are bearish that for at least another few weeks, I would think that we could see more upside. It won't be a straight shot up, but industrial production came in better than anticipated. So we had a nice bounce there. Rick Santelli talking about that this morning. Consumer Price Index, that continues to drift lower. The AAII Bull Bear, I talked about this quite a bit yesterday. Here's 1990, 2009, and the current situation. In each case, once this reversal started to kick in, the markets rose over the following few months. Now, a lot of people are still looking for S&P earnings to deflate and for prices to pull back more in line.
63.5, that is higher than the forecast.
Okay, so in line would be closer to 3,000, the blue line there.
That's lower than the forecast of 0.3%.
We're up here. Now, the one thing that
Expectations prelim is 60.
CNBC analysts, et cetera, won't say is that we do spend a lot of time in overvalued area on the S&P 500. So it's not inconceivable that we have already seen the lows, October 13th. Certainly banks, comments from JP Morgan, et cetera, are good for the markets. All right, so it looks like profit taking is starting to hit Apple and Meta, Tesla, Microsoft. So looking for higher lows at this point.
This stream is sponsored by TickStrike. TickStrike allows you to actually hear order flow futures, forex, and stock instruments.
All right, let's look at breadth. NIMO has been improving. You know how the advanced decline percent works. When you're extremely oversold, you want to think about buying. When you're extremely overbought, like we were Monday 2 weeks ago, to start the week, you want to be selling or taking risk off the table. As we're starting to lift here, breadth looking better. Okay, and if we look at NIMO, a couple of weeks ago, we talked about in the weekend video that this trough suggested that we're going to see a follow through. This is a lagging indicator, but we were looking for more upside. And that was 2-3 weeks ago when we saw this trough developing in the middle of March. Okay, so we continue to move higher. We did have a little dip last week, Monday, Tuesday, and then Wednesday, Thursday, Friday, we pushed higher. FANG looks good. So I'm just going to keep working on this potential upside. The weekly looks good. Which would you rather? Would you like to be buying up here back in October, November 2021? Obviously not. That was the bear market start. We were below the 10 EMA. This is one of William O'Neill's main concepts, among others. Look for relative strength line to be rising and look for prices to be above a rising 10 EMA. If you just stuck to that one principle in 2023, even though we had 6 weeks of fade, we're still above the 20 EMA. Maybe you took some profits at those peaks there in February, like most of us did. But generally speaking, going forward, this looks pretty good. As GTO, if you know who GTO is, as GTO used to say, you want to continue to ride this trend until the stock or the asset does something stupid. Something stupid would be categorized as a waterfall like this. You're long until you start to see topping candles, and it does, you get these big bearish candles. Right now, this just looks like we're going to see a trend continue. Note the difference here. All right, we had a 4-week fade. In this case, we had a week and a half, and now we're starting to surface. That said, I am paying close attention to junk bonds and high yield corporate. Those are risky assets. As such, we know that means risk on when they're moving higher, risk off if they're dropping. Okay, like back in 2020 during COVID, had you been paying attention, you would have missed about 15% of the downside. Okay, you would have missed all of this over here. So the first time, this is something stupid right here. That would be a categorized statement there. Okay, that's something stupid. When you see this kind of movement, all right, you're only like 2 or 3% off the highs at this point on the S&P. The next week and the following week, you saw a drop of 10% and then drop another 10%. So pay attention to junk bonds and high yield corporate debt. A lot of times that'll help you a great deal. Look where it is right now. It's more bullish, higher highs, higher lows. If you can see that develop, this is more for people that are um, investing for the long term. If you're thinking about areas where you want to be adding to your portfolio on the long side, most 401ks you can only do long only funds. You know, you can invest in some international as well. But if you look at TRBCX, we were buying this at the beginning of the year, end of 2022, and we continue to rise here. All right, from 100 to 120, 121. So that's a nice gain there on a pretty sizable part of our portfolio. TRBCX, SPHD, of course, continues to rise. I was going to buy some here. I did for the kids, but I didn't for myself on this last dip. SPHD is an ETF, all of the common names that you know, companies that have been around for 50 years, pay dividends regularly. This this fund or ETF pays monthly at the end of the month. So we got about another week or so before another dividend. I have that rolled into more shares. So that's a way to invest for the long term, a portion of your portfolio, more passively, I guess. Anyway, so the markets are starting to peak a little bit here. 4150 is the level that we thought would be some resistance for the S&P 500. So most of you are aware of that. So I'm not telling you something you don't know. 4150. Now, if we close above 4150 and start to book higher, 4200 is the level I'd be looking to take some off into strength next week. 4195 was the pivot back there in February on the 2nd. And we're just filling the right side of this pattern. So I'm seeing a lot of similarities in many stocks that are filling the right side of the pattern, like energy. All right, starting to build the right side. This is a descending channel looking for a breakout. All right, so it's a little slow today. It looks like a lot of money is coming out of energy into financials, which is good. We need the financials to rally. We also need industrials to continue. Despite the fact that Boeing is off, what is it off now? Boeing is off 13, almost 14 points, just below 200. Despite that, industrials are still pushing higher. INDU is off a little bit. All right, so markets look okay. So if you've been taking profits this morning into that 945, 950 peak, I'm just looking for dips now. Let's go see what is working. Sector-wise, we're about 50-50 on the sectors. Retail, financials, and semis are doing the best so far. All right, so a little reversal off the high here. All right, S&P 500, pretty decent drop there from 4162.50. That's almost 20 handles in 5 minutes. All right, VIX, a little bounce there. All right, so there's a bit more volatility right now. Let's see, what time is it? It's 10:09. We had University of Michigan sentiment, preliminary. Business inventories, that's behind us now. University of Michigan, condition preliminary, expectations preliminary, 5-year inflation preliminary. We don't have anything else until 1 o'clock. Baker Hughes, rig count. And that's it for the day. We got Nagel over at the ECB talking at 2:15, but pretty light day today. Not expecting big moves in the markets at the moment, barring any catalysts that are unexpected. That was a pretty decent down candle there. That was a 20 handle move in 5 minutes, not even 5 minutes. I'm still bullish. I'm looking for dips to buy. JP Morgan. All right, so it's starting to come back in a little bit. But holding VWAP, this starts to pull away. The only reason why JP Morgan would start to push higher out of a gap up, we're up 7%. The only reason it would continue higher is because banks or institutions are buyers. Okay. Institutions that would show up in volume. So the thought process is here, institutions will buy high. There's times where they will buy high and sell higher. They like what they hear from JP Morgan. You'll continue to see it in volume and price. Not my opinion. I'm just watching what's going on here. I sold the 140 calls this morning for a hefty profit. Hefty. And I'm still bullish, JP Morgan. I'm just waiting for an opportunity again. It's a Friday, so I'm not doing a whole lot. All right, so NASDAQ 100 is 55% red at the moment, 45% green. The leaders are, looks like industrials, tech, names, Marvell. Marvell looks pretty good. MRVL. Did they have earnings? MRVL. Anybody know? Or Marvell? It's okay. Marriott. All right. So travel and leisure seems to be catching a bid. What's Booking.com doing? This is one that Russell will trade pretty heavy. Bookings.com is looking good. BKNG. Hotels. Travel and leisure. TNL. That looks pretty good, actually. This is one that Anton likes to trade. Anybody hear from Anton? I don't have any idea what he's doing. I think he might have got offended or something by something somebody in the room may have said. Wasn't short enough or something. I don't know. Intel. Okay, Intel. I've been seeing a lot of volume on Intel. So does it move down to the 21-day first before we re-enter? Or does it move higher from here? So it's a Friday. We're watching the S&P here. All right, so we had a dip. I don't know what the hell that happened just now. But we got shorts coming in now, covering 20 handle drop in 5 minutes. And very few blocks. Most of the blocks are on the Qs. The majority are the Qs. We got 3 on the SPY and 1, 2, 3, 4, 5, 6, 7 on the Qs. None on the IWM. Speaking of IWM, let's take a look. That's a risky asset. So if you're bullish equities, you want to see IWM moving higher. I will say something about emerging markets and Mexico and EWZ, Brazil. These are all areas I'd be interested in buying once we come out of these bases, EWZ. Other areas to invest besides the U.S. Money to work. Here's Greece. Greece on the move here. Greece is the word. Nice. What's Turkey doing? Turkey had a nice run last year. It's been consolidating much of the last 4 months, just sideways. Let's look at some of the other. This is more for people that want to invest in international stocks. All right, so here's VWILX. This is the Vanguard International Growth Admiral shares. As the name implies, this is the top dogs in the international markets. This is what I'd be looking at. I do have a position in VWILX. We bought some back in October and haven't looked back since. Okay, it's above the 10 EMA. That's the first barometer that I like to look at for any investment. I want to see, are we at highs and above the 10 EMA, or have we already pulled back and discounted shares down here? So VWILX looks really good. And if you aren't on Street Smart, you have to go to the main Schwab site to buy any of these funds like VWILX or TRBCX. TRBCX. I have a position in TRBCX since late 2022. Continue to stay above the 10 EMA. I would rather buy down here and look for prices to mean revert, maybe 50%. Once we get to 50%, right around 150, 152, then we'll reassess. Once it gets to 131.80, we'll reassess there, see where the markets are. But for the most part, these longer term funds look really good. Okay, so SPY still chopping around here. I'm not doing anything on the SPY. I don't have any positions this morning coming into today. We're about 55% red on the sectors, 45% green. Semiconductors are fairly strong. Financials are the focus. So if you're trading financials, I have some Deutsche Bank January 10 calls. I've already had those for a couple of weeks since this bottomed here. That's at 11, looking for that to move higher. Some of the other names, maybe some of the regionals. See this come out of the base. KBE. Obviously, there's still a lot of risk in here. So I can be very selective. I bought some Morgan Stanley this morning. Looking for Morgan Stanley to make higher highs and higher lows into next week. Small position for now.
BlackRock Sphinx says, I'm not sure we'll see a recession in 2023, maybe early 2024.
Okay, so Morgan Stanley reports next Wednesday. Why did I buy shares now instead of next week? Because I think they're going to do well, just like JP Morgan. And what is Citigroup doing? Citigroup. Citigroup doing very well on the gap up on earnings. Wells Fargo. So. I'd prefer Citi, actually. Citi. Technical pattern. So let's see what the earnings look like on Citi. I didn't catch earnings this morning.
This stream is sponsored by To The Tick. Get free daily pivot points
Low
for
equal at
Fibonacci and market profile
-800.
levels by signing up at tothetick.com.
Okay, revenue growth of 74.7% on a year-over-year basis, despite what happened this year. In the first quarter, Citigroup reporting $1.86 per share on revenue of $37.5 billion. That looks pretty good. The two banks I like the best are JP Morgan and Morgan Stanley, and that's because of their wealth management divisions as well. Deposits increasing, strong balance sheet, price to book. All right, so we're still fading here, S&P. All right, we didn't expect that we would move beyond 4150. Okay, that's resistance. And then 4200. We expect prices going to stay between 4100 and 4150 until OPEX. Okay, OPEX is next week, the third week of the month, the 21st. We really don't have any kind of major data. The Fed, with its nothing burger in terms of quarter point rate hike, 25 basis points. CPI earlier in the week. PMI, was it yesterday? Inflation, we're past peak inflation.
The bank crisis is to accelerate capital markets growth.
So I'm going to take a couple of minute break because I'm sure you've heard me talk a little bit too much already. Not a whole lot to do. I'm bullish on the banking sector, financials. I want to buy dips though. Visa sold some Visa into strength. Those 250 calls are very active, and a lot of that open interest is still there. So that tells me that those who bought those 15,000 contracts yesterday are looking for more upside. Okay, so Visa just sitting here. I'm looking for Visa to get up near 250. Could do that before that June strike. The 250s are the June strike. And now we have, let's see, only 55 have traded today. Visa, only 55 of those have traded. Still have 16,625 in open interest now. At 56 were sellers. So somebody took profits on the observation yesterday. I think that was from Option Hawk. 15,001 block traded yesterday in the evening session. Visa, we talked about that. And Visa's just flat VWAP right now. So, okay, flat VWAP. Yesterday I had nice sloping VWAP.
Low tick alert minus 800.
Bitcoin stocks coming back a bit. Caterpillar. All right. So everything, it looks like a tip. I hate to use the word typical. Nothing's typical. It is a Friday. Generally, and Fridays, people who are short-term swings that get in on Monday or Tuesday, exit before the weekend, so they're not holding risk over the weekend. See a little profit taking. Caterpillar. Just said I was going to take a break. Let me take a couple minute break. I'll be right back.
Since 2020. So what we've been seeing back gusto and across the country is a surge in entrepreneurship that, for decades before the pandemic, we've been seeing declining numbers of new business creation. But, like so much during the pandemic, that trend was flipped on its head. And we're even, 3 years out seeing rates of new business creation that are 40% higher than what we've seen in 2019. And so, the U.S. is quite frankly seeing a renaissance in entrepreneurship right now.
Low tick alert
the
minus
connection
800.
between that and the COVID stimulus era and payroll protection and maybe limited downside risk to starting something new? Did this? I mean, I guess your survey goes back to 2020, so this is basically started during COVID. How much of a connection do you think there is to some of the economic injection that we got?
Yeah, I think there's a huge connection both between the economic stimulus that we've been seeing and then also all of the disruptions that we've experienced since the pandemic. When we did the survey in 2020, what we saw was a huge part of this entrepreneurship was out of need. A lot of these entrepreneurs had lost their job and they needed to find a new way to support themselves and their families. And actually, one of the forces that we've been seeing is that women and entrepreneurs of color who felt those disruptions most acutely were starting new businesses and fueling this surge in entrepreneurship. That before the pandemic, women were about 29% of all new business owners, and afterwards in 2020 and even 3 years on, they make up about half of entrepreneurs. And so, we've been seeing all of these disruptions since the pandemic, and also the economic stimulus that's fueled this surge in entrepreneurship. And it's gotten a lot of people who haven't necessarily taken part in entrepreneurship before into the fold.
And some of that you describe as a result of burnout, and I guess that was enabled by the ability of in a lot of industries now to work from home, where people say, you know what, forget it, I'll do my own thing, I'll start my own small business. E-commerce boom, a lot of people started storefronts online, stuff like that.
Yeah, no, exactly. We asked these business owners whether they quit their job to start the firm, and we saw that this year about half of all new businesses were started by people who quit their job, and especially in that sort of mid-career, 35 to 55-year-old entrepreneurs, we saw that burnout was actually the number one reason that they started a business. And it's really this accumulation 3 years on, and feeling that before the pandemic, people had to fit their personal lives into their professional lives, but entrepreneurship has been a viable option to do what you love, to pursue your passion, and also to do it on your terms, where you want, when you want.
How many participated in this survey?
So we did a survey of about 2,000 new business owners, about 1,600. And like I said, we've been doing this over the past 3 years. And so we've been able to see these trends. And one of the constants is the elevated rate of entrepreneurship. But what we've been seeing is that a lot of these forces, why business owners have started, has been changing over the years. And this year, the rising cost of living and inflation came to the forefront as one of the reasons that business owners started.
Okay. Monthly, is that correct?
So we do this annually. We do this as a look back. So, for instance, we just looked at the cohort of 2022 entrepreneurs this past year.
What do you think will be the main themes going forward based on the catalysts for the data the last year? Anything changing in the macro headwinds here? I mean, we had a conversation this morning with an investor who basically said the market's biggest problem last year was inflation. This year, it's recession risk. Do you expect that to show up? And what role do you think that plays?
Yeah, that's a great question. We're definitely keeping an eye on how some of these macro forces are going to play into entrepreneurship. But, I'm really bullish on this trend of entrepreneurship and new business creation. 2020 was the first time ever that we saw entrepreneurship actually increase during recession and the decades that we've been keeping track of this data publicly. And so I think going forward, we've seen a change in the dynamic between when it's a good time to start a business. That, it's not only a good time for entrepreneurship when economic times are good, but, entrepreneurship is a viable option at any time. And one of the forces that we're looking at right now is technology and how some of these continued revolutions, for instance, in AI, are going to play into some of the new businesses that we see being created this coming year. Because what we see is that entrepreneurs find opportunities and they create a business to solve those disruptions or to take advantage of some of the opportunities in the economy at any point in time.
Anything that right now shows up as AI creating a new business? Anything that you're seeing from the clientele popping up?
Yeah. So in the survey, actually, we did ask about technology playing a role, and we saw particularly among the sort of younger cohort of entrepreneurs who are 25 to 34, or even younger than 25, technology is playing a huge role. About 40% of those businesses were in technology. And so, I expect to see this continued surge of young entrepreneurs who are, growing up in this technological environment and starting new businesses that are going to solve a lot of the problems that we face today.
Okay. Luke, thanks for the report. Appreciate it.
Thank you.
All right, it's a good big picture setup here for the maybe next phase of entrepreneurs. Got their starts when money was coming in, liquidity was going up in the economy. It'd be interesting to check in a year to see how potential tightening of economic conditions has weathered those startups. Luke Pardue from Gusto. Chartmaster standing by. We're going to take a look at some consumer stocks, clothes, drinks, and smokes.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Stocks have faded down from the morning strength. We've got some charts to talk about, though, and 2 out of 3 of these are lower right now, Renita. Let's start with the winner. And let's talk some close here, as VFC is actually having an okay day. Retail sales, not great, but an upgrade from Goldman may be kind of great.
Double upgrade from
Wow,
Goldman,
there
right?
you go.
Took the stock to a buy from a neutral, and it is setting the price target at $27 from $26.
They had it at sell.
At sell, you're right.
Full
it was
double
a sell.
upgrade.
Full-on double upgrade. Thank you so much for catching that. But that's nearly an 18% move to the upside from where it's trading now. That new price target at $27 that came up from $26. And the company said that, or the analysts said that the company's revenue and earnings trajectory has really been underperforming, right? It's been underperforming the market in a big way. And even its stock, if we look at it, it's down about 59% from last year this time, about 17% year to date. Ouch is right. But Goldman believes that this company has the negative story, those negative catalysts are now a thing of the past. What were they, though? Vans' weakness, it was wholesale inventory rebalancing that the company had to do, right? It needed a right-sized dividend as well as a management turnover that happened within the company brands, right? But this analyst feels like the stock right now is at an inflection point, and that Goldman believes that the strategic initiatives of the company are poised to really drive an outperformance in the stock. So we'll find out what happens soon when its next earnings report comes out.
This is one of the weirder analyst notes that we've had on here lately. The double upgrade with the price target change of $1 US.
Right.
26 to 27. What do you make of that, Kevin Green?
Very interesting note to say the least here, Oliver. But from a chart standpoint, you never want to go against the primary trend. You don't want to try to be the hero because it can burn you, and we will show you that here in a second. If we look at a chart, especially on a 2-year time frame, on a daily time frame as well, you can actually see this downward sloping line. I created a channel from the highs as well as from the lower highs that were created, and it's been trading within that channel here, which is why I'm telling you, you don't want to try to be the hero because every time trying to pick that bottom, you would have gotten pretty much wiped out, unfortunately, here. So that primary trend is still intact. Keep that in mind. That's going to be something that technicians are going to be focusing on here. One thing to note, though, if you look at point B, that's going to be that 20-day moving average. It's been a very reliable source when it comes to trying to predict short-term trends. And when the stock is trading above the 20-day moving average, we do see a temporary pop. And when it trades below, then obviously we do see the stock continuing to move to the downside here. And it stays below the 20-day moving average more than it stays above the 20-day moving average here. So right now, there could be an immediate pop in the stock here. Just keep an eye on the resistance point at $24. And I'm also trying to keep an eye on that 50-day moving average. Last but not least, we have that volume profile. We show the point of control sitting at around $29. That's another area of significant resistance potentially for the stock. A lot of trading activity has taken place at that level. So just keep an eye on that. But once again, over primary trends down, you want to have it prove to you that it could actually make this turnaround. I know Goldman has this, nice note coming out, but once again, from a technical standpoint, you never want to follow a trend that's been in this downward motion for as long as it's been.
Even if it gets to the $27, kind of seems like pennies in front of a steamroller. It would be a nice trade. Hey, percentage-wise, $5 on 22. Okay, not bad. But certainly wouldn't change the trend if we got there. I don't think anybody with a long-term holding would be terribly happy at this point with the deterioration that's already gone under. And it looks also, if you pull up your chart again just real fast, I mean, it looks like it's kind of getting cozy here down at $25. All that volume trading on the right, that's a huge, huge section.
Yeah, definitely. And that could be a turnaround signal. But once again, you have to prove itself. I like to look at price, and I also like to look at volume. So volume confirms trend. But once again, if you're looking at that volume profile on a longer term basis, each one of those support areas that is broken down over the last 2 years has had this similar type of volume spike. So it doesn't automatically mean that there's buyers coming in at this point in time. It does look attractive if you look at it and you're trying to call a bottom. But if we even just shifted that chart over and we didn't see what was actually occurring beforehand, we probably would be saying the same thing, unfortunately, right? So we want to be able to see the movement to the upside, significant movement to the upside with volume, try to break some of those resistance levels that I highlighted here earlier, $24, maybe that $29 area where the point of control is. That would provide you a little bit more confidence that maybe the trend is changing. But right now, primary trend is still intact, and even secondary trends are still to the downside as well.
All right, pretty bearish. We're going to move our way up here to the from the worst to maybe the best. And in between, I think these charts that we're going to do on these three stocks is Philip Morris. What are they saying here? It seems like the analyst at Stifel does like the stock and price target close. I mean, it would be a year high.
You're right, close to a year high. So
all right, so nice outside.
And it has a $114 price target on it, and it's with a buy rating. Shares are lower today, though, because the consumer staples sector is down. There may be some profit taking happening.
All right, looking for this dip to get bought.
Consumer staples during the banking turmoil, but nevertheless, Stifel resumes coverage with a buy rating and $114 price target, which represents about a 15% move to the upside from where it's trading today. Now, this analyst is identifying Philip Morris as among the firm's top ideas in the space, right? And he believes that it offers superior growth potential compared to both of its tobacco and consumer staples peers. And so this trends somewhat with what the market thinks. Analysts polled by Zacks feel that this stock will deliver a year-over-year decline in earnings per share, but on revenues that increase for the next quarterly earnings report. We'll see that on April 20th. But yeah, that's
kind of touching.
It's a little touching.
Yeah, it is, exactly. All right, so mixed bag expected for earnings-wise, which are coming up next week on Thursday. But $114 price target. I mean, if the team of Stifel's got this right, That's a nice big breakout. Kevin, is there any sign of such a breakout?
Potentially, I mean, it's on an upward trajectory at this point in time here, Oliver. But with this chart, you have pretty much everything. Easy to identify resistance and support areas, cup and handles, star patterns, you name it. But we're going to keep it really simple here. First and foremost, before we talk about that price target, we have to get through some of the easier resistance levels to identify. First and foremost, the first one that I would really be focusing on is point A, the resistance level at 104. We see that was the recent high, and we actually tested that high around 3 times between December 2022 and February 2023, but it was not able to actually break through, and we did see the movement to the downside. That's when we go to point B. Point B, you can actually see that point of control is sitting at around $101.50. The reason being, there was a lot of trading happening during that range-bound movement that we talked about at point A. So yes, you could potentially see a situation where if it breaks through that point of control, you might get some momentum traders that start to buy the stock because they do feel like it could move to the upside. But then we look at point C, RSI, CCI, close to oversold territory. It's actually been fairly reliable for the stock. Once again, determine the amount.
All right. Most stocks are starting to see some short covering for now. Just assume it's short covering.
At this point in time, maybe it takes a little bit of a breather. So keep that in mind. Even though we do see the RSI at those levels, we could see it pull back down to that $95.25 range. That would actually be healthy before it pushes all the way back up on higher volume. If it pushes through that point of control, pushes through that resistance level, that could be a boost of confidence.
Okay.
So pretty well established levels here to the upside that might act as some resistance. So you have to be careful about that if you are super long the stock. At least it gives you something.
Mostly sell signals for now. The major indices. Short term. Intraday.
Already, and so Barclays raised the price target to $201. That will put it about 9% above where it's trading right now. And the company is down. Shares are down today for the same reason that Philip Morris is, profit taking in the greater consumer staples sector. But this analyst also kept an overweight rating on the shares and says that Pepsi is within the firm's staples universe, and that in that group, the analyst thinks that names with greater visibility to volume growth is best, right? And so it's either through enhanced cash
Bear flag. Looks like a bear flag.
The company will achieve that situation, right? And so earnings come out at the end of this month for the company. Citibank also said something a couple of days ago, placed PepsiCo on its 30-day catalyst watch ahead of the earnings. And the analyst said that scanner data suggests that Pepsi beverages and Frito-Lay sales in North America could significantly outperform expectations. So we'll look and see if those numbers line up with that.
SPY looks like another bear flag. 415 is a major level. SPY.
Extreme low declared.
We definitely ran into resistance here, but the stock has been very resilient. If you look at point A, the resistance level is at around $185, tested 3 times between November and December of last year. And if you're looking at support, it would be at around $177. But the big key area here for me, Oliver, is going to be point B. Our volume profile shows the point of control at $170.75, which is all good and well.
All right, new low here. Looks like they're headed down to 410 potentially.
There's actually significant volume leading up to that point of control, which means it will be fairly difficult for bears to try to knock the stock down unless we see something very drastic happen. There have been consistent buyers at these price levels all the way up here, and that just allows a little bit more resiliency when it comes to this.
All right, not much to do today. It is a Friday.
See a little bit of an intersection at around that $175, $177 range last night. Last but not least, CCI is overbought, RSI is overbought. Both indicators have been actually fairly reliable. When we do see a break in the stock, it does tend to test recent highs. So that's another area at $177. So all of these areas are kind of converging, if you will, when you're looking at the indicators. But once again, that volume is really showing me that it's going to be fairly difficult to try to break the stock down in the near term.
Got it. All right, looking pretty good. just got to chug along through that previous high. But so far, Pepsi has not let down.
All right. I'm your host, Cousin Vinny, coming to you from theclosingprint.com. It is Friday the 14th, very early in the morning, 10:44 on the East Coast. Markets hit the resistance levels pretty quickly and reversed. 415 is a major level for the SPY, 4150 for the S&P 500. So you should have been anticipating that if you were paying attention this week. 4200 is a major level. We did see the call wall for SPY shift from 420 down to 412. So we're right at that 412 level now and starting to see a bounce, some short covering.
First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more. Trade network. The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradenetwork.com, all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. See a neighborhood where risk meets opportunity.
All right, S&P. $41.63 high. All right, so it looks like VWAP is starting to flatten out.
Just getting started. TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcast and start learning today.
All right, shorts covering. Shorts starting to cover.
Red as equities fade since the open. The biggest loser in the S&P 500, Catalent, the healthcare supply business. What happened here, Caroline?
Hey there, Oliver. Yes, shares sinking 25% after the drug manufacturer issued a profit warning. Doesn't actually report results until May 9th, but ahead of that, said it expects productivity issues and higher than expected costs at 3 of its facilities, 2 of which are its largest manufacturing facilities. Said those issues and costs will materially and adversely impact results for the period and the rest of the fiscal year. In terms of those 3 facilities affected, one is a gene therapy manufacturing facility in Maryland. Says it faced productivity and operational issues, won't impact the quality of its products, but will impact revenue in both Q3 and Q4. Also, 2 facilities in Indiana and Belgium fell short on productivity and revenue due to operational and some engineering control changes after.
All right, you're looking at PayPal earlier, Joel, PayPal. All right, trying to turn the corner. What's Block doing? Square? Nope.
Catalent said it has taken a number of measures to address the root causes of the issues identified at each site, including management operational changes. And on that note, it actually did announce an interim CFO effective today after its CFO left yesterday. So as you can see, shares down more than 25% today. This isn't a stock I cover often, so I wasn't exactly sure how it had been performing year to date, but based on the fact that it's still up almost 5%.
All right, some of the banking cards, credit cards, moving off these bases. Visa had a good job. Popped, continues to trend higher. 250 was the strike that was most active yesterday. Bought some of those June 250 calls. Pretty decent open interest there.
Not like Boeing, where you said it's not necessarily Boeing's fault, although still can't finger point externally for this one. It seems like much more internal issues, hence some of those operational and management changes that they're announcing. But I guess it doesn't matter at the end of the day. It's still impacting the stock.
Meta, JP Morgan holding on. Very nice, JP Morgan. Morgan Stanley. Nice trade today. Big bullish candle. Institutions buying high and selling higher. All right, so we could see this push to this area. JP Morgan. The highs over here in 2021. 165. Do note that Money Magic posted the bank levels. JP Morgan, 137. Above 137, need to look for new calls as we push higher. JP Morgan. All right, so SPY still looks like a bear flag at 412. That's where the call wall is now.
When the banks have been reporting good earnings. And so if we're going to see that, and the banks do report decent earnings, especially coming through the whole bank debacle that we've seen recently, if we see some decent earnings come through there, then we may be looking at maybe no recession, but maybe at the very worst, a softer recession. And, there's a lot that could be said about that in terms of
Let's see, the dollar. Dollar trying to bounce, double bottom. 10-year yield, that'll impact growth stocks. If this continues to push higher or at the 200-day, do we produce a lower high by the close, or do we push above the 200-day? Any move higher would be considered a headwind for tech stocks. New York Fang still consolidating.
What's happening with yields, two-year yields are actually higher today, and I think that suggests that there's more confidence right now in what's going on with the banks, and I think that's a good thing. I'm a little bit concerned on a couple of things, though. If you look at the core CPI numbers, they're actually moving in the opposite direction relative to the headline numbers. I think that, again, is speaking to prices that are getting dug in, or if you will, are a little bit more sticky than
Okay, Fridays I generally don't do a whole lot. Today's no exception. We had the call wall for the SPY moved from 420 down to 412. We're sitting right here at 412 right now. A drop below 412, possible. SPY, we could get down here to 410. Still in a very bullish trend. We're reverting back down to this 410, 409 area. Had a nice pop yesterday. We're making new lows now. S&P been on a sell signal since that first bar right there at 10:05 when we hit the highs resistance and sellers came in. So now we're just fading.
So the confident, George, to that point, when you say the market feeling more confident,
China's foreign minister says China and Germany are partners, not rivals, and China and Germany need cooperation, not confrontation. When formulating China-related strategic documents, Germany should proceed while considering interests of the two countries and make correct political choices.
Now these numbers are suggesting the money kind of flowed up to banks, and there is stability at the top.
And the Chinese foreign minister says as long as both sides remain open, there is no need to worry about so-called
I mean, does that go out the window too?
Well, that's the thing. I think if you just look at core inflation, they should be moving higher in terms of rates.
This stream is sponsored by TickStrike. TickStrike allows you to actually hear order.
Concentration issue. We're seeing more concentration amongst the bigger banks. That's just a normal part of the
All right, VIX is pretty tame for the most part at 1790, 1785. Not a whole lot to see here on VIX. Looking at this more like a spring being pushed down. Eventually, we'll most likely see VIX become unsprung and start pushing back towards the mid-20s, I would think. But volatility is certainly on a bender.
Which is still relatively elevated at 5.6%, considering the federal funds rate is still below 5.
Okay. Scott, what do you think here? Do these data from banks give the Fed more confidence that maybe they can still be aggressive without breaking the system?
Yeah, absolutely. As a matter of fact, the Fed president out in your neighborhood, Oliver Goolsbee, said yesterday.
Not much to do here.
Yeah. He said, and I'll quote him. He said, "What I'm looking at quite clearly coming into the next FOMC meeting is what's happening on credit. How much of a credit crunch is there?" He said. And so, they're definitely looking at this. This is going to be an extremely important component to it. Waller, who was also quoted yesterday,
Banks are flat to slightly lower at the moment. The regionals, JP Morgan still on a move. JP Morgan still grinding. I took profits on half of the 140s. Those are June 140s. Took a nice profit, nice fat profit on half of those. I'm looking for a dip or a flag next week. I don't want to buy up here any shares or anything. I just want to wait. Starting to see a little short covering here. SPXU's at the highs.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the options for volatility course, we explore what implied volatility is, how it can potentially affect the price of an option.
All right, let's. We were looking at the dollar. A little bounce there. Silver and gold. Pretty decent reversal on silver. A little profit taking, it looks like. If you check out the commitment of traders report, I imagine that shows that commercials were taking profits. Gold and silver pulling back. Dollar's up a little bit. Not a whole lot, but it's higher. Let's see what the defensives look like. Defensive sectors like consumer staples and healthcare. JP Morgan, Goldman Sachs, Caterpillar, that's the Dow Jones, AXP, HD, IBM's up 0.25%. BlackRock, State Street.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME,
Okay, mostly red. It's a Friday, not surprising. We are trending despite the, off day. We've had a pretty good, decent week. We've been trending along the 92150. We knew that 4200 and 4150 were going to be resistance. No surprise, we got rejected there. If you're playing this intraday candle or intraday price action, more power to you. I'm just sitting here watching, looking for dips to buy. I'm particularly interested in banks like Deutsche Bank. I have 10 call. Deutsche Bank, I'm looking at this to be up to 12.13 by the time those calls would expire. All right, so they're January 10. They're in the money. They're making money. UBS is another one I'm interested in. UBS, we talked about UBS potentially getting back to the highs. We finally did that today. Actually, yesterday we tagged it.
Checking out the futures products here this morning, you're seeing oil moving higher, 82.30. Gold at 20.11 a troy ounce, that's down $43. U.S. dollar hovering around one-year lows yesterday.
All right, people taking profits to end the week.
And Bitcoin futures at 30,725. Of course, we've gotten in a lot of the news from the banks, and that's a big story. Joined by Jenny Horn, markets correspondent here on the TD Ameritrade Network, to take a look in detail at some of these banks' earnings that we've really been waiting for. Your thoughts? Start with Citi.
It seems like, at least so far from what we've heard, Nicole, that these bank earnings were not perhaps as bad as feared, as we're seeing a nice pop really collectively across the board here. Citigroup making a nice move higher after their earnings did top.
All right, so we're holding on to the call wall. 412 is the call wall. It shifted from 420 down to 412. So it looks like support for now. If we lose 412, then 410 is in the cards. JP Morgan with a nice move today. JP Morgan. But just grinding along now. JP Morgan. So long as the financials can manage to hold on to some strength, we should be okay. Industrials look pretty good as well, with the exception of Boeing, of course. Pausing some of its, I think, the MAX production on quality issues. Some of the parts in the tail section were not up to specs. Spirit Aerosystems, I believe, was one of the providers. They have 3 providers. So looking for opportunities. There goes SPXU starting to push a bit higher. SPXU.
Yeah, absolutely, because there are really big differences between each of these banks. JP Morgan, another one you're following closely.
JP Morgan, another one making a nice move higher, even some more sizable upside than what we're seeing in Citigroup. And just to paint in picture how much of a move we're seeing higher today, shares were down actually 3.8% through Thursday.
Vertex Pharmaceuticals. That was one that Jimmy Lebenthal mentioned on Wednesday. That's still looking pretty good. Vertex, continuation, Doji now. On Wednesday, this was breaking through the 325 zone. That's where some of you may have bought. I bought some shares too. Vertex. Let's see what AbbVie looks like. AbbVie's trending. AbbVie produces a few bullish days, and every once in a while you get a bearish day. It's a Friday. So it's been higher all week from 159 up to 163. Nice 4-point move for the week. It's off a little bit today. Let's see what J&J looks like. J&J still consolidating at the 200-day. Once it gets above the 200-day, I'll start adding to J&J. BMY. AstraZeneca. Novo Nordisk. I think Prism has that one. Novo Nordisk. Got a doji up here tagged 170 and looking pretty good. Generally today, not really that interested in doing much. There is strength in some of the industrials and transports. And the banks, of course, the big banks, money center banks. But everything else is pretty much telling you just chill. So that's what I'm going to do. UPS is up 0.5%. Caterpillar up almost 1%. Emerson, PACCAR, Airlines, Delta Airlines bouncing, Fastenal. United Health off almost 3%. United Health. Some of the consumer discretionary hotels doing well. Let's look at Hilton and Marriott. Marriott and Hilton. These all look pretty good. Hilton. Yeah, HST. Hyatt.
These banks would just stop lending, right? And that everyone was worried about credit tightening and rising standards. And I thought the commentary on the economy from a lot of these bank CEOs was actually very benign, considering they've been a negative bunch before.
Yes, Sarah, so they're still making loans, and you have to understand that they don't bank everybody in the country. They are preferentially banking, the people who are generally better off, higher income folks, people with actual assets to their name. And so, they feel like these people are good credits. They're going to continue. Jimmy Dimon was asked this about a potential credit crunch, and he said, we aren't going to, drastically pull back on credit. He did, however, hint that there is a risk that the banking system as a whole pulls back because as we get closer to recession, people are going to be risk off.
Hey, finally, Hugh, any read-throughs on Goldman, Morgan Stanley next week when we start paying a little more attention to capital markets activity?
I'm going to say that they're looking pretty good today because if you saw the results out of fixed income at both JP Morgan and some of the other banks, they look really good. They actually outperformed JP Morgan did by roughly $400 million, exceeding expectations on fixed income. And as you know, Goldman and Morgan Stanley both have sizable trading operations. They're going to look pretty good there, Carl.
Hugh, appreciate it. A good wrap up, and there's a look at what's coming our way in the next 5 sessions. Hugh Sung on banking today. So from commentary on the banks to a resilient consumer, JP Morgan says U.S. consumers and small businesses both continue to show some resilience with spending remaining solid. Wells Fargo CFO did add that credit and debit activity is increasing, and it feels like there's still a lot of activity in the economy, although they do expect some slowing. But today's econ data does uncover some cracks in the consumer. Retail sales, as we said, down 1% in March, the lowest level since November, and the weakest ex-auto number since late 21. The odds of a 25 basis point hike jumping to around 85% for the May meeting. Joining us today, JP Morgan's chief U.S. economist, Michael Feroli. Michael, happy Friday. Appreciate the guidance today. It's great to have you. I think in general, your framework has been that Q1 is resilient, but it's Q2 where we're at least on guard for a drop-off in the consumer, right?
Well, I thought this morning's number was actually fine. Some of the weakness we saw in March was, related to gas station sales. Also, the January level was huge, so we're kind of coming off of that. It was supported by some one-offs, but overall, I think the picture looks okay for the momentum heading into the second quarter. So I don't think second quarter maybe tough to match the first quarter, but still, it doesn't feel like we're kind of slipping off the precipice here or anything like that.
Right. I did notice a chart you guys published last night, basically looking at claims in the wake of some of these revisions. And it feels like, what's the number? Is it somewhere around 250K where if you do meaningfully shoot up above that, then you might start...
Still sitting here at 412, not much movement.
Yeah, we're not there yet. We had a little bit of a drift higher in claims in January and February. They look like they've stabilized over the past few weeks. But I think if we are going to have a recession sometime in the next few quarters, we would expect claims to drift higher and payrolls to slip into negative territory. But we're pretty far from there right now.
Larry Fink this morning at BlackRock, which is another big winner in today's session with all the inflows, Michael said that he doesn't necessarily see a recession happening in 2023 and maybe 24, a shallow one, doesn't see a very big one. Is that something that you agree we can get away with at this point with all of the monetary tightening, the high inflation, and now the worries about bank lending?
So, our main view is that we have a mild recession starting very late in the year. So I would agree with the point that, we could get out of this year without a recession. I think the question is, can we have a disinflation from where we are to something closer to 2% without a recession? Historically, that's never happened. I mean, we don't have a ton of data points on this type of inflation. So it's possible, hope's not unreasonable, but the history would suggest to get back to inflation around 2% would require a rise in the unemployment rate of above a percentage point, which would be associated with a recession. So I think that's, again, the most likely scenario. One can always hope that we have something a little more benign, but I don't think that's a starting point that I would think about.
Do you think the market catches up here more with the Fed? Because the lines from the Fed, and I know there's a little bit of divergence lately, but it's basically not convinced yet on the disinflation story enough to pause or think differently about the outlook. Yesterday I was at the IMF meetings. The managing director said, yeah, it's coming down, but not fast enough. There's still more work to do. And that appears to be a consensus among central bankers in Europe and the United States. So do you think the market is going to come around there?
I mean, you said if it catches up the line from the Fed, I guess it depends what line we're talking about. I mean, the Fed officials are saying, we're not going to be easing anytime soon. The Fed staff is saying we're going to have a recession later this year. So those are kind of two different messages. Generally, when you have a recession, the Fed cuts interest rates. So, I think the market may be a little more aligned with the staff forecasts, right, than what the Fed's saying. But I would agree with the line coming out of the IMF is that unless we have something, much more, a bigger setback in growth, it's pretty hard to see the Fed just easing for no other reason later this year.
We were talking earlier about one more in May. Earlier in the week, I think you did say that there is room for a June move. And I just wonder, how many meetings do you see a non-zero chance of a hike?
So May, our baseline is May. I think the risk is 2 rather than more tilted toward 2 than 0 in terms of the number of future hikes. So I do think June is very much a live option. We have 2 payroll reports between now and the June meeting. If those don't, slow down pretty significantly, I think it's going to be hard for them to stop in June. July, I think it's a little trickier because we might be right in the middle of a pretty bruising debt ceiling battle, which could turn out in a way that's very unfavorable. So I don't think that's an environment in which the Fed wants to be hiking. So I do definitely think June's on the table here. May, as I said, we have pretty much all the data we need between now and the May meeting. The only thing that could set back May is if we have a resurgence of stress in the banking system. Otherwise, it seems to me like May is, I wouldn't say a done deal, but it seems very high odds on May. And then, yes. And then June, I think June gets a little more interesting. I think it's really incumbent on the data slowing pretty significantly here to get June, to have a June pause, I think.
Pretty remarkable turn from the conversations we were having, say 3 or 4 weeks ago.
Sure.
Michael, thank you so much. Good to sum up some of the work you've done lately. Thank you, Michael Ferroli.
Still to come this hour, much more on the strength of the financial sector. CFO at Wells Fargo joins us, so far downplaying the impact of the banking crisis. And then we've got an exclusive with the Deputy Treasury Secretary of the United States, Wally Adeyemo, a look at Washington's plan to backstop the economy and how they're thinking about inflation right now and the current cycle. Plus, Boeing, a major drag on the Dow. That story also coming up when Squawk on the Street returns. We're down 171 right now on the Dow. The S&P 500 also weaker than when we started, down about 0.25%. Financials, the only sector currently green.
Yeah, not much to see here. I'm just scanning through stocks at the moment. Only thing I see is some healthcare, some of the hotels, the banks, but generally not really much going on today. Considering the banks didn't scare the market, so with Jamie saying something like, "Oh my God, the world, the sky is falling." So I'm thinking of I'm looking at opportunities on some of these dips, stocks like CVS, for example, that to follow through and push higher. CVS. Lending. Visa pushing higher, a little profit taking at the highs, but looking for a follow through. 250 calls were very active. Some of the biotechs did good this week. LABU, a big move yesterday, no doubt tied to the lending that some of these companies are going to need going forward. My wife just telling me that a restaurant near us, the landlord's raising rent for Sam Sneed's, the well-known golfer back in the Jackie Gleason days. Landlords raising rents along some of the 501 corridors, more busy area of Myrtle Beach. Kind of interesting to note. They'll go somewhere else, take all their memorabilia with them. Lots of movement down here in Myrtle Beach. A lot of people from New York moving down. I was talking to some friends that are in the financial industry group that work with UBS. They're talking about the Miami district down where everyone's moving from New York.
It's significant, but it's too early to know how significant because it depends on whether or not we see a big drop in deliveries or if this is an issue that can be rectified, let's say, over the next several weeks. And it's not a 3-month or 4-month delay or slowdown, I should say, in deliveries. Here's what's going on. Some 737 MAX deliveries are paused. I should point out the most popular model, the 737 MAX-9, that is not impacted by the slowdown in deliveries. 2 parts from Spirit Aerosystems incorrectly installed, so they're going to have to do an inspection to see which ones need to have those 2 pieces replaced at the aft fuselage where it comes together with the vertical stabilizer. Important to note, this is not a flight safety issue. So the MAXs that are in service, they remain in service. But it will impact deliveries That's the expectation.
SPY still hanging out here at 412. Looks like a bear flag. Could drop off here, so you might want some put protection if we bounce and fail.
Analysts who are surveyed by FactSet is that they're going to deliver 445 this year. I should point out that is not the guidance. That is the estimate from FactSet. That is pre-news coming out. So what you're looking at is a number that is likely to come down. Though, as you take a look at what Boeing and Spirit are doing today, keep in mind that Moody's Investor Service, they just put out a note a few minutes ago saying that they think that the 410 deliveries that they are already modeling for this year is still achievable. So they're not going to bring down their delivery estimate. Meanwhile, other analyst guys like Sheila Kaiula, she is bringing down her delivery estimate. To what degree, it remains to be seen. It all comes down to how long this slowdown in deliveries lasts. Is this something for 2 or 3, 4 weeks? Is this something 3 months? Is it something for 6 months? That remains to be seen.
Yeah, I mean, the immediate knee-jerk conversation, Phil, is whether or not it has a meaningful impact on airlines' ability to get fresh aircraft. I noticed Southwest, heavily reliant on the 737, is down more than other carriers today.
Right. And at this point, and we've reached out to Southwest, haven't heard yet. We know from United came out and said, look, this does not change our plans in terms of aircraft that we have in service, obviously, or aircraft that we plan to put in service. So we will likely hear from other airlines as well. It really depends on how quickly they can get their hands on how many of the aircraft that are in production or in inventory are impacted. And just for a point of reference, they had about 250 in inventory at the end of Q4. The estimate is that they probably have 230, 232. Now, remember, not all of those will be impacted because many of those are the MAX-9, which is not part of the slowdown in deliveries.
What a story, Phil. Wow. Coming up last night and impacting the market today. Phil LeBeau, once again on Boeing. Phil, thanks. Still to come this hour, we're going to talk to the CFO of Wells. Stock reversing some early gains along with the major averages. That call is wrapping up with the CEO now saying there are some pockets of risk out there. Dow down an even 200. Squawk on the Street continues after a short break.
All right, so biotechs, watching those as well. Had a pretty good week. You're looking at Crocs. Crocs. Crocs looks like it could go. Come out of a base. Morgan Stanley. Will fade at the 21 day. Morgan Stanley. Earnings next week, Wednesday. Just doesn't feel like there's much to do today. Just running some scans. Jimmy Choo, Steve Madden. All right, looks pretty good. Hilltop Holdings. Nope. NetEase.
Welcome back. Let's take a look at the story abroad today. European markets closing out a pretty stellar week. Euro Stoxx 50 notching a win as equities across the pond see their longest weekly gaining streak since early December. I'm watching the euro dollar as well. Euro's been strong, dollar weak, though that's reversed today. It's near, though, the lowest level in about a year. I'm also, Carl, watching Infosys, the Indian company. Everybody's looking at that one today. The stock ADR trades here, hitting a 2.5-year low. The company reported a miss on profit and revenue and said the outlook remains uncertain. And some of the CEO quotes are interesting here. We saw an unplanned project ramp down. We saw unplanned project ramp downs in some of our clients this quarter. In other words, weakness from enterprise spending. A lot of people look at
All right, let's look at international markets.
software consulting services companies in the world. So when they're talking about weakening demand and surprising weakening demand in pockets like finance, which the company did mention,
United Kingdom making new highs.
On what's actually happening with company confidence and spending.
That's funny. It was just
UK making new highs. A little profit taking today.
also the biggest spender of IT. It's a huge part of the IT business. So if you do begin to see cracks or at least more disciplined cost control within banks, that's good. There's going to be a bridge to tech. It largely goes through software.
Right, and tech, we were already worried a little bit about tech pulling back because we know that
Greece at the highs. Greece looks like it's just going to keep going.
margins, not worrying about finance.
Lots of volume.
After the break, speaking of financials, next picture right now. After a strong start this morning, JP Morgan still is the big winner of the day. Of course, the health of the balance sheet, deposit growth, key concern over the past month for the entire sector. Deputy Treasury Secretary Wally Adeyemo joins us next with the White House's first response to the health of the financial system following some key results. Stay with us.
So Greece, the issues they had with the government and all the problems with a potential default, that was in 2014, it looks like, right? About 236, 382, about 382 Fibonacci's on the retracement. 50% would put us right around 42, it looks like. Removing the candles. Note, it doesn't look anything like S&P doesn't look anything like 2000, 2002 or 2008 into 2009. Still pushing higher. Interesting. European debt crisis was 2011. Greece, that was 2010. Okay, 2010 was Greece. 2010. Russian ruble was 1998. Okay, so Greece 2010. All right, SPY still drifting lower. More importantly, right now we're just showing weakness.
Some session lows here, down 222. Let's get a news update with Bertha Coombs. Hi, Bertha.
Hey, Carl. Here's what's happening at this hour.
VWAP tilted down and to the right, so we're more bearish bias after hitting the highs. Rejected at 415. That was major resistance.
Highly classified military documents. The new details come as 21-year-old Jack Teixeira appears in court this morning to face charges under the Espionage Act. A federal magistrate judge ordering Teixeira to be held until a detention hearing next week. China will not sell weapons to either side in the war in Ukraine, according to China's foreign minister. The country has maintained it remains neutral in the conflict despite backing Russia politically and economically. This comes in response to Western concerns that Beijing could potentially provide military assistance to Moscow. And former President Trump answering questions for nearly 7 hours on Thursday during his second deposition in a legal battle over his company's business practices here in New York. The former president reversed an earlier decision to invoke his Fifth Amendment protection against self-incrimination and remained silent. Sarah, back over to you.
Bertha, thank you. Bertha Coombs. As we had to break, let's check in on the markets again. Down 229 on the Dow right now. S&P 500 also under pressure. It's down about 0.4%. Financials are certainly helping, almost 1% as a sector, but everybody else is down. And the biggest drags right now are utilities, healthcare, down 1%, real estate down 1.3%. As far as healthcare is concerned and the Dow, United Healthcare, by far the worst performer, it's shaving 100 points off the Dow. Earnings season, notching a beat, raising its full-year revenue outlook, expecting member growth for its insurance business as well, but Wall Street not sold. Session lows for the stock. Of course, the banks are the big winners again. Just want to give you another check as we head to break. JP Morgan is the winner in the space and also helping offset some of the losses from United Health and Boeing. JPM adding 60 points to the Dow. It's up 7.3%. We're going to talk to Wells Fargo CFO Michael Santomassino in just a few minutes after the break about his company's performance and some of the worries about banks in general. We'll be right back.
Cody with a breakout. Cody, COTY. New highs, just trending. It's got an ATR of 25 cents. Maybe they got something going on with the Kardashians. Least our note SPY rejection at the weekly. The Senkubi.
The banks and the read-through to the economy. Reports from JP Morgan, Wells Fargo, PNC, and Citi providing some context surrounding the health of the financial system. Of course, we have yet to hear from some of the regional players, which were hit hardest from the collapse of Silicon Valley Bank and the subsequent deposit outflows.
Actually, we're sitting just outside of Kumo now.
12 months. But joining us now to discuss in a CNBC exclusive is the Deputy Treasury Secretary of the United States, Wally Adeyemo. It's great to have you back, Secretary Adeyemo. Welcome.
Thanks for having me, Sarah.
So what's your early read here? Because there was a lot of worry, and I know you were at the center of the action trying to help restore stability in the U.S. banking system. What's your read on what we've heard so far today?
Sarah, like you, I've been paying attention to the reports from various companies throughout the economy. I think that what we've heard from the banks in particular is what we've been saying over the course of the last few weeks, that the American banking sector is resilient, and that the actions we took a few weeks ago helped to reassure the American people that the government was willing to use our tools to make sure that we protected that system. And we look forward to seeing how banks will provide credit to the broader economy to make sure that the economy continues to grow and produce the robust jobs that we've seen over the course of the last 2 years.
Definitely signs of stabilization, not just in the share price and some of the read-throughs, though. You know, if you look at some of the Fed balance sheet data, which was out recently, we continue to see a decline, but still a very elevated level of borrowing from the discount window, from the new emergency facility created. So it's not like all clear, is it?
What I would say is that the situation has stabilized, and what we've seen in terms of the data that have been available is that people have started to return collateral to liquidity, back to those facilities in exchange back for their collateral, and the deposit levels have stabilized. And in some of these banks, you've seen deposits actually increase over time, so that they're in a position where they continue to do what banks do, which is provide lending and credit to the economy.
Are you worried about the tightening of lending and what we're about to get from the regional banks in the next few weeks on that front?
So, Sarah, as you know, it takes a while to see the data, but we haven't seen meaningful tightening. I think the information that we garnered today from earnings left us with the impression of what we know to be true, that demand in the economy remains strong, and that overall it's the consumer demand that drives a strong and robust economy. And as long as that's the case, you're going to end up in a place where you're going to have banks in a position where they're going to want to extend credit to businesses that are growing going forward. So we look forward to seeing the rest of the earnings season, but fundamentally feel confident that the economy at its core is continuing to robustly produce jobs, and also that demand remains strong, which will help drive a strong economy going forward.
Wall Street's obviously been wrestling for months now about what the future holds regarding the debt limit, and there are some reports that maybe the House Speaker offers a one-year extension in return for some concessions. I mean, I don't expect you to get in front of that too much, but is it being talked about today, this idea that we might get some formal proposals moving?
I'm not going to get ahead of it at all, but what I'm going to say is that what you know to be true, Carl, which is that it's critical that Congress lift the debt limit. The last thing we need is a manufactured crisis in our country. I'm right now in the midst of meetings with finance ministers and central bank governors from around the world, who are all complimenting the strength and resilience of the U.S. economy. The last thing we need to do is to have a manufactured crisis that would take away from that confidence the world is showing in the U.S. at the moment. It would slow down the momentum that we have, and we hope that Congress does what it needs to do and lifts the debt limit.
I'm curious about those meetings you're having. It's IMF week there in Washington. I was there, and everyone's in town, the central bank governors and the finance ministers, and there's some gloom as far as the global outlook is concerned. The IMF warned about it this week in terms of what they expect for the global economy, and I'm wondering if the U.S. is still the beacon of growth in the world economy, given that some of the problems and the biggest risks to the system are now emanating from our financial system. What are you telling your counterparts?
So, Sarah, I characterize it differently, and my counterparts do in the meetings that we've had. Fundamentally, the actions we took a few weeks ago helped mitigated those risks by making sure that we've made clear to depositors that they would be safe, and the facility that the Fed created also provided liquidity. What we've seen since then is we've seen healthy job numbers in the United States. We've seen the CPI data that's come down we have to make more progress on inflation in the United States, but the idea that we're continuing to create robust levels of jobs while inflation is coming down speaks to the underlying resilience of the United States economy. And while there are headwinds, and we all face these headwinds, not just in the United States, but around the world, be they Russia's invasion of Ukraine or the post-pandemic supply chain issues, what we've seen since the IMF released their report in October, when they called for the world economy to slow.
All right, I need to make a few phone calls, so
Taken in the United States,
you're going to be, it'll be a little bit quiet, but I am here. Just got to take got to take a few minutes to make some phone calls, and I'll be back with you. Pretty slow day. Looks like we're going to test 410 potentially.
In this country, and it kind of led to people being perhaps more nervous or even panicked than they needed to be in the month of March. Do you think does there need to be some kind of education / marketing push beyond just seeing that gold plate when you walk into your branch?
I think it's important that people know that if you have insured deposits in this country, that the FDIC has an insurance scheme for dealing with that. But I think even more important at the moment has been the what we've done when it came to Silicon Valley Bank and also Signature Bank, where because we saw the underlying potential that depositors would leave institutions throughout the country, we used the systemic risk exception, the Fed, the FDIC, unanimously amongst their boards, to send a clear message to the American people that your deposits of any size were going to be safe. And also the Fed's creation of this facility, which made sure that banks would have access to liquidity. Fundamentally, what we're saying is that the U.S. banking system is resilient, and that's what you've seen in terms of early reporting and what we expect going forward.
But what if it happens again? I don't want to create alarm, and I know there's some stability, but what if it happens again? Do uninsured depositors get bailed out?
So, Sarah, the conversation that we've had on the air previously and we've continued to have, the system has stabilized and we're in a better position, but we also have the tools to be able to deal with it if we get into a situation where we have those challenges. And the Secretary has made very clear that we're prepared to use those tools again.
Finally, really quick, Hank Paulson gave this fascinating interview to the FT, I think it was last night, where he talks about China and says, and I'll read a quick quote here, great powers don't look to go into war, they stumble into it. I think it's important that we tone down the rhetoric on Taiwan. Despite what you read, the last thing that Xi needs is a war for Taiwan. That comes on the heels of a Nick Kristof op-ed earlier in the week. Do you think perhaps the U.S. is using fulmination as a policy too much?
So I haven't read the article or seen what Hank said. What I will say is that ultimately our goal is to make sure that we're in a situation in which we can work with countries around the world, including China, to both deal with the challenges that we have in a constructive way, but also to find ways in which we can cooperate and work together on things like climate change and addressing sovereign debt going forward. This is why meetings like the ones that are happening here in Washington matter, because they give us an opportunity to meet with our allies and our partners, but also with all the countries around the world to talk about how we forge a path forward. That's exactly what the Secretary and I are doing with our counterparts, be they finance ministers or central bank governors.
Well, we'll let you get to it, Wally Adeyemo. Thank you very much for taking the time today.
Thanks for having me. Take care.
The Deputy Treasury Secretary.
Coming up still, Tesla with yet another price cut, this time in Europe. We'll get some details on who may benefit later. And a non-earnings mover, VF Corp. One of the calls today is Goldman double upgrade, going from sell to buy. That comes on the heels of earlier, actually it was just yesterday, Edward Jones also upgraded to buy. You can read more about that on CNBC.com. Back in a minute.
Chair.com.
Tesla with yet another price cut this morning. It's the focus of today's Tech Check. Phil LeBeau is back, having talked about Boeing. Now here to talk some Tesla. Hey, Phil.
Hey, Carl, not a surprise that we're seeing more price cuts from Tesla. We've already seen them in China and the U.S., their two largest markets. Now we are seeing them in other parts of the world. According to Reuters, they have decided to cut prices on the Model 3 and the Model Y in Europe. Germany in particular, 4.5 to 8% cut in the prices there. Singapore, a cut of between 4.3 and 5%. Remember, in terms of global EV sales, Tesla still leads the market. I get this question all the time from people saying, well, yeah, they lead here in the U.S., but what about around the world? Their strength in China, along with the U.S., helps them get 17% market share. There you see BYD nipping at their heels, particularly in China, but also expanding in Europe. And then VW and GM. As you take a look at shares of Tesla, keep in mind, we hear from them after the bell next Wednesday. That is when they report their Q1 results. Interesting to see whether or not they will say anything about how these price cuts might impact their guidance, though I don't think we're going to see them lower their guidance from the expectation of delivering 1.8 million vehicles this year.
Phil, I wonder, I thought of you because Adam Jonas of Morgan Stanley did a piece this week where he looked at the Norway market, which is, in their view, about a dozen years ahead of us in terms of EVs. And one of the arguments they made was that, Tesla's made a lot of inroads into a more mature environment, but those Chinese automakers also are making a stand.
You know, the Chinese automakers are extremely aggressive, obviously, in their home market, and they've got some advantages there in terms of incentives from the government. Then you look at what's happening in Europe. I've talked with people who are active within the auto market in Europe, and they make a point of saying, you would think that people would say, well, boy, I'm going to buy Tesla or I'm going to buy a European brand in terms of an electric vehicle, not a Chinese brand. If the price is low, those consumers are no different than anywhere else. And especially in the UK, that's where you're seeing the Chinese automakers become very aggressive. And it's impacting sales. They are picking up market share. Not a lot, but they are starting to pick up market share.
Yeah, something to watch for sure. Phil, thanks. Phil LeBeau. We're also continuing to watch the banks today. Wells Fargo trying hard to hang on to gains after a strong start to the session. The company warning to expect some slowing of the economy. We'll get into it with CFO Michael Santomassimo. He joins us next. We're back in just 2 minutes here on Squawk on the Street with the Dow down 200. We'll close out the hour where we started with the big banks. That's the story of the day. Wells Fargo delivering a beat across the board in the first quarter, but on the heels of a turbulent month for financials, did up their provisions for credit losses to $1.2 billion. Joining us now for a closer look and a first on CNBC interview is Wells Fargo CFO Mike Santomassimo. Mike, welcome back. It's good to see you.
Thanks, Sarah. Good to see you again.
So, I mean, there was a lot of worries going into the quarter, and it looks like, at least on the top and bottom line, things look okay. Can you go beneath the headlines and give us a snapshot of what you're seeing right now?
Yeah, no, I appreciate that. And, it was a really strong quarter, I think, across the board. As you look at, the revenue side, net interest income, really performed, as we expected and was quite good. Really driven by the increase in rates we've seen over the last year. You saw good fee momentum, particularly in the trading businesses and other areas. And on the expense side, we continue to just execute on our plan to drive more efficiency across. And underneath that, you see really good activity on both the consumer side and the commercial side still. You are starting to see, a slight gradual increase in credit charge-offs, but that's to be expected given, the environment that we've seen over the last few quarters.
Just a little grind lower.
Good activity, good spending. People came into this environment strong, and you're seeing that play through, I think, across the board.
Need to make one more phone call.
Let's just dive into those rising credit costs on the loan loss reserve bills, especially on the consumer, autos and cards. What can you tell us about the trends there that you're seeing that might have you a bit worried?
Yeah, the increases across the consumer portfolios are actually quite modest when you dig into the detail. And in the card space, you're seeing just a very gradual weakening, which is what you've seen now over the last couple of quarters. And on the auto side, you actually saw it get better than it was in charge-offs versus the fourth quarter. And so you'll see that move around a little bit, but it's been still very, very gradual given the amount of liquidity people came into the environment that we're in with, and also the behavior that we've been seeing over the last number of months. And so I think it's still quite good, and the consumer side was quite modest.
What about in the commercial real estate book? How exposed and how concerned are you about the trends there?
Yeah, look, there too, the performance to date has actually been quite good. You're not seeing systematic stress translate into loss content in the portfolio, even in the office space yet. That's, the story is going to take, play out over an extended.
Watch, shorts are starting to cover. I'm seeing some buy. I'm picking up here on the SPY. Shorts covering. VWAP is still overhead, so we're still in a bearish fade. Still in sell signals, but I'm starting to see some volume coming in. Probably just shorts covering.
Hey, Mike, some of the commentary we got from other banks this morning was that, we got sort of a bumper crop in deposits. That's moderated, but we don't expect necessarily those deposits to be sticky. I wonder if that's something you would concur with.
Well, I think anytime you get a big increase in deposits in a short amount of time, you have to be really cautious in how you sort of think about those. And it's likely some of that will revert, across the board. But I think it'll just take some time to play out. So I think that's certainly a view that I would concur with at this point, until you get a little more history and a little more time to go by.
Is there anything more you can tell us, Mike, about what you've seen on deposits after March 9th? I thought overall they were down about 2% for the quarter, but what do those flows look like right now?
Yeah, look, we definitely saw, as we said on our call, we saw a bit of an increase right in the middle of the first few days of when we went through, that week. But that has abated, and those inflows have really stopped. And so now you're back to just BAU activity, in any given day, and payroll may be coming in.
So just a little bit of short covering. We're still fading.
Normal ebbs and flows on a daily basis across the different.
We got a couple of IWM blocks, 5 total, 176.50. Nothing really huge today. SPY 450,000. That's the largest block. The lack of interest right now on this fade just Not that interesting.
Demand for loans. What have you seen since the episode, the failure of SVB?
Yeah, not a lot, to be honest. And I think if you zoom out just a little further, if you look at what happened last year, in the first and second quarters, really where you saw that strong loan growth across the board, and not just us, but across the industry. And since then, it's been pretty moderate and has moderated quite a bit. And overall loans are roughly flat, plus or minus a little bit over the last, three quarters. And so you really saw that moderate quite a bit. And since, over the last few weeks, that really hasn't changed in any significant way. You're starting to see a little bit more activity in some of our middle market, customers, particularly as inventory levels grow from really historic lows that we saw over the last couple of years. But for the most part, I'd say the events over the last month or so really haven't changed things in a significant way.
I know expense control and efficiency are some big themes this morning. I think it was Jim this morning who said Charlie Sharp is back. I do wonder, you think about a year ago where the street was really watching how far expenses were going to go across the space. There was this competition with fintech, obviously competition for labor. Would you say we've done a 180 on that? Thematically in the industry?
Well, I think, we've been executing for the last couple of years now on a program that we laid out back at the end of
60 minutes by, still hanging on to this trend, the 21 EMA on the 60-minute. We're going to be bullish above that, bearish below. Seeing more volume coming in here, watching volume.
Now, when you sort of look at some of the trends there, you definitely have seen some of the pressures that we saw a year or so ago from wage inflation moderate quite a bit. So you're not seeing that as acutely as we saw, 12 or 18 months ago, and that's for sure. You've also saw, attrition slow and other factors that really sort of help there. So some of that may have moderated a little bit, but for us, we've been just executing on the plan that we laid out a couple of years ago. So I think you'll see us continue to do that.
Well, part of the reason I think that it was a sigh of relief for people to see the net interest income reiterated, right, at 10% growth, Mike. But I guess when you compare it to JP Morgan, it doesn't look as good because they had that higher expectation now of net interest income. I'm curious how confident you are in the guidance there and relative to some of the other banks, how it looks.
Yeah, you'll have to ask them about theirs, but I'm very confident in what we laid out there. And I think as we sort of look at our expectations for the year, there's a lot of volatility that's still embedded in the environment, whether it's going to be the mix of deposits, the level of deposits, pricing. And so underneath our guidance really embeds the assumption that it's still going to be pretty competitive out there. And so we're hopeful that in the second half of the year, it'll be better than we think. But, we try to put out guidance that, we can be comfortable with in a whole range of different scenarios. And if things play out a little bit better than what we're modeling, that'll be great. And we're hopeful that'll happen. And we'll see that benefit as we go into the second half of the year. And, as long as the economy stays strong and people and our customers are doing well, then I think that'll ultimately benefit us and help on the net interest income side.
Hey, finally, Mike, the street has been watching the banks last couple of quarters. It's been about comp and bonuses coming down. It's been about reductions in force. I wonder if you think that chapter is ebbing as well. You talk about attrition slowing down.
Yeah, look, we're just systematically investing across all of our businesses while we are driving efficiency. And so you really have to sort of look at the complete picture, and so while you may see, headcount and expenses coming down in some areas, there's also investments happening in other areas. And with that, you need to be competitive on comp. And that may ebb and flow based on market activity or revenues in any given year. But I would say, it's still going to be pretty competitive as you look forward to make sure you got the right people in the right places and that you continue to invest over a very long period of time. But you can do both in terms of driving efficiency and overall headcount down while you make the investments you want to make over a very long period of time to build really strong businesses. And so we're trying to do both of those.
I appreciate all the commentary on the quarter and what you're seeing. Thanks for the time. Mike Santomassimo,
Yeah,
the CFO of Wells
for having
Fargo. Stephanie Link, shareholder, also likes the reinstatement of the buyback, of course.
And we'll get Goldman and Morgan Stanley next week. Let's get to the half.
Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Walker, front and center this hour. The kickoff to earnings season. The banks deliver some upside surprises. Between that and a flurry of economic data, there is much today for our investment committee to debate this hour. Joining us on this Friday, Josh Brown, Stephanie Link, Jason Snipe, and Bill Baruch. Let's check the markets, see what we're doing. Right now, we are in the red across the board. Now, a lot of the Dow's lost. You see it's down about 200. That's due to Boeing, United Health, and we are going to get into all of that. Josh, I feel like you got a lot of cross currents, though, today. You got the retail sales miss. You put that against J.P. Morgan and what some of the banks have delivered. You have a new background behind you. Nice flowers on this Friday. So that's, just add that to the cross currents and things we need to discuss. But what do you make of what you're dealing with today? Very nice. Very, very nice.
My guy, it's not very complex. What would you ask yourself? What would you prefer? A blowout retail sales number? Is that what we want to have happen? So for me, I'm kind of looking at glass half empty as actually glass half full. And I think most of the market seems to be in that mode. We all understand that we're facing down an earnings recession. We all understand that the economic data is cooling. We all understand that that's by design. And so this is really going to be a question in my mind for this year of which companies and which sectors can better withstand what we all see coming and which can't. And if you actually decompose the stock market returns by factor this year, you find that it's high quality, companies with secular growth that are withstanding it the best. And I don't really see why that would change as we go through what we're going to go through in the next 3 quarters of this year. So that's where we are right now. The winners are separating themselves from the losers, and the winners have a lot of commonalities that are very easy to see. You don't need to be a quant or to look at thousands of stocks. Just look at your quotes. Look at your stocks, do an eye test, and you can see which names are holding up the best on days like today and which names are leading on green days like yesterday.
You should have said hello, friends, when I came to you, because it looks like you are at Augusta. The nice azaleas behind you and everything. Amen Corner is where we go when we go to Josh. But Stephanie Link, retail sales worse than expected. Still, not horrible. Sentiment higher than expected. 1-year inflation expectations, though, high. And then you have Larry Fink a couple hours ago sitting right here on this set. Inflation is going to be stickier for longer. What cost from all of the things that you hear about from the Lebenthals of the
Still
world?
looks like it could be a bear flag.
At what cost? So how are we assessing all this and what it means now for everything, the Fed and the market?
The Fed is not done. After the data this week from the CPI at 5%, and that, by the way, included a double-digit decline in energy prices, which we now know our energy prices are back to last November's levels. So the number next month likely goes higher, I think, right? So that is a problem. Core CPI ex shelter also was stronger than expected. Retail sales, I take exception to it being really a horrible number. Not that you said it was, but some people
I said it wasn't. I said it wasn't horrible.
There are some people that are saying
it's
it's terrible. I think you have to look at retail sales on a 3-month average basis or a 6-month, a little bit longer, because it's so lumpy. And a 3-month average, the last 3 months, retail sales rose 1.8%. The consumer's hanging in there for sure. The Atlanta Fed GDP now at 2.2%, that was jacked up higher.
Yeah.
And so the point being is inflation is still here. It is still sticky, right? We all know that. We've been talking about it. And so the Fed probably has to continue to go. And I think that's why the markets are down, because people are a little uneasy that they're going to continue to raise in the face of a lot of other data that is slowing. We've talked about it, very mixed, right? So I think that's what's happening today. But I think what's really important, Scott, is we're in the 8th inning.
I'm here just sitting here watching the grind with you. Nothing to do.
That doesn't mean, even if they get to 5,
go on to way extra innings.
it's not going into extra innings,
Well,
but it'll stay. It'll stay. That's the thing. My point is, maybe we don't jack them up higher, much more high. Like maybe it's 2 more times, 25 each. But we're almost done, and then we're going to see what 5% or 5.25% Fed funds does to the economy.
We're already getting a whiff, right? I mean,
we
Larry
are.
Fink in the same breath says, I'm not expecting a big recession in the U.S. Not even sure we're going to have one in 23, maybe early 24. But when you have inflation expectations, you've got the consumer still hanging in. J.P. Morgan, and we'll talk about the banks in a moment. Nothing that J.P. Morgan today said with their earnings makes you think that the economy is going off of a cliff. And it's why you have Michael Feroli of J.P. Morgan saying doors still open for a June move. Jason Snipe, Waller, Fed governor, recent data show the Fed hasn't, quote, made much progress on inflation goal. Rates need to rise higher, still much too high. So my job is not done. That's what we're left with.
All right, new low on the SPY, new low.
I'll say this, Scott. I mean, there's a couple of things for me. Obviously, core, and Steph just alluded to this, core is sticky. It's still up 5.6% year over year. The headline 5% year over year, but the piece that Steph mentioned that I think is important is the energy piece, right? So it was up double digits, but we had a surprise cut with OPEC, and obviously oil prices are above 80 now. So that print will look very different next month. And I think these are the types of numbers that the Fed is really focused on. So I do believe they'll move another 25 basis points in May. We'll see what goes on thereafter. We also are expecting.
So that little bit of volume there just looked like shorts covering.
There potentially some more pullback in earnings going forward. So I think that's where the Fed is in. They're in this interesting spot where higher for longer. How long? Right, and the market's starting to look to price in 200 basis points of cuts. We'll see if that happens.
One day, Bill, obviously doesn't a earnings season make, but what if we find ourselves in the midst of, as we get really into the heart of it, starting, next week, once again saying, where's that earnings disaster?
Yeah.
Where's the earnings disaster that people have been calling for the last 12 months? Yeah. Because at each of those reporting periods, it didn't really materialize. Now, it still might. But I wonder if we're going to be sitting here saying that again and what that's going to mean. Hang on. Let's get Bill in and what that means for the idea that some are still putting forth of a soft landing.
Yeah, thanks, Judge. And I think what I've said in the past, where these earnings, I don't expect them to come down as what everybody's calling for. I remain fairly optimistic. And the banks today, they seem fairly optimistic. I mean, look at loan loss provisions. Even the credit utilization from J.P. Morgan was down. And everything was actually acting pretty well through the open. What really shocked markets today was that Michigan consumer inflation expectations for 1 year, 4.6 versus 3.7 they were expecting. That's definitely a shock. And that's a reminder that although some of the data within inflation that we're seeing in CPI has come down, what people are really paying is still remaining elevated. Airfares have continued to elevate, and people are booking those summer trips, and you're seeing those numbers higher. Now, I remain a little more optimistic about the CPI number itself, despite the jump in energy. Even in Cleveland Fed, who's right now modeling after this inflation crude jump, is still at 50 basis points or so, and 5.2 on the year over year. So we're going to start to seeing higher base comparisons too. Go back into March of last year when Russia invaded Ukraine. That month-over-month jump was 1.2%, the highest.
Not much going on here. We just continue to fade, grind lower. 410 is the next level we're looking at, potentially getting down to.
Inflation's going to arbitrarily come down, but the Fed, like you pointed to Waller's comments, the Fed isn't backing down. They know if they back off at all, the market's reaction function is going to take it away from them. So it's a very fickle spot right now.
And the sentiment numbers that you're alluding to, I mean, they jumped up high in terms of inflation expectations. Yeah. And that is directly because gasoline is now higher and rents 100%. Continue to be really high. They're not coming down
you're
like
booking
people
your summer
expecting.
trip, to Bill's point. You're like, where's the rollover?
Right.
In inflation that everybody keeps talking about. Josh, you wanted to say what?
The rollover in inflation that everyone keeps talking about is that contrast the PPI number this week from March 2023 with March 2022 when PPI rose by 11.7%. Like that's where the inflation rollover is. And to say that we haven't made progress on inflation,
no, we obviously have.
Clearly, all right. So let's put a pin in that. I want to address the. I want to address the where's the earnings collapse? Nobody's calling for an earnings collapse. Like look at Look at the top 20 Wall Street strategists, all the polls. Like even the most bearish, and by the way, on balance, they were all bearish. But even the most bearish, nobody's calling for an earnings collapse. And there's a very good reason as to why. Inflation actually benefits revenue and therefore earnings. Like companies are charging higher prices, therefore
hold on,
you
I'm going to
don't
stop
get
you
a
for 1
collapse.
second. I'm going to stop you for 1 second because there are a number of people, as a matter of fact, who are calling for another 10% decline in earnings. To if you have a whiff of a soft recession that you
Consensus
get
is
down
negative
to
7%.
200 or 195, you're still at like 220. So there are plenty of people who still expect earnings to come down significantly enough from here. Well, who cares what consensus is?
Okay.
Consensus is often wrong.
Okay. Well, when you say who cares what consensus is, well, when you say there are plenty of people, consensus is taking into account the lowest estimates, the highest, the median, everyone in between. And that's like where we get, quote unquote, the market's expectation. So that's why I'm saying what consensus is. And consensus is not calling for anything drastically negative on the earnings front. In fact, if you actually look at why there was so much bearishness on Wall Street going into this year, it was more about valuations still need to come down further than it was about any kind of collapse in earnings. So, and here's the second part of that. We're saying, like, where is it? We had 5 companies report, and 3 of them are banks. And no other sector is going to benefit from net interest margin the way that banks did in the first quarter.
Of course, which is why I said one day doesn't an earnings season make. It's exactly why I said.
And you're right.
And it remains to be seen. However, there have been predictions each quarter that, oh my God, earnings are going to be terrible. It's just going to be bad.
They're not good.
And they haven't. But they're not. They're not horrible though. They haven't been horrible. They haven't been horrible.
I agree.
They haven't been horrible. And JP Morgan, by the way, which I want to come to you on anyway, shows you that. Now, amid dire predictions about what the banks were going to say, JP Morgan has record revenue. The stock is up still more than 7%. Its biggest earnings gap higher, according to Bespoke, in 20 years. And it's at 7.5%. Josh, take on that.
Because JP Morgan is Michael Jordan. And again, don't take what they managed to report this morning and try to extrapolate that out any further than JP Morgan. Jamie Dimon is a professional. He is managing, this is professionally managed business. Not only is he managing the employees of the company and the customers, he's managing you, he's managing Wall Street, the media, he's managing Washington, D.C. This is how it's done. And, for years, I'm in this stock and everyone's like, oh, well, Citigroup's cheaper. Well, have fun with Citigroup. There's a reason why you pay a slight premium to be in JP Morgan. And by the way, today is the biggest gap up in reaction to earnings for this stock in more than 20 years.
Really?
So they tamped down
expectations.
expectations.
There must be an echo in here. I'm glad you were listening to the way that I sent it to you by saying exactly that. Thank you.
Listen, I'm just reiterating the very good point that you made. But I think the big picture here is that most companies, even in the banking sector, with net interest margin giving them this huge benefit, are not able to say something like this, which is that the guidance for the full year, net interest income now expected at $81 billion, and that is $7 billion better than the previous forecast of $74 billion. That's coming from the CFO. There aren't a lot of companies that are going to be guiding up in this environment, and it's because JP Morgan is who they are. They are him, but also the very peculiar circumstances of a situation where rates rose. They didn't blow up with long-term interest rate bets. They managed the balance sheet correctly, and if there is in fact any kind of cutting of overnight rates at any point, even if it's not until the fourth quarter of this year, that is where you get that boost in guidance from. So this is a very specific situation. My hat is off to the company, and I don't think that you'll see a lot of this in this quarter.
Steph, you could be in Citi and be happy today.
SPY continues to fade.
Kramer thought it was a good quarter. Walls, the reaction in the stock is quite interesting. You bought more this morning?
I did. Well, look, just on JP Morgan, it's clear they're taking share, right?
I'm looking to buy some EEM, by the way, some emerging markets. I don't know if I'll do it today, but I'm looking to buy some emerging markets.
They did reiterate mid-70 billion in net interest income medium term. So this is a short-term thing. Very happy for JP Morgan shareholders. That's great. But I don't think this is going to continue at this kind of a clip. So I'd be careful there in terms of chasing. Wells, I think the reaction is kind of silly to me because they reiterated net interest income. So by comparison, it doesn't look as good as JP, but I think they're being very conservative, right? And I think having 17% total revenue growth, 45% net interest income growth, costs, which has been a big sticking point with this company. They reiterated 50.2 billion for the full year. That's flat year over year. It's come a long, long way. All their capital levels are really good. So yeah, at 0.9 times book versus JP Morgan at 1.5 times book, I think there's a better value. And I also like the fact that they now reinstated the buyback and they bought 4 billion and they're going to be buying a heck of a lot more throughout the year. So I think that's your better value here. You know, but obviously in full disclosure, I've owned this for a while, but I just think that the valuation here is very compelling.
Okay. What about PNC? Jace, another one that, you know, certainly didn't wow people in terms of what the stock's doing. Last I checked, it was down. Let's look at it again. You own it. How do you size this up there? It's down about 2%.
Yeah. So for me, as it relates to PNC, I think, you know, the main driver for me is they have a very diversified deposit base. So, you know, a mix between retail and commercial business. The other thing is there's been all this talk about CRE and a lot of concerns that they only have 2.7% exposure there.
To commercial real estate.
Commercial real estate, which I think is important to note. And their deposits have grown, you know, and I consider them a super regional. Obviously, all the hype around the banking crisis and what happened about a month ago, they're a super regional. So they're taking, to Steph's point, I mean, JP Morgan was a class of the banking reports, but I do believe PNC is taking some business from some of the smaller regionals, and that's why I like
all the big guys are.
You got it.
What do we take then looking into next week for Bill Baruch? You sold some Bank of America, right?
Yep.
A couple weeks back.
Yep.
You own Morgan Stanley.
Yep.
I would assume that if you own these stocks that are reporting next week, you must be feeling pretty good by virtue of what you got today from the big guys.
Yeah. I mean, it was a great report, I think, from JP Morgan, and I think you'll get some follow with Bank of America. I didn't time my entry into Bank of America very well, so I cut it into the quarter. Let's see how these earnings come out. I'm definitely encouraged. We really like Morgan Stanley, and we moved away from regional banks at the end of last year, worried about lending and worried about the mortgage space. Morgan Stanley doesn't have to worry about that. They're a juggernaut wealth management business. They're not exposed to the lending business, you know, and their any loans are, you know, very high net worth clientele. So I want to see how we get through this. I see myself potentially getting back into a JP Morgan or Bank of America to get that exposure and stay away from the regionals for the time being.
The investment banking business at JP Morgan fell 19%. That was way better than expected. Some people thought it was going to be down 35 to 50%. So that bodes really well for both Goldman Sachs and Morgan Stanley.
Yeah. How about United Health? Because we have ownership there too. And we've talked about it almost every day this week leading up to today, saying, hey, don't forget about this other big company that is reporting on Friday along with the banks. And it is a weight today and a sizable one on the Dow. Dow's down 238, 239 as we speak. Jason, you own UNH.
Yes. So for me, as it relates to UNH, so beat on the EPS, beat on revenue. They're a very consistent player in the space. I mean, there's 21 of the last 21 quarters they beat on EPS. And for me, I also think they're, as it relates to healthcare services, they're pristine. They're the cream of the crop on that end. I think this has to do with the guide. You know, the guide was a little bit light going forward, and I think that's part of a little bit of the pushback. And also, they've had a nice run over the last couple of weeks. I mean, they're the largest component of the XLB. And that's part of what's happening.
SPY just continues fading. There's just no interest, or there's a lack of interest by institutions. We got a few blocks, but normally on a bullish day, we would see the amount of blocks we have already, about twice that this time of day. So VIX is pushing a bit higher. At extreme lows, wouldn't be surprised to see VIX pop.
Has been a great performer for the last 3 years. Yeah. I sold them. I bought GE Healthcare, which is up 40% this year because I like it better. So it's much bigger. But this is definitely on my radar screen. It's just run from 460 to 510. And all this company does is beat and raise. And so they didn't raise as much as people thought. I think that's absolutely silly. Optum is their fastest growing unit. It's 57% of total revenues, and it grew 25% year over year. And the medical loss ratio, I think everybody's freaked out about that. It was up 19 basis points. People thought it was going to be up much more than that. So I actually thought it was a very good quarter. If it pulls back, definitely on my radar.
Okay, J&J you're looking at too?
Yeah, absolutely. I mean, I think they get this talc settlement behind them. We can now focus on what they do really well, which is pharmaceuticals and medical tech, and they're going to spin out the consumer business. We can focus on fundamentals at that point. We got to get through May, and I think it's a good chance that they do settle, and that would be great news.
Okay. We will take a quick break. When we come back, we have our chart of the day. The other big drag on the Dow today, I mentioned Boeing. Stephanie Link owns it. That, Josh Brown just bogeyed 11. He goes to the par 5 12th next.
Just a slow grind lower today. 410 was the previous level that we moved above early in the week. Then we ran into 412 for a couple of days, popped above that yesterday. We had the call wall shift from 420 down to 412. Now we're just below 412 with 410 in sight. Not doing anything. Today's kind of a slow day. Fridays I don't do much anything anyway. I do like that we dipped in the morning, so if there is any buying in the evening session, I'll be looking for institutions to give us some direction, and we can go from there. Next week, we got OPEX on Friday, so that's something to look forward to, but not a whole lot of news between now and then. I am interested in buying some JP Morgan on any dip, any weakness. I don't see any weakness at present. And just continues to hang out right near VWAP. So JP Morgan is up 7%, $9 and change. We decided to take some profits off of the 140 call this morning for a nice fat profit. I still have half left. Those will expire in June. But because we're up nearly $10 on the day, I'm not going to chase or try any new entries right now. I want to wait and see what happens on Monday, Tuesday, if we flag, consolidate, or if we just continue to move higher. Either way, I'm more bullish. I'm also watching for an opportunity on Boeing on this little snafu that they had. Deutsche Bank, I have some January 10 calls. Deutsche Bank, I'd like to buy some Deutsche Bank. I'd like to buy some bank exposure. I'll keep it to XLF for now.
There it is. It's Boeing down 6% after warning of reduced 737 MAX deliveries due to a parts issue. Stephanie Link owns this stock, which was off to such a nice start this year.
Yes, it was. And if you put up a longer-term chart, you would see how pretty it looks. And the fact is, the stock is up 73% from the September lows because they've been able to execute and deliver more planes and that sort of thing. I do not think this news changes the story. I do think it's going to change the free cash flow, unfortunately, because the 737 is 60% of free cash flow. It's not 30% of total revenue. So it's going to hurt a little bit, but it's a near-term issue. This is not a safety issue. This is not a grounding of planes issue. This is a supplier issue, and that's unfortunate, as I mentioned, but I think this is way overdone today, and I think people are just taking gains because it's had such a nice run and just going.
Does it ground, pardon the pun, does it ground the stock for a while?
No, I don't think so. I mean, look, they had problems with the 787 earlier this year, and they fixed it within 15 days. So they could fix it. I'm not saying that they will, because this is going to deal with something like 100 planes or so, maybe even more. the fact that the company hasn't quantified it for us is, I think, the real reason why the stock is down so much. But look, I think this is going to set up for an opportunity. It's a duopoly with Airbus, and they have 4,000 planes in backlog. So we saw all the orders that they got this year to date. They're just crushing it on that front. So I think you got to stay patient. It's a volatile stock, but I do think this sets up for a buying opportunity. Once we get some clarification around how many planes this is going to be and then we can calculate with the free cash flow.
So, Josh, you have the ITA in which Boeing is the second largest holding within it.
Yeah. It's unfortunate, and it's like a little bit off thematically. It's a little bit off of the reason why I'm in ITA. But the reality is it's less than a 2% drawdown with the biggest holding acting like this. And I actually agree with what Stephanie had to say. I don't think what was announced today is really going to be a major issue or have a big impact. So if I weren't already invested here, I would probably use this dip to buy or add to it.
What you guys?
I don't own it. I for this reason, sort of what headlines, and I missed the rally. And so I've been kind of watching for an opportunity. I would be a buyer at 180 if it ever gets back down there. It's about 10% lower than here. I'm just kind of, that's the spot. Jason?
Yeah, for me, I think I agree with Bill here. I think the headline risk for me is just a challenge. So,
I mean, but you could say that from here to eternity.
You're right.
For Boeing. I mean,
yeah.
Is that a great reason not to own a stock like that?
It's not.
Because the headline risk?
No, and I think as it relates, and Josh mentioned this earlier, I think as on the ITA as a sector, I think some of the more defense names, the Raytheons, Lockheed Martin, those are the names I'd be more interested in this space overall.
I got you. All right, coming up, tech taking a bit of a breather today. Bill trimming one big name in that space as well. We have the trade, we have the debate. We do it next.
All right, we just continue to grind lower, exhausting the bulls. Anybody that's holding on. Most of the sectors are fading. It's been a pretty decent week going into yesterday's close, but for now, we're just giving back a lot of yesterday's gains. And off 0.5% on the day. Still more downside potentially. 410 is the target. Another 10 handles on the futures potentially.
Bertha Coons. Here's our CNBC News update at this hour. France's Constitutional Council approved President Macron's controversial pension reform that would raise the legal retirement age from 62 to 64. Macron will likely sign the bill into law within 48 hours. French protesters have been demonstrating against the divisive policy for over a month now. The Justice Department charging 28 Mexican drug cartel leaders and members, including the son of former drug lord Joaquin El Chapo Guzman. This is part of the DEA's larger push to target the Sinaloa and Jalisco new generation cartels. The White House says it's also increasing cooperation with Mexico to combat the flow of fentanyl coming into the U.S. And President Biden wrapping up his trip to Ireland with a visit to the home of his ancestors. Biden is set to speak at the cathedral where his great-great-grandfather was baptized back in 1832. How exciting is that? Back to you, sir.
All right, Bertha, thank you. That's Bertha Coons. NASDAQ near the lows of the day. Big debate, Bill Baruch, over what to do with some of these stocks that have had an absolutely amazing run year to date. I think NVIDIA's up like 80%, right? You trimmed it.
Yeah. And you know what? You want to trim on strength. I want to be overweight things that are outperforming. And first, NVIDIA became about more than a 7% position in our equity bucket. And so it just to trim makes sense. But it also, relative to the price of the NASDAQ, had broken out to record highs, and it sort of started surrendering that. The other thing I'm looking at is semiconductors broadly have sort of been consolidating, and they're not outperforming the NASDAQ anymore. Goldman Sachs research has said that hedge funds are short right now, and they're underexposed to the market. That keeps me excited. That's why I'm still holding overweight tech. And they've also said that over the last 5 years, 92% of the time, the hedge funds have held more semiconductors than they do now. That tells me that they're sort of defending the position right now. But if we start moving higher after earnings season, I see a capitulation and a massive short covering. So that's why I like it here, but I'm also being very cautious and starting to trim it.
Josh, what do we do with tech? I know you own NVIDIA, and I'm not going to fault anybody. I know what you would say for taking some profits off a stock that's up 80% in a few months. I totally get it. But now, as you said at the top, they're just the beginning of earnings season. We're going to really find out what the story is as, these companies continue to cut costs. What do we think about tech here after the run we've had?
So I think Bill is doing the right thing. If you're in NVIDIA as a trade or like a tactical position, this stock has gotten very expensive. It is definitely far outrun any real change in fundamentals or even the outlook for this year. A lot of the excitement that's baked into that stock is like about the next 5 years, the next 10 years. So there's absolutely nothing wrong with having a huge outperformer and just making sure it doesn't get too big. So that makes sense to me. Broadly speaking, though, on tech, they've had like every tailwind imaginable at their backs. Number one, they're high quality companies. Remember, we talked about that's what's in favor right now. Number two, tons of cash. They're not cyclicals. They don't need to go to the bank and borrow more money. Number three, the NASDAQ had a 35% correction last year. Massive bear market. It's unlikely that they need to do that twice, quite frankly, even if we are going to have an earnings recession, et cetera. So like you've had a lot of these benefits. So the real question is like, how much of that have you already gotten as a shareholder this year? And unfortunately, you might have gotten most of that benefit already. So look, a VIX with a 17 handle is not where so that we're in a high VIX regime, but we're at the low end of that high VIX regime. 17, 18 is as low as it gets given this current regime. So this is not where you get all bulled up on tech. So I think tactically, it's probably a smarter decision to be looking for what you want to trim versus what you want to like initiate new positions in.
Yeah, I mean, it is unbelievable. Look at the VIX 17.7. Jason Snipe, Apple, Amazon, Alphabet, Microsoft, Netflix, and NVIDIA. You trimming anything here?
So I haven't yet, and I think what Bill made, the decision he made is obviously a prudent decision. I mean, stock up 80% within 4 months, not even 4 full months of the year is something that we need to make happen.
Are you not being prudent? I mean, what do you mean?
So
are you
it is
thinking about it yourself?
So it's something we trimmed it last summer, so we're looking to likely trim again this quarter. But for me, as it relates to broadly tech, and Josh just alluded to this earlier, I mean, listen, the NAS is up almost 16% year to date. The NASDAQ 100 is up almost 20% in the first quarter. These are great annual returns, so I think as we look at the macro environment going forward, is it prudent to invest in new positions in tech? I don't think so, not at this stage, given the macro backdrop and given where the Fed is. So that's really our position.
All right, we'll take a quick break. Stephanie has another new move in her portfolio, that we will talk about next.
Trade my trade. Send us your latest stock move, and the investment committee will debate it and grade it. Email us at askhalftime@cnbc.com or tweet us, #GradeMyTrade.
Nice flow right back down to 410. Continues to drift lower. We're almost there now. While we're waiting, let's check out that Royal Caribbean. Looking for their break above these pivots. Royal Caribbean needs to get above that 21 day, but there's some flow being noted. Pioneer Natural, 230 calls are very active.
For your free consultation.
Stephanie Lee, another new move. FCX. Report McMoran. Why'd you buy it?
Yeah, so I think that the supply demand for copper actually is pretty favorable, and you pick it up onshore and talk about that.
All right, we'll continue to drop off. SPY continues to drop off.
Actually being a little bit better than expected, and Freeport is very levered to it, right? For every 10% moving copper, that's 15% to EBITDA. I think these guys are very well positioned in terms of their balance sheet. They're lowering their debt. They want their debt to get to 0.5 times net debt to EBITDA by the end of this year. And I just think that at 8 times EBITDA right now, the stock is pretty attractive. I bought this on Tuesday, and it's up 7% in a couple of days, so it's very volatile. I don't expect the quarter to be great on production because they've had some weather issues. So I started with a small position, and then into earnings, if it is weak, it's very volatile, I'll probably add to it.
I just wonder why take the risk in a name like this. Fed, these are, from your words alone. I mean, Fed's still hiking.
Yep.
Economy's definitely weakening. It's weakening.
It is weakening.
You look at me like that's not true.
No, I'm just no, but the U.S. is, but China reopening is not weakening.
Right, but
actually,
I mean,
that's a big recovery story for them.
Yeah, but I mean, you still say it's so levered to the price of copper.
And it's very hard to get copper, right? So the supply demand is actually pretty much in their favor.
And
and the stock's up 12% year to date.
Well, when I bought it, it was up 7% year to date. Even so, at 8 times EBITDA, and
So
I feel very good about the
50% in 6
EBITDA.
months.
Even though, okay, so fine, but I think at 8 times EBITDA, then the stock is very attractive, and I think that the supply, on the supply side, it's really hard to get copper. It's really hard to mine it, right? And the demand is still there for now. And even though the U.S. economy is weakening, we have this whole onshoring thing that actually is in their favor. You know, when you build a home and when you build things, you need copper, right? So to me, I think, again, I don't think the quarter is going to be great because of the production issues with regards to weather and that sort of thing, but I like the story, I like the concept, and I think I've been very consistent. I am more balanced this year. So for every P&G and Keurig Dr. Pepper that I'm buying, I'm offsetting that with an Ingersoll Rand and also with a Freeport McMoran. So to me, I'm just a little bit more balanced, and that's where I feel comfortable being.
All right. Josh Brown, you own Newmont. Speaking of mining companies.
Yeah. Yeah, this is because I think gold is on the verge of a fairly substantial breakout. I could be wrong on that. It is a commodity, and it's anyone's guess. But it just seems as though the accumulation phase is like about to reach a fever pitch. I don't buy commodities. I don't trade futures. So my proxy for that is to buy the highest quality, largest, most liquid name in the space. That's Newmont, getting a nice 3 and change % dividend yield while I wait, and I think it's a well managed business. So that's really why I'm in that name.
Bill, Josh may not trade futures, but I do. I run a commodity fund, I run a metals fund, and a global opportunities fund as well. I'm very bullish on copper, and I don't think we've seen the impact of the China reopening yet on copper. They consume 50% of the world's copper. China new loans data earlier this week was the second best in history behind January. The reopening story is taking place. The public is now getting back into the real world after 3 years of lockdown. Southern Copper Corp is also on my buy list right now. They increased copper production 50% since 2021 and are expected to increase 70% over the next 8 years. So I think it's a really, really great story, and I think you got to watch copper, keep a pulse on it. I don't think the economy is as bad as people are calling it for, and JP Morgan confirmed that today.
Look, I mean, Larry Fink, the people who are saying, I mean, it doesn't have to be so binary. Yeah. It's not either, no recession or recession. You can still have a slower economy and not go into a recession, right? I mean, Larry Fink sat right here today and said, yeah, inflation is going to be sticky. He thinks the Fed's going to go more. He's still not looking for a recession this year either.
If we get inflation data like we saw in Michigan expectations today, because Powell has said that expectations of inflation are a self-fulfilling prophecy. Think about it for the most simple fact. If you know gasoline's going to be higher next week, you're going to go fill your tank up. So it's going to be a tailwind inflation. That number concerned me today, and I spent the hour leading up to the show managing risk across my commodity portfolio.
Larry Fink also talked about $1 trillion in fiscal programs getting into the economy that have not yet gotten into the economy, right. And that's where the momentum has been, right? All this stimulus. We have $4 trillion more stimulus pre-pandemic in the economy as it stands. Now I know it's kind of waning off, but you have other things that are in its place, and so yeah, maybe you could have a soft landing. I don't know. We don't know. We know we're slowing. We don't know what it means, but in the meantime, I like the copper story, and it's mainly because of the global side of the equation and onshoring here.
All right, coming up, earnings season getting really into full swing next week. Your playbook with the top stocks you need to watch. We'll trade some of them ahead of those numbers, and we'll do it next.
We continue to just grind lower. Not much going on here today. Most stocks are fading. So if you're on the bearish side, or you're looking at stocks showing relative strength, Josh just mentioned Newmont Mining. That's starting to catch a bid off the lows of the day. Newmont pulled back. Josh mentioned it just now. I like the setup as well. Off the 21 day. Newmont Mining coming off the lows. I like the pullback potential to get back to the highs, 51. We're right at the 21 day on the daily time frame. Finding some buyers there. We could come down to the 50 day. Just looking for a pop. VIX is starting to move higher. VIX.
big week of earnings next week. 10% of the S&P 500, along with 6 Dow components reporting. There is your wall. We're going to go through. Look at those big names, Stephanie Link, IBM, Lam Research, SLB. You own all 3.
Yes.
Where are your expectations for, let's just say, IBM, which is down near 10% year to date?
Yes, after being one of the best tech stocks last year.
It may have been the best.
Possibly, but it was good. It's a value name, right? And value has actually underperformed growth year to date.
All right, Stephanie talking IBM.
So clearly, they have enterprise exposure, and that could be weak. But they also have Red Hat, and I think Red Hat continues to see strong momentum. So mid-teens on Red Hat is what I think the bogey is. But overall, I think they're going to continue to execute well. Kind of a boring name, but really cheap with a good yield.
What about Lam Research?
So Lam worries me a little bit because you're starting to hear wafer fab equipment.
SPY still fading. Got another 40 cents to get down to that 410 level.
I think the expectations are really low. I trimmed a little bit a couple of weeks ago. I think we talked about it on overtime at the time. But I still like it because I do think we are somewhere in the bottoming process of this inventory correction. We just got to get through kind of the next quarter or two. So I have it. I like it. It's cheap. It's a little bit smaller of a position for me.
Jason Snipe, Netflix on Tuesday after the bell. That really kicks off the first, obviously, of the FANG reports.
Yeah, for me, it's really looking at this ad tier. It looks like there are about 1 million users now. Daily active users are up 10% in the month of March. So the real focus for me is password sharing. Let's see what happens there. That's going to be a real focus for me going forward. You know, and the ad tier just was released late last year. Let's see how the follow-through is.
Bill Baruch, AT&T, reports next week as well. That's Thursday morning.
Yeah, that's a stock we actually really like as a ballast. I mean, obviously it takes more risks in other parts of the portfolio. Their 5G spending is moderating. They've been an unloved stock for quite a bit, and I think as they start to, I think they'll beat with earnings over this year, and I think you'll start to see a lot of money flow into a stock like AT&T, especially with the yield that's still hanging up at 5.6%. I believe it is, or above 5%.
What about SLB, Stephanie Link? You and Bill both have it. I want Steph's take on it first. The former Schlumberger.
I like it a lot. I want to make it even bigger.
Didn't you buy more recently?
Yes,
you did, right?
I just keep on buying it on these sloppy days because it has a little bit of beta to it.
Crude 82.5.
Yeah, I mean, look, they're gonna. I think the quarter's gonna be very good, and it is really about the technology and the digital initiatives that they have put in place that give them pricing power, and that gives them their customers the efficiencies and productivities, and I think that's very underappreciated. And we're at the inflection point, I believe, of international now starting to do very well. And we know they had a big chunk of their revenues tied to international, so that's what I'm going to be watching for.
Yeah, you made the point with international, and having the international exposure gets you a little more offshore exposure, which is a longer cycle and more sticky income. It is a little premium to Halliburton, but we like it. SLB was one of the best performers over the last 2 weeks after that crude news, after crude gap tire, and I want to see that happen. Yeah, that's what you're paying for with that little bit of premium.
Jason Snipe, Amex, reports next week as well on Thursday.
Yeah, volumes were good last quarter for Amex, around 17%. I think for me, as it relates to cross-border travel, that's a big deal. Obviously those guardrails have come down. I expect some follow-through in the report this quarter.
P&G also next week, Friday morning.
Yeah, P&G for me, organic sales 4 to 6%. Let's see what happens as the dollar has pulled back some. They have a lot of business overseas. I think that will also be some follow through there.
Is that a take on P&G?
I think it's going to be a good one. I think they have pricing power. I think the volumes
P&G
data, the volume should be actually okay. They've just got the premier brands and marketing, and they're taking market share. So I like that one. They just raised the dividend this week too.
All right, we take a quick break. We'll come back. Grade My Trade is next.
Flag. Cup and Handle looking for a breakout in Procter & Gamble. That's one from a couple of weeks ago. Some of you may have taken it above the 50-day.
What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
Okay, UNH pulled back to the 200-day, seeing some buyers showing up at the 200-day. All right, so just sitting there for now. I'll take another look at it on Monday, Tuesday, potentially a bounce here for United Health. Let's take a look at the IBD 50 stocks coming into this week. How they fared. On the week. Bygene. All right, that's consolidating. Crocs from the IBD 50, follow through, looking good. Add B from the watch list. Consolidation of this week's gains, still trending. Berkshire Hathaway. Nice pop today and a little fade. Markets generally are just lower. Most stocks are lower. Not much to do. JP Morgan still hanging out, plus 7% on the day, just below that 140 level. So I'm looking for this to consolidate next week between 134 and 138. I'm bullish above 134, bearish if it drops back below the 50-day, but I don't think it will. Next week, looking for a follow-through. Think being the operative word. I don't have any special powers or know what institutions are doing. I can see the volume, so that tells me they're accumulating. But other than that, I'm just going by price, relative strength. Trend looks good. So JP Morgan will be looking to buy some on any dip or consolidation next week. Most likely that stays above 134. If we take off and make new highs from today's highs, that would be a reason to buy.
$80.72. It is 1.75% of my portfolio. Do I trim? Do it. Do I trim it due to it being at an average price or hold?
Geez, flat.
I would not trim it. I would look to buy on weakness. This is a story that has gotten more simple with the spin-outs of GE Healthcare, which has been a phenomenal performer as well. But next year, they're going to spin out the renewables business. And then it gets even more simple. Then it'll be a pure play aviation story. And I think aviation is a secular growth story. And I think that they are actually providing the engines to Airbus and Boeing. And so they've got great customers. And they also have a phenomenal management team. So I like it. I would look to buy on any weakness.
All right. Jason Snipe, Charlie in Scotland bought PayPal at $81, which you own. We haven't talked about that stock, by the way, in a while. It's up 7% year to date. Over a year, down 25.5%. The payment space has been big time in question.
Without a doubt. So, and as you mentioned, you talked about the performance. So for me, as it relates to PayPal, the multiple is coming dramatically. It's only trading at 15 times. And I remember it was at 60 times through the pandemic. Elliot's been in there for some time. They're really focusing on cost cutting and also optimization of the existing base and transactions per customer. So I like this name here. You know, it's trading at $75 roughly. I do think there's some opportunity with the secular shift.
IoT.
And, you know, it's pulled back some of this, you know, over the last
Consolidation. That's from the watch list as well.
That's why I like this stock.
All right, Bill. Don in Connecticut. I own Marvell.
Oracle from the watch list. Just grinding along.
Should I hold or take my losses and move on?
All right, these stocks are looking. They're still holding on to strength. RBNC will probably take that one off this week. AGL had a nice week as well. Started off the week right near the 21-day. 9%.
I do believe that we'll see this thing be able to rally a bit, and it has a place within its portfolio. It's right size. All right, we will come right back with final trades next.
Walmart and the recession-resistant retail stocks like Dollar General, Dollar Tree. Pretty much everything pulling back today. But bullish longer term. Dollar Tree, Dollar General. Those pushed above the 200-day and then pulled back. Okay, so it looks like it's going to base some more down here. So it's the banks that are doing well. Citigroup, XLF. XLF faded a little bit. Looking for a follow through and a push towards a 200-day next week. Not much to do, folks. If you aren't watching positions, nursing positions, then I would be taking the rest of the day off if I wasn't broadcasting. If we weren't live, I'd be taking the rest of the day off. This is a pretty slow day. We're fading. We have a chance to bounce pretty soon. Going into the evening session, 2 o'clock, I'd be looking for institutions maybe to buy this dip. Other than that, there's not a whole lot to do.
All right, there's your market picture now. Let's call blows of the day, thereabouts. Dow down about 280. Big drag, obviously, today from United Health and Boeing. JP Morgan is certainly a standout. We said the best earnings pop in some 20 years for JPM. But you do have concerns, inflation expectations still high over 1 year, according to UMich. Consumer sentiment was a little bit of a beat. You still have Fed speakers. And by the way, voting members talking about not being done as well. That was Fed Governor Waller was one of them on the tape talking about just that. And then we look ahead to what's next week with a very, very busy week. So, Josh, set the table for me before we do finals and be quick, if you would. What you going to be watching today into the close?
I think it's really important that the stocks that have been holding up can stay up. I know that sounds obvious, but sometimes it's the simplest things. So what we really don't want to see is intraday reversals of the leadership names. And right now, even with a weak tape, we're still seeing that strength.
Gotcha. Give me a final trade quick, too, please.
Carlyle Group earnings coming up with a new CEO for the first time.
Okay, good stuff. Thank you, Steph.
Butter after healthy can be quarter.
Yeah.
You gotta like Estee Lauder's chances for a good quarter next week.
All right, Bill Baruch. Alphabet, to Josh's points, hanging up pretty good in a sea of red. Google
Estee Lauder does look good.
YouTube Shorts could be a juggernaut. Jason Snipe.
Goldman Sachs trading at 1x book, over 3% dividend yield. I like this stock here.
All right, good stuff. We've got Dan Greenhouse, Bryn Talkington, Kevin Simpson.
Google just grinding along here. So while it's not doing gangbusters, I do like Google moving higher. For my kids, I have GGLL. I have my kids in this. It follows Google, uses options and some other strategies to give it 1.5 times the share of Google, but it trades at a discount, obviously.
We've got deflation, we've got inflation, we've got Fed speak going both ways, retail sales, industrial production. And after all of that,
All right, probably going to make some lunch here. The markets aren't going anywhere fast.
and the housing market at its tipping point, we've got the rate where home buyers are drawing the line, plus a contrarian call in the travel space. It's a bearish note on a very big name that's seen 30% gains this year. Back to the markets, though, the NASDAQ underperforming amidst the sell-off as those rate hike expectations shot up this morning.
Chegg.
Major average now on pace to close lower for the week. Now to the banks and those big bank bank earnings we mentioned. Let's dig in a little bit, shall we? The results were
You can see this base here in Chegg. We had a nice break above the 50-day this week. Chegg is in the business of printed and online text materials for school, middle school, high school, college. And that looks pretty good. Looking for a follow through next week. Looking for this to follow through next week.
Initially, that boosted shares, but they've since turned lower as investors now say that contributed to a low quality earnings beat, and those provisions maybe should be going up if we're heading into a downturn. So JP Morgan, far and away the best performer on the S&P today. It's up about 8%, 7% as it pairs its gains, while PNC shares are now trading back to levels we haven't seen since November of 2020. So are the bank problems really behind us now or not? Let's ask David Conrad. He's large caps bank analyst at KBW, a Stifel company, along with our very own Dom Chu, who joins me here on set, and CNBC.com banking reporter Hugh Sun. Welcome, everybody, and it's great to see you. David, I'll start with you. And regional banks, I think people feel a lot better if we look. If the carry was up 5% today, I think we could all say this issue is more firmly behind us, but it's not.
Yeah, I mean, I think PNC is probably somewhat of a decent read-through going into next week on the fundamentals, perhaps.
Stock showing relative strength. Let's run a couple of scans. All right, so we're starting to see a little turn here. Shorts covering.
I think the issue also with PNC, though, is one of the more expensive stocks, heading into the print, and so it was trading at north of a 20% premium to peers, largely because it's a high-quality, strong management team. So they were more exposed to kind of a guide that missed expectations and brought the stock down.
Hugh, what would you add to that?
Hey, John, great to be with you. So I would look at it through the lens of net interest income. So if you look at JP Morgan, theirs was up by nearly 50%. It was a huge beat by over $1 billion. And they actually guided to a $7 billion in excess of what they had said that net interest income would be in this year, 2023. They're saying it's going to be $81 billion versus $74 billion. Now, look at PNC. PNC actually had a 3% decrease in net interest income because, as David mentioned, their funding costs are higher. Now, what does that mean? What does that mean in plain English? It means that they actually have to pay people higher interest rates to convince them to keep their money on PNC. And I think that's the issue that they're going to face, and a lot of the other regional that they face, is that they don't have the kind of franchise that keeps these kind of sticky deposits at such a low cost as JP Morgan does, which, as we know, is the beneficiary of that deposit flight.
And Dom, so we have kind of two problems coming to a head today. We have this issue of talking about with banks specifically, while at the same time, the Fed speak is, Christopher Waller is pretty hawkish. And so we've got kind of this double whammy for those who are hoping for maybe a little bit smoother sailing today.
And it's not just that. I mean, the points being brought up here are very much on point with regard to the regional bank versus big bank dynamic. And the reason why...
All right, we're starting to turn here. The markets are starting to turn. A little short covering. Let's see if we can muster some strength.
Specifically, we're talking about a super regional bank that, yes, has some of those funding costs and will have to compete with other banks to get customer deposits in, increasing funding costs, lowering net interest income. But it's also about whether or not that deposit flow is steady. And what we did see from PNC is that their deposits did actually grow ever so slightly. It wasn't a huge growth in deposits whatsoever, but what it shows is that for a bank of, say, a PNC size or a U.S. Bank's size or one of these other super regionals like Truist or Regions, maybe those deposits are not as flighty as they are at, say, a PacWest, a Western Alliance, a First Republic, or otherwise. And that's the reason why people are looking at this, not because it's indicative of those problem banks, but because it is a way for you to benchmark what other regional banks will be like in this coming week.
Yeah, and David, to the point Dom's making, these are some of the stronger super regional banks, right? These, I don't think it's going to get better as we get into the smaller, areas, maybe more specialized. It's a different line of business. Tell me, as we spin this into next week, what your big takeaways are, what you think are now going to be the pressure points for the market.
Well, again, it's all going to be about deposits. And if you look at PNC, their deposit costs increased about 70% relative to the Fed funds increase. JP Morgan only increased deposit costs 55% of what the Fed funds did in the quarter. And so when you start to get to that 70% range,
a little bit more follow through on shorts covering.
It's tough to really grow the NII. And so we're expecting cumulative betas to be the mid 40% range by the time we end the year. And so that means really escalating costs.
So it's just shorts covering for now. We'd have to see a nice follow through for the next 30 minutes or so to consider this anything more than just shorts covering for now.
JP Morgan, because credit costs aren't highest. They're not elevated. They're still super low, and yet they're reaping the benefits of the fact that big picture, the Fed has increased interest rates, the benchmark rate by 500 basis points more or less in the past year. So that's a very compelling kind of combination. But then you take a step back and say, do I want to own banks ahead of a possible recession? How deep is that recession? How bad could it get? So that's certainly the case here, and it would give a lot of investors pause.
Yeah, Dom, go ahead. I was going to say, you brought up an excellent point, Kelly, about bringing kind of the Fed dynamic.
All right, so it just looks like a little short covering for now.
You would expect interest rates to rise. And in that way,
JP Morgan starting to move again.
Where things really go bad, people will end up flying.
All right, just flat VWAP. So my plan is to wait for JP Morgan on Monday, Tuesday, see how it trades. Does it just continue with another bullish candle? The only way that would happen is if institutions are buying high and selling higher. We need to see more volume come in as well. So if we have a similar looking candle on Monday and we're headed towards 142, I'll sell the rest of those 140 calls and perhaps buy some shares with profits on any pullback that we might see or consolidation. I want to buy it up here because we're right near supply, near resistance. But I am definitely interested. I'm very bullish on JP Morgan going forward. And Citigroup looks pretty good, but I want to see how Morgan Stanley earnings are received next week. I did buy a little bit of Morgan Stanley, probably buy some puts for insurance, but looking for upside in Morgan Stanley. Looking for them to beat as well. Goldman Sachs, not so much.
David, I just got to sneak this in real quickly. I mean, do you do, kind of rating, price target changes, all that sort of thing immediately following what we've heard from some of these players? Or do you think this is going to be a longer period of time where we need more information to kind of know what the rightful valuations are going to be?
Yeah, I mean, I think a couple points. We do try and
SPY, not much in the way of follow through.
Right. But to be clear, usually I like to, if I contemplate a rating change, kind of digest all the information for the quarter.
Trying to go on a buy signal here.
I'd also point out with JP Morgan's strong quarter and their NII guide. Part of that is
Apple just triggered a buy signal.
The Fed could cut later this year, which eases the cost of deposits later on. So it'll be interesting that dynamic versus the Fed views.
Wow. Yeah, that's officially baked in, and yet the Fed itself is insisting, oh no, we're not going there. That's fascinating. Thank you all. David Conrad, Hugh Sun, and our Dom Chu. We really appreciate it. Now, despite all those downturn concerns, my next guest says the market is not overvalued, and consumer discretionary stocks are his biggest holding. He says panic is driving the markets instead of the data themselves. Joining me now is Neil Hennessy. He's Chief Market Strategist at Hennessy Funds. Neil, it's great to see you again. Give me your common sense point of view here. What do you think is going on?
Well, I think everybody, Kelly, has to just take a step back. Like the last segment, you're talking about the banks. I mean, the financial segment is very strong. You look at the financials, and that's just proved by what the Feds did 2 weeks ago. In the light of Silicon Valley Bank and Signature, they raised interest rates. They would not have raised it 25 basis points if they thought the financial system was in any shape that was going to get hurt. So, but there's a lot of issues that are going on, a lot of things that are being said. But the bottom line is our financial system's in good shape. Our markets are in good shape. The consumer's in good shape. There's tons of cash on the site. There's $7 trillion in cash on the S&P 500 balance sheets. There's over $5 trillion in cash in money market funds. There's over $1 trillion in cash in personal savings accounts. Where'd all this money come from, and where is it going to continue to come from? Most of it is all from everybody's being employed that wants to be employed. Companies are making money. Earnings are going to be down approximately 6% this year. So what, Kelly? There's companies that are still cash flowing at huge numbers and putting money in the bank and looking at the same time the cost savings. So I'm not sure why everybody gets panicked, but it's sort of like
Watching the ES here, 1 minute chart, right at resistance right now, the moving average.
when the reality situation, if you buy quality and you hang on to it, you're going to be fine through.
Looking for more buy signals to concur. A few more things are going green on the day.
We're going to tip over here. And I'm not saying that's not going to be a good opportunity to buy stocks, but I can absolutely understand why people are concerned. And I would hardly expect the Fed to be ahead of that. They're always behind. They overreact one way, they overreact another way. They're all focused on lagging data. They're never ahead of the ball.
Well, I can see that. But, if you look back a couple of years ago, everybody was, I guess, hoping that the Feds were going to keep interest rates at zero. And everybody knew at some point in time they were going to go up. That, you look at Silicon Valley.
All right, starting to catch some momentum here. Watch the buy programs potentially.
Crisis that we had going back to 2008 and 9. If you look at it, Kelly, did anybody have a problem cashing a check? Anybody getting cash at a bank have a problem? Did your debit card not work? I mean, come on. So when everybody's focused on this banking issue, when it really isn't an issue. But if you focus in, and one thing I've always said, Kelly, I've always said, if you buy high quality companies, and most likely if they're boring, sort of like a coin operated laundromat, because you've never seen a sign outside a coin operated laundromat going out of business, those companies tend to perform over time, little by little by little, and they make the investor, the end user, a lot of money.
Let me ask you this, Neil, because we're showing some of your top holdings we've talked about before, Academy Sports and Outdoors, Dick's Sporting Goods, a couple of different types of financials you have almost no exposure to. Why?
All right, we need to get a little follow through right here. We're just starting to transition above the 1 minute moving averages here, longer term.
So that's something different, completely different. Part of it also has to do with price to sales, and that's one of our leading indicators, Kelly, instead of price of earnings. I rather look at sales because that's a truer number than earnings, where you can manipulate your earnings by write-offs or gains or whatever. Sales are sales.
So financials are tough to evaluate from that point of view, or just expensive?
Well, it's like our Hennessy Mid-Cap 30 fund is quantitative, so you're going to have to fall within that category of a low price of sales, higher earnings, and so when you look at the banking system, they didn't make it.
Tick cumulative is trying to change direction
And so when I start to look
and cross over on the shorter time frames.
what I'm trying to do is not keep the indexes. I'm trying to make the shareholder.
The dollar, the 10-year, and the VIX are all fading at this point, so that would be a tailwind if that continues into the latter half of today. Starting to gather some momentum now, volume coming in. We got a 1 million share block on IWM.
As we head to break, take a look at the Dow heat map. JP Morgan leading the way as we move off the very session lows. We're down less than 200 points right now, but only about 7 names are in the green today.
1 million share block on IWM.
Down nearly 6% after warning that an issue with parts could cause delays for 737 MAX deliveries. We've got the latest on that and more when the exchange returns in just a moment.
1 million share block on IWM trading here. And that looks like, what's that? 175 and change. IWM, watch IWM here. All right, that's at the bid for what it's worth. IWM, that's a 1 million share block at 175.77, bullish above 175.77.
Welcome back. Shares of Boeing down almost 6% on fresh news of delays for the 737 MAX, while shares of supplier Spirit Aerosystems are down 20% today. Phil LeBeau is here with the latest details, and Phil, investors seem super frustrated by this.
Frustrated because they don't know how much of an impact this will have on Boeing's cash flow and, by extension, its earnings in the second quarter and really the rest of this year, Kelly. That's the primary issue for investors. And related to that is the question of how long will it take to fully identify and then figure out and fix how many 737 MAXs are impacted by this issue. While they are figuring this out, Boeing has said they will be pausing deliveries of some 737 MAXs. For example, the most popular MAX, the Dash 9 model, it's not impacted here. So the deliveries will continue in some fashion, but all models other than the Dash 9, they're going to have to inspect them. And that means those that are in production as well as in inventory, 2 fuselage parts provided by the supplier Spirit Aerosystems will need to be identified and potentially replaced. And again, this is not a flight safety issue. I've had this question all day long. Well, if it's an issue with a part in the fuselage, is it still safe to fly? Yes, the FAA says the ones that are in service can continue to be in service, but it will impact deliveries potentially. And when you look at the 737 MAX, remember that Boeing has been increasing production and increasing deliveries. The estimate right now, according to FactSet, for full year deliveries this year, 445, but I've already heard from a couple of analysts who are saying, look, we're going to have to bring down our estimate depending on how.
All right, so just a bear flag for now, no follow through. Need to see this continue higher.
Located in Wichita, Kansas. They are the ones who have said there is a particular issue with 2 parts at the aft part of the fuselage where it connects with the tail fin. And what you have is a situation where they're going to have to inspect these planes and potentially fix them if they find the planes have the parts that are in question. Spirit Aerosystems, by the way, will be reporting its Q2 results on May 3rd. I haven't been able to find out when was the last day it was down 20% today, but this is one of the biggest losses, single-day losses that we've seen for Spirit in a long time. And then when you take a look at shares of Boeing, obviously under pressure because it may have fewer deliveries this year. Remember that its shareholder meeting is next Tuesday. It'll be interesting to see if they make any comment regarding this issue. And then on the 26th, they report their Q1 results. Kelly, back to you.
All right, Phil, thank you very much. And again, that is weighing on the Dow today. Meantime, demand for planes and for travel in general seems to
Okay, no follow through. So I was saying before is that we need to see like a half an hour worth of bullish activity. We're already starting to see a little fade already. We need to get above 176. IWM.
You're pointing out, listen, the market share here maybe is facing some competitive pressures. What are they?
What we see within the booking numbers, which have been good and they have been very supportive of the stock, is they have benefited from some of the actions of their biggest rival, Expedia. Expedia has switched off or reinvested in some of its smaller brands like Travelocity, Bookers, Orbitz. It's re-platformed some of its more prominent brands like Hotels.com, which have affected performance. It's decided to try and become more of a B2B focus on loyalty. And we think those actions have helped Booking, but are time limited. Eventually, Expedia will be back to the market, and there are some signs with its new loyalty program, maybe its investments in AI, that show that it's getting more confident again and coming onto the fore.
Sure. So you see basically Expedia is coming back in a big way potentially. What about Google?
Yes, I mean, the aggregate position of Booking and Expedia, what we see is that they are losing share. So Booking is gaining, but it's gaining from Expedia's losses, and the aggregate is that they're losing share. And one of the biggest drivers of that is Google. Google has continued to iterate how it deals with travel-based searches. It isn't a direct competitor, but it is sending more traffic to the hotel's own websites through its map-based and reordered searches. So that's certainly having an impact on the aggregate position of the two OTAs.
And I really like your point here. So a lot of people, as they've been running recession probabilities, have been looking back to the playbook from the financial crisis to say, where were some areas that we could kind of hide it or ride it out? And Booking was one of those areas, relatively speaking. Why don't you think that's going to be the case this time around?
Yeah, I suppose there's two factors for that. And our thesis is not that travel is about to fall off a cliff. Every year, I think the last 3 years, we've been hearing travel's going to fall off a cliff in September, and people are now saying it for this year. We don't really believe that. But if it does, where would be the places to hide? And we don't think OTAs are necessarily the right place. In 2009, the vast majority of hotels were not on the OTAs and came on to them.
I need to see more follow through. It's just one of those kind of days.
Discovery tools for consumers, they may have got the best deals, and we would argue there are other platforms like Google, like Hopper, that potentially can provide better prices to the consumer in the next potential downturn.
Real quickly, Richard, before I let you go, and again, it's not often you see a name like this taken to underperform. That's why it's so provocative, and we like it. In terms of getting us thinking, stack it up across the rest of your coverage space. Like you said, you don't expect maybe a macro slowing in travel, but how would you explain your thoughts on the stocks in the coverage space more broadly?
Yeah, I suppose I'm an interesting analyst in this respect, but I'm not actually an internet analyst. I'm a lodging analyst, so I cover Hilton, Marriott, those companies. And in that respect, the fundamentals of Booking are pretty much part of the course of selling travel. High margins, high cash generation. You can get that elsewhere in the travel distribution market. It's a great business to be in. And I guess I just see with Booking more competitive pressures, maybe slightly less defensibility in terms of their customer base than we see elsewhere, maybe in some of the C Corps or even Airbnb.
All right, they were showing Airbnb shares also up 32% year to date. Richard, thanks for your time today. Appreciate it.
Thank you.
Richard Clark, Bernstein. Now, what if I told you that Powerbar was a top pick on the street today? Stifel naming its parent company BellRing Brands as a top pick, with the shares already at 33% so far this year. And BellRing also owns those popular Premier protein drinks and protein powders. Meantime, tobacco stock Philip Morris, also a Stifel top pick, lower today, but on pace to close out a third straight positive week. We're back in a moment here on the stage.
All right. I apologize. Although I have nothing to do with the market's flow, there's just a very distinct lack of interest in the markets. We got some short covering, looks like, at the low. IWM, we had a 1 million share block at 175.69. We're just above it right now. Looks like it was shorts covering for now, but I'm looking for a follow through. So IWM, if we get a reversal at the 21-day, that would be huge. Right now, we're sitting right near the 21-day moving average. We spent the entire week trying to get above the 9 and 21-day and failed. We're right below the 200-day, got rejected there. So small caps are considered a risky asset. As such, if they're moving lower, that would be risk off. Okay, I'm just watching IWM. Another risky asset is high yield corporate debt and junk bonds. Generally, it's making higher highs and higher lows, pretty much mirrors what we're seeing on the SPY. OG spending top, but no real hard sell off. We came down and tested 410. I'd also be watching junk bonds and biotech stocks. These are risky assets, and traders will tend to stay away if they're risk off and buy when there's risk on. Right now, it's just kind of neutral today. It's a Friday. I am interested in the hotels like Hilton and Marriott. Both of these look pretty good. Trying to push higher. Bookings.com continues to grind higher. Royal Caribbean, there was some talk about Royal Caribbean options trading. Carnival Cruises. The airlines, Delta had a bounce initially. Not much going here. The casinos. You can see there's not a whole lot going on. Everything is down. The Dow, the S&P, the NASDAQ in descending order. Dow's off the least. It's only 30 stocks. S&P and the NASDAQ's off the most. MRUS. Okay. On. All right, so IWM right back down to the lows. No follow through on that 1 million share block. All right, so we're testing the low. We're back below that 1 million share block now. Starbucks, seeing some action in Starbucks. Just grinding along. and Google.
Hey everyone, welcome back to the Exchange. I'm Tyler Matheson. Here's your CNBC News update at this hour. The Air National Guardsman arrested in connection with the leak of classified documents appeared in court today and learned what charges he will face. A federal judge told 21-year-old Jack Teixeira that he's being charged with possessing classified documents pertaining to national security and possessing national defense materials. The charges carry a maximum of 10 years behind bars. Teixeira's next court appearance.
VIX spiking.
Members of Congress are reacting to the document leak and arrest, and some are defending the suspected leaker. Representative Marjorie Taylor Greene tweeted support for Teixeira and claimed that the Biden administration was, quote, the real enemy. In response, former Representative Liz Cheney said Greene should lose her security clearance and that she, quote, cannot be trusted. And the maker of mifepristone, the pill used for medical abortions, is joining with the Justice Department now to ask the Supreme Court to block a ruling that curbs access to the medication. Danco Laboratories said if the decision to revoke approval of the drug goes into effect, it will be unable to conduct its business and would be, quote, irreparably harmed. Kelly, back to you.
Tyler, thank you, and I'll see you soon. Meantime, we have a ton of divergent data to dive into today and really from the entire week. CPI, PPI both easing. Retail sales missed, but if you look at the 3-month annualized pace, they're still quite high. Headline consumer sentiment beat this morning, but those one-year inflation expectations shot higher, which helped push up rate hike expectations. And industrial production also climbed, but that was thanks to utility usage rather than manufacturing.
Today's just one of those days. I don't want to force any trades, so maybe Monday we'll get better read on the markets. For now, I mean, S&P looks okay. It's not like falling off a cliff or anything. We're trending. We have that 4,200 level overhead. 4,150 is a major level. We know that. We knew it coming into this week. 4,100 is also a big area, 50 handle range here, 4,100 to 4,150. So that's where we are. I don't see us breaking out. There doesn't seem to be an interest. There's not a whole lot of blocks coming through. Pretty slow day. I would take the rest of the day off if I wasn't here talking to you live. There's just nothing to do.
Most of the move curiously came right after the retail sales numbers showed a bigger drop than expected. Though, as Kelly just said, the March decline was revised up to less of a drop, and that quarter was still strong because of the big January spending number. And it came while new Chicago Fed President Austin was making his first interview since becoming that, taking that title, was suggesting the Fed should be cautious about future hikes.
Let's just be mindful that we've raised a lot. It takes time for that to work its way through the system, and you, with this sales number, you may be seeing a little bit of that lag. And if you add financial stress on top of that,
Starbucks pulling back a bit. Starbucks.
So potentially offsetting these comments or offers.
Okay, so probably on Monday or Tuesday, we're going to get a test of the 9 EMA. If we do, I'd be interested in adding there or starting any kind of new position. 21 days crossing up through the 50-day. Some decent volume, but nothing to write home about. RSI showing strength of trend. So let's look for a dip to the 9 EMA, perhaps on Monday, Tuesday. For now, I don't have a position in Starbucks. I thought I did. I just checked, David. So sold it yesterday, apparently. Okay, so we're drifting lower, new lows.
Stubborn and frustrating data point of the year. Gasoline prices are up almost 50 cents a gallon, and maybe that's why we saw inflation expectations jump. And it'd be pretty uncomfortable if right as the Fed needs to sort of take its foot off the brakes.
Newmont Mining, that was a nice entry right around where Josh Brown talked about it. Buyers stepped up. Newmont. Josh spoke about it. It took off to the upside. And look for higher highs.
Oil prices that rise as the year progresses, particularly if the Fed does eventually stop raising rates.
that leads to further weakness in the dollar, and that will really complicate their job. I mean, just in April alone, the first 2 weeks, oil's up double digits. So whatever moderation that we might have seen on the energy side in March in CPI, PPI, even in input prices, well, that's going to reverse itself when we see the April data next month.
And we learned in 2008, you can have oil prices rising even during a recession. I mean, it was the early part of 08, they climbed to, what was it, 150 or so, and that was, the recession was already 4, 5, 6 months in at that point.
That would be a difficult stagflationary situation, and I'm not sure how the Fed would respond because they know that they wouldn't necessarily be able to directly cap energy prices, but it would still filter through in an inflationary way throughout the rest of the economy.
And I don't want to take us too far down a hypothetical, so maybe let's dial it back to what you think is most significant about today. Is it this change in expectations for a hike now?
Going into today, we were still about 65%, call it. So Waller's comments sort of pushes that further, but we still have a couple weeks left of data. I don't think that Goolsby's opinion is going to be solely to him, because a lot of the things that Waller said was classic rearview mirror thinking. The labor market's strong. Yeah, well, it's strong, but it's not as strong.
What about jobless claims?
The jobless claims, exactly. Talking about very sticky inflation, but once rents start to kick in, that's going to disappear. So I think he is really looking in the past, not in the future, and coming from someone who's very focused on inflation and has been. I think he's making a classic central bank mistake.
Steve, I'll give you the final word here. And we have made it through now a raft of the data we were expecting for the month. And it's interesting to see, although there's a little bit more to come, like Peter said, we're largely in another hike camp.
Yeah, it's hard for me to see. And if you don't mind, maybe give Peter the final word in that. I don't really see what else is going to change the Fed's opinion here. I think the market was maybe kind of in this holding back and making a final call on this. And now I think all the data's in. I think unless there's data that show the banks pulling back much more, or maybe going to the window much more than they thought, or than is currently the case, that I think the writing's on the wall. There's not very much else that's going to be out there to sway the Fed. Maybe some huge rise in jobless claims could give them pause. I don't think that there's much else here. And the way it broke, Kelly, was, inflation was down. But the idea that what really fell in inflation this week was the headline number. And what you were just talking about, likely to reverse itself in April. I think that's going to weigh on the Fed, which, again, I think is a forward-looking indicator, not a backward one.
And Steve makes a good point, Peter, that maybe the jobless claims really become the most. If this is just a head fake and they go back down, fine. And if not, that basically means we're with, set the clock for recession. Or as Michael Kantrowitz would say, once claims have bottomed, stock prices have also topped. So there's a lot at stake here for that series.
For sure, and it's the highest frequency data we're going to get every week. And to Steve's point, maybe there's not enough data to swing them and pull them back, but jobless claims could be. And maybe corporate earnings. I mean, we're going to hear a lot from corporate America in the next couple of weeks and what they have to say about the landscape. We had even the Wells Fargo CFO talked about moderation in spending they saw. We had Fastenal saying that sales fell off in March because March 9th was a big change. We have two economies this year, pre-March 9th and post-March 9th.
Because of the SNAP benefits?
And because of SVB.
Oh, because of SVB.
SVB,
yes,
right.
Yes.
So I want to hear what companies have to say about their business post March 9th and into the couple weeks of April rather than up until March 9th.
All right. Got to go. Steve, I love you. Wait, what? 10 seconds.
That's what really separates members of the Fed, is how concerned they are about what happened March 9th, with Goolsby more concerned. Some other folks saying, hey, we got it solved. We have the big programs out there.
Yeah, exactly.
8, 9, 10.
Yeah. And that's what makes him so good at his day job and his night job. Steve, thank you, Steve Leisman. There is a line in the sand for home buyers this year, and it has to do with, no surprise, mortgage rates. What number do they refuse to go over? Diana Olick is here to explain. Diana? Well, Kelly, for most buyers, the mortgage rate determines what they can afford, right? Because you buy the house not based on the price, but on the monthly payment, and the monthly payment is all about the rate. But a new study by John Burns Research found a majority, 71% of buyers, said the highest rate they would accept is 5.5%. That apparently is the tipping point. And it didn't matter the age of the buyer either, as in those older consumers who may have had a higher mortgage rate many years ago. In addition, 62% of consumers said normal mortgage rates are below 5.5%. Now, just so you know, the current rate is about 6.4%. And of course, We've been talking about these higher rates since
Newmont, it's a buck off the low of the day. Looking forward to get back above 50.
Averaged 7.75% from 1971 all the way to 2023, reaching an all-time high of over 18% in 1981 and a record low of 2.65% in January of 2021, the height of the pandemic. Now, it's only been since the Great Recession and quantitative easing that rates went below 5% and then went historically low in that 2 and 3% range. Now, those ultra low rates, of course, they were the thing that lit the fire under home prices. So it's no surprise 63% of current homeowners think homes are overpriced, as do 83% of renters.
I know
Callie, you got all the numbers?
I do. Well, believe me, everybody follow. I mean, is there anything more followed than the housing market and mortgages? Peter, I was just going to say 5.5% might feel better, might unlock a new wave of demand, but the market is resilient even with rates where they are right now. To me, it seems surprisingly resilient.
From a pricing perspective, absolutely. I mean, I'm still hearing about bidding wars.
Right. Same.
That's because of still the dearth of inventory. I mean, to Diana's point, 90% of the mortgages outstanding are below 5%. I think about 70% are below 4%. Wow. So you have a lot of these people that are trapped in their houses, whether they want to or not, because they just don't want to give that up. Now, I think as we get through the spring selling season, which is the hot season, it'll be interesting to see how this plays out on the price side. But no doubt the lack of inventory is keeping things elevated, which would then potentially reduce the pace of transactions
And
further.
Andy has made this point as well, Diana, but if we see mortgage rates fall below, as Peter said, 4%, 5% even, I mean, that could suddenly see more inventory, lower prices. It could really spur some moving activity.
Absolutely, and inventory is the key right now. That's the problem. New listings are down phenomenally from a year ago. There's just nothing on the market, and if it is on the market, it's priced incorrectly, and that's why it's sitting. But I would also note that about a quarter of all home purchases right now are all cash, so no mortgage rate involved. And that is really historically high for the market. Usually it's well below 20%. We're also told that investors are moving out of the market right now because prices are so high, and yet that all cash number hasn't pulled back very much yet. And that means that people have so much capital that they're sitting on. Maybe it's in a home they already have or somewhere else, but they're putting it in because they don't want a mortgage.
Absolutely. Diana, thanks. Peter, thank you as well. Peter Bookvar and our Diana Oleg. Still ahead, big EV makers and solar companies boosted by the Inflation Reduction Act. But what about the mom and pop shops also involved in the energy transition? We'll tell you how small business could benefit from the IRA next. Meanwhile, check out shares of ResMed. This is the sleep apnea device maker. They're down. They've been volatile today, even though Mizuho is bullish on the name, initiating them with an outperform, calling them the undisputed king of sleep. One to keep an eye on. The exchange is back after this.
All right, pretty slow day. Just making some lunch. I'm here with you. It is 1:44 on the East Coast, coming into the 2 o'clock hour pretty quickly.
Things are starting to look dire, at least on a chart. When you look at Rivian, I mean, the stock was like $180 at one point. Had the big backers and Amazon notably behind it, Ford involved as well. The car looks good. You see them on the road, at least in Illinois, but not enough to maintain this stock. It's just basically took a nosedive, essentially on lifetime lows now. I know we just heard from Piper. They're downgrading it. They moved that price target sharply down to 15 from 63. I mean, you can see this. You can double, and you're not even going to notice it on the chart. But Caroline, what about the rest of the street? Are people losing faith in this company? Like, this is already a really, really tight needle to thread. But when you start having stock charts that look like that, I'd imagine confidence starts to fall away.
Yeah, that's certainly the case. Keep in mind, you mentioned the $180 highs. This is also a company that IPO'd at $78 a share. So I think it depends on, from an investment perspective, when you got in. I mean, at these levels, if you take a look at the median price target, analysts expect that it could more than double from these levels, so more than 100% upside, because the median price target is $27 a share. So definitely room to the upside. However, if you got in at 180 or 78, I think your confidence is pretty much waned. I will say, though, I mentioned Rivian's down about 30% so far this year. Obviously, much more than that from those all-time highs. But at this point, still 65% of analysts have a buy rating on these shares. Another 25% have a hold rating. So very few in the sell camp, only 2 total at these levels. So not completely pessimistic on this name, but I think with constrained capital, with the cost of capital being higher, it certainly has its fair share of headwinds. We know that Elon Musk has warned that some of these other automakers could basically run into bankruptcy issues. Obviously, Piper Sandler has some concerns, $4 billion to fund its growth through 2025. So I think, not without headwinds, but depending on how you look at this, you could say that there's, more bullishness than anything on the street, given that 65% have a buy rating at this point and a $27 price target, which is, almost double where it's currently trading.
I think that's a good point, Caroline. I almost want to throw away for the chart from 2 years ago, because I think it's all relative now. Like you said, it depends where you got in. I think right now a lot of people could say, hey, with shares down so significantly, it perhaps could be an attractive buying opportunity. They have just got to get their costs under control, because if Tesla's having problems, I can only imagine that the picture for their margins also isn't looking too great. But we will leave it there. Appreciate all the insight on Rivian today. Have a wonderful weekend, Caroline Woods, Senior Markets Correspondent for the network. Coming up next, we're looking at Spirit Aerosystems, which is down 20%, pacing for its worst day in nearly 3 years. On some Boeing news, we'll discuss that more with George Tillis coming up next.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on Trending Game.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Next Gen Investing. It's time for Under 30, looking at SPR, that is Spirit Aerosystems. Stock is plunging here on this Friday after some not so great news regarding what company that has to do with airplanes just never doesn't have bad news. Boeing.
Well, it does seem, so this was a Boeing story, but it does seem like Spirit Aerosystems Aerosystems is to blame. So go figure, we're seeing shares down 20%. But here to tell us more now on this move and this story, I'd like to welcome in George Tillis, Senior Markets Correspondent for the network. So George, from my understanding, this is all Spirit Aerosystems' fault. I mean, I'm sure Boeing can take some credit here, but is that why we're seeing such a massive sell-off?
Yeah, I mean, the reason we're seeing the bigger sell-off in Spirit Aerosystems is just because the fall really relies on their end product, which is their fittings for their fuselages. That's essentially what Spirit Aerosystems supplies the marketplace. And unfortunately for the company, but sometimes fortunately when things are going well, 80% of their total sales go to Boeing. The rest of the 12% or so goes to Airbus, and 8% or so goes to some of the private Airstream or airjet manufacturers. But that's one of the unfortunate factors of having a large customer like Boeing is that you really rely on them. And of course, when they found an issue associated with the fittings for the fuselages, that's really going to impair the company. Now, it's not affecting the airplanes that are in flight or in service right now. It's really based upon those that are actually manufactured and are getting ready to be deployed into service. But nonetheless, there's probably going to be some expected write-downs associated with the cost of dealing with this, not necessarily just in the ones that are due for delivery, but also the ones that are probably in flight for inspection, of course, and for repair. But if you consider Spirit Aerosystems, I mean, 80% of their sales, like I said, are Boeing, but you look at the breakdown of that, it's close to 78% of that goes right to the 737. So it's really hitting the heart of Spirit Aerosystems, which unfortunately is down still. I mean, in the last 5 years, down about 65%. And in fact, this is not a COVID problem. This has been a Boeing 737, Spirit Aerosystems mixed problem that goes back to 2019 when the total sales for Spirit Aerosystems were at their peak around $7.8 billion. And last year, unfortunately, they only generated about $5 billion. And of course, their net income last year was negative $500 million compared to back in 2019 when it was positive $600 million. So unfortunately for the company, they've lost money every single year since 2019, and that's why
Newmont mining right here near 49.70. We get above the 200 EMA. Watch the 20 EMA for a cross up. We're above VWAP. Bouncing off the 21-day on the daily time frame.
Consumer confidence in this thing cannot be good, and it might be the safest plane ever in the end, but like this has been a 5-year story at this point, it seems like.
Yeah, so look, if you look at Boeing, I mean, at least on a year-to-date basis, or actually since I think November, it's performed quite well. The reason being is the expectations for 2023 were full year profitability, but that might actually take a little bit of a hit based upon the deliveries of this particular plane, which seems to be at the very least halted for the moment. So things can change. Maybe things will turn around based upon this being not necessarily such a dire situation. But if you look at Spirit Aerosystems, they're not expected to be profitable on a consistent basis until 2024. So they're lagging behind. And you talk about a curse. I look at it and say it's a very complex machine. It's a complex industry, which again is very specific to specific companies. It's intellectual capital that can't be reproduced by multiple competitors. That's why there really is single suppliers in many instances, in this case, of particular components for these aircraft. So that's the issue. There's no competition because of the complexity, but at the same time, it's actually a good thing if things are going right. But in this case, there are going to be some engineering complications, which there still are for the 737 MAX, but it really is a very critical plane for Spirit Aerosystems. It is very much so for Boeing. But at the very least, Boeing has other revenue streams, including, of course, other jumbo jets, aerospace and defense, to insulate itself from the 737 MAX issues. But I think this issue will be resolved. But unfortunately for Spirit Aerosystems, what this does is it creates a situation where maybe that profitability expectations for 2024 gets ratcheted further out. Because, again, it's going to cost them a little bit more to deal with because it's specific to their components and their company.
Yeah, and George, it's been fairly difficult to keep the faith regarding all things 737 MAX, but I hope it's not cursed because I've been on one of the new ones. So I hope, luckily I obviously turned out okay, but I hope that for the safety of all passengers, they are not cursed. We will leave it there. Yeah. Appreciate your insight, George Tells, Bloomberg's correspondent today and all week long. And that also does it for Alex and myself for Next Gen Investing. Coming up next, we have the watch list from Paul Pedalese.
Let's walk through how to analyze a company's financials on thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make thinkorswim even better, we listen.
I'm here with you. I'm just eating lunch. Watching Newmont here trying to push through 50.
You can access anywhere, no download necessary. And Kim, she wanted to execute a preset trade strategy in seconds. So we gave them thinkorswim web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Binge watch the market with TD Ameritrade Network. The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com. All your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Good afternoon. Welcome to the watch list. I'm Nicole Pedalese. It's 2 p.m. Eastern Time, coming to you live from the New York Stock Exchange. You see down arrows here, but it is, in fact, a winning week on Wall Street. We've got a lot of bank earnings this morning, retail sales, consumer sentiment, and those inflation prints from earlier in the week. The S&P at 4122, down 23 points, but as I said, higher for the week. In fact, the fourth positive week in 5 for both the S&P and the NASDAQ. The Dow right now, 33,795, down 234 points. The NASDAQ, 13,010, down 100 points. And the Russell's down 1.3%. For some of the biggest stories in the markets, we welcome in Renita Young, Senior Markets Correspondent on the TD Ameritrade Network, to take a look at some of these banks. So the earnings season has begun. Today kicked it off with a few of the very big names. You're focusing on a couple, including JP Morgan Chase and Citigroup.
You're absolutely right, Nicole. And so what investors are looking at this earnings season for banks is to see if they have cut the flow of credit to investors and to consumers, rather, and also to businesses. I'm looking to see if they've made fewer new loans. That would absolutely affect the larger economy in that way. They're also looking at the fact that even before the turmoil that happened in March, all size lenders had been losing depositors to money market funds. But JP Morgan Chase came in above estimates on both parts, earnings per share and revenue, also above for last quarter and last year. But just last month, JP Morgan took in $50 billion in deposits as some customers fled regional banks. That was only for 1 month. Now, deposits did fall 7% for the quarter from a year ago, but they were slightly higher from the prior quarter, and home lending revenue fell 38%. Total loans, however, were up for JP Morgan. When it comes to Citigroup, shares are actually higher today. So were JP Morgan shares on those better than expected earnings. Citigroup also saw an increase in net interest income. Adjusted earnings per share was also above estimates. So was revenue, coming in at $21.45 billion. Citigroup deposits were roughly flat from the year prior, and total loans for this company, for this bank, were actually slightly lower. Net interest income saw 23% increase year over year, and net non-interest income decreased 3% to $8.1 billion in the quarter.
Yeah, I mean, pretty great start. In fact, every single sector is lower today, with the exception of financials on this news, on the heels of these big reports. I mean, this was a record for JP Morgan as far as the quarterly revenue. Financials, the only group in the green today. Let's talk about Boeing. Big news there, and certainly weighing on the major averages.
Absolutely weighing. So Boeing shares are falling today because it's got to halt the production of its 737 MAX, or the deliveries, rather. And it's all apparently because of a parts issue by the company's supplier. Spirit Aerosystems disclosed itself as the supplier. Shares for that company had gone below as low as 20% lower recently during the trading day. And Boeing, they aim to deliver between 400 and 450 of its jets this year, but analysts say that more than 80 of them will have to be pushed back because of this equipment issue, this parts issue. And it's really a hit to Boeing because it's one of Boeing's best-selling business lines. It's happening at a time when Boeing is trying to repair its finances after Boeing had to pause its deliveries.
Tesla moving back above VWAP. Maybe we'll get some kind of move on Tesla.
Jets. And so as a result of this, a couple of analysts are talking, of course, Wolf Research reiterating their outperforming a $240 price target, expecting Boeing shares to find support at the $200 level in the trading session. Maybe not this session, but some session, I should say. And Credit Suisse noted that potential disruption and said that they chose not to change their price target as well in the stock and kept it at a neutral.
All right. Thank you for that. Renita Young, great to see you. Appreciate it.
Me too.
Now let's take a look at the bigger picture. Alexander Reed's with us, Chief Investment Officer and Visitors Wealth. Thank you so much for being with us. So, look, we have a winning week here. In fact, the NASDAQ and the S&P, fourth positive week in 5. But what we are watching is we've seen rates creeping higher. The dollar has been relatively low. And we have that back and forth action as far as stocks has been going. What are you thinking here?
Yeah, thanks, Nicole. So right now, we really think the market wants its cake and to eat it too, right? They're really making an easy connection over recent price action to say, because inflation is slowing, the Fed will then pause, and that's a green light for risk assets across the board. You know, a simple, easy recipe for immediate gratification. And we would say, in a vacuum, that's true. That would happen, but in investing, especially in macro, you know, it's never just one thing, right? So for us at Visit Wealth, we often do a risk management exercise, really examining contradictions around market narratives, and because the market can't have it both ways, right? So for us, right now, there's a couple of them that we call out. Number one, slowing inflation will allow the Fed to pause soon. And we're quick to remind the markets that there's a 60% chance that the Fed's going to raise rates in 3 weeks from now. And then on top of that, inflation. Yeah, go ahead.
No, I was going to say, and that's what I wanted to ask you because we've gotten in those prints on the CPI and PPI and your thoughts on the Fed. I mean, if they raise, which seems most likely for May 2nd, May 3rd, what happens next?
Right. So for inflation in core, we got some comments from a federal.
Newmont trying to push through this 200 EMA.
Core CPI actually accelerated on a month-over-month basis from February to March. It's still at 5.5%. So the Fed's target is 2. So, and then if you look out in the back half of this year, there's a disconnect there to say the market doesn't believe the Fed. They're pricing in 2 rate cuts by the end of this year. And so when we look at that and to say, you know, the market and the Fed don't cut interest rates just for fun. You know, it's usually coincides with some level of economic fragility or rising recession risk. And if the market itself can sustain itself from spring to summer to fall at a 5% risk-free rate, there's really no incentive for the Fed to cut rates. So there's this major dichotomy between what the market's pricing in at current levels and what the Fed is saying and where inflation actually is on a rate of change basis.
So that being said, what do you tell investors at this point? You know, a lot of folks have cash, they pulled out cash, put them in money market funds, but we see and know that these banks have done very well on trading revenue, particularly fixed income trading. What's your advice to investors?
Sure. So there's always a level of uncertainty within the markets, right? And to be an investor, that's normal. It's normal to feel uncomfortable. Right now, there's an elevated level of uncertainty. So for us, driving home to clients, diversification will work. And for us, we think bonds offer a tremendous total return perspective relative to where the market is, the kind of the macro noise out there today. Bonds offer really attractive total return when we look out over the next 12 months. And then from an equity perspective, you know, focusing on high return on asset companies, high free cash flow, from a factor perspective, low volatility, and then from a sector perspective, healthcare, staples, and high quality technology is kind of our focus there. From an underweight perspective, you know, we were underweight, you know, credit, high beta, high debt. Typically, those cyclical type of companies and industries tend to underperform at this point in the cycle as we kind of approach that zero bound on the growth curve.
Yeah, you mentioned some of the sectors like healthcare, staples, and even some tech.
All right, IWM trying to bounce as well.
That we had with the regional banks, a lot of people went to some of the large cap tech almost as value, as a safe haven. Do you see it that way?
That's definitely been the trade. If you look at kind of the distribution of and the contribution of returns of the S&P year to date, you know, there's a lot of figures pulling out the top 10 names, the top 5 names, and if you do that, it kind of reveals that the S&P is essentially flat for the year. And so it's back to that kind of safe haven, high liquidity, and mega cap tech to say if the economy is slowing, that's a good place to hide, which we would favor kind of those mega cap high cash balance sheet companies as favorable, but you have to consider earnings expectations too, right? Earnings estimates for 2023 have come down, but they're still highlighting 0% earnings growth. And if you look at some of the leading fundamental economic data out there, where we are today, and then look back over history, what that has resulted in earnings growth, that would suggest to us around 10%.
All right, Newmont continues to run into resistance right here. IWM, let me just keep an eye on IWM. Trying to change direction. SPY, a little double bottom on SPY. All right, trying for a buy signal here. We're on a buy right now.
When you say recession, soft landing, hard landing, I mean, how long are we looking at and when are the rate cuts coming?
Right now, the market's pricing in 2 rate cuts by the end of this year. Earnings estimates, I suspect that we'll start hearing from news articles, news outlets through this coming earnings quarter about an earnings recession because earnings growth last quarter was recent price run up has been great for equity prices and risk assets so far. But on a go-forward basis, same risk reward just quite isn't there, knowing that such dichotomy between what the economic fundamentals would suggest and then where estimates are. So we'll see and definitely have a better perspective as we move through earnings season over the coming month.
Alexander Reed, Chief Investment Officer, Envisage Wealth. Thank you. Later this hour, we'll be talking Bitcoin. You saw it get up to almost 31,000 this week. Some trends to watch there. We'll also take a look at two brands that you need to keep an eye on. NBA playoffs begin. Discuss whether this should be in your portfolio, what you need to know. And our panel ready to take a look at the
All right, SPY trying to push back towards VWAP. Keep an eye on it.
luxury category that could be at risk of a recession hit. Up next, our guests bullish on CVS Health, shares of a specific regional bank. You'll want to hear more about it. Stay with us.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting drawings, drawing tools, and then type of drawing.
Still not seeing a whole lot of volume coming in.
This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade. It's a 13-hour flight. That's not a weekend trip.
15 minutes from Florida.
You downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight. Thanks. We'll see you.
Slow grind coming off the low.
Choose the app that fits your investing style.
Like to see some more short covering.
Welcome back to the watch list. I'm Nicole Fedelides, live on the floor of the New York Stock Exchange. Take a look at some more movers for you right now. Shares of drug maker Catalent are tumbling toward the company's second biggest single-day percentage drop. That's after it issued a profit warning, citing productivity issues and higher than expected costs. Comes on the heels of the CFO's departure yesterday. Stock is down nearly 55% from a year ago. Also, the downside of a pair of electric automakers. Take a look. Rivian down after Piper Sandler downgrading the shares to neutral from overweight. Also slashing the price target to $15 from $63. Shares are down about 28% so far this year. And the EV maker Lucid also now at nearly a 3-month low after it reduced and reported declines overall. Declines in production and deliveries for the first quarter. On the upside, Hello Group is seeing strong gains after JP Morgan upgrading the shares to overweight from neutral, calling it a preferred stock in the live streaming space. China-based social and entertainment company also saw its price target increase to $13 from $5. Its shares are up 78% from 1 year ago. And Elf Beauty continues the hot streak, rising to new all-time highs after Truist upgrades its cosmetic and skincare company to a buy from a neutral. Truist also raising the price target to $100 from $75, citing its ability to have strong margins while still undercutting competitors' prices. And check out Bitcoin, which has been hovering at the high June, right now at 30,450, down 0.25%. Now let's bring in our good friend David Dietz, Managing Principal and Senior Portfolio Strategist at PPAC Private Wealth Management. Look at the big picture. What did you think about the week that was? Boy, we got a lot of information this week.
Yeah, very volatile. I think the real standout here is a couple things. One is, of course, we've got those key inflation metrics. I mean, the most important one is the headline CPI number. That was 5% lower than the prior month. When you think back to last summer, that was between 9 and 10%. So definitely look at the headline number. We're making great progress. The next day, we got the producer price inflation numbers. Those showed actually deflation taking hold last month. Obviously, what you're paying at the wholesale level is going to start to translate into the retail level. So I thought we saw some great signs that inflation is starting to cool. And of course, that was followed up with the unofficial start of earnings season this week. I mean, the biggest and the best among the banks, JP Morgan just knocked the cover off the ball. What better indicator for the U.S. economy is JP Morgan? It also, I think, showed how pessimistic Wall Street expectations were for it to rise 6 or 7% like this. So I think we've gotten off to a decent start here.
So what's your strategy? I mean, even though there are people worried about a recession, worried about testing new lows, do you have a strategy?
Yeah, well, first of all, I try and keep my clients upbeat. I tell them there's no better point to put new money in when everyone else is pessimistic. Why is that? Because prices are lower. I actually like the fact that earnings expectations for this quarter are for the second quarter of the year down 5%. When earnings expectations are low, companies have a better chance of beating, and that's, I think, what we saw with some of the banks. And I mean, you know, the Federal Reserve has been doing its job. Kudos for seeing that inflation cool. But, you know, you can quibble as to whether their job is going to end with like quarter point hike in May, maybe one more in June. But the fact of the matter is we're very near the end of the tunnel. Even its own staff said, look out for a recession in the second half. So I think the Fed is going to, at worst, pause very shortly here, and at best may actually be cutting rates in the second half. And of course, once stocks really fully digest that, I think we can move forward here.
You know, that's amazing. So even cutting this back half of this
SPY continues to push a bit higher now.
Sooner than later. That being said, when we get to stock picks or themes, regional banks have been on your mind. You're watching KeyCorp, for example. Tell me about that.
So, you know, everyone loves the big banks because they see everyone being nervous about the smaller regionals. But what we've done here is taken a fine-tooth comb and looked at some of the very best regionals that are being sure survivors and are now just trading at pitifully low valuations. So let's take KeyCorp. You know, it was founded in 1849. It's seen some tough times, the Civil War, the Great Depression, you name it. It's been through that before. $170 billion in assets spread out over 16 states. What I like here is two things. One is a middle market bank. So if you're a mid-sized company or a mid-sized consumer, you know, you may say JP Morgan is the safest place on town, but try and make an appointment with them. They don't want to talk with you because you're not big enough. There's certainly a room for a place like KeyCorp. Let's look at the valuation. It's down 45% from its recent high. This is like $12 stock should earn $1.74 this year. Trading about 3 times cash flow, below book value. And of course, let's look at dividends. There's nothing like a dividend in volatile times. Your dividend is just under 7%. It's only a 42% payout, so there's room to run. And over the last 5 years, it's increased at 14% annually, plus earnings growth up over 11% annually. So I think KeyCorp may have been thrown out with the bathwater. They diversified, pick up a KeyCorp to take advantage of this regional bank sell-off.
All right. And then we turn our attention over to the pharmacies and health. And by the way, I mean, I saw Merck at a new high today. I mean, there are a lot of names that are hitting 50.
Tesla above the VWAP and continues to push off the lows now.
Well, first of all, it's a market leader. In Walgreens, there's a duopoly out there in terms of which drugstore you go to. But of course, CVS is much more than a drugstore. It owns Aetna. We just got a good earnings report, of course, from United Healthcare. So Aetna's probably going to have some tailwinds there. This is also getting into the stores take advantage of another way to reach out to the customer and so forth. But look at the valuation here, Nicole. I mean, it's down 1/3 from a recent high, 40% from its all-time high. Are those sell-offs justified? Well, I mean, they're going to earn $9 a share this year. It's a $74 stock.
IWM trying to gain some traction here. IWM.
They've got so many levers to reduce costs if they have to, buy back stock, do other things. Of course, if recession is front of mind, what is less prone to fall out from recession than healthcare? You're not going to not go to the drugstore if you're not feeling well due to weakness in the economy.
Any other themes? I mean, we talked about some of the banks today that came out. I mean, BlackRock had its profit drop about 19%. JP Morgan record quarterly numbers. We showed Rivian and Lucid down today. Boeing's under pressure when we think about industrials or aerospace. Tech was a safe haven to a certain extent during the weakness that we saw in regionals. Any other themes that you would say, hey, I sort of like this group, or any other thoughts for investors, ways to make money?
Yeah, I'm not going to name any specific names, but we like the REIT area generally. Now, that has historically been a hedge on inflation. You've got real estate, of course. If I'm right that we're closer to the end of interest rate hikes, if interest rates that stop going up or even come down because they're leveraged, I think that will do well. People, again, are going to be looking for dividends if this market gets volatile going forward. The REITs, of course, there's no tax at the corporate level, so all their cash flow comes out as dividends, so they have above average dividends. There is some genuine concerns in the commercial real estate area. I get it, but there's no reason that it should have infected the whole sector. So companies that are focused
All right, starting to catch a bid here. SPY.
and are trading well off their highs. Historically, the REITs have actually outperformed the S&P 500 through thick or thin over the longer period of time. Haven't for the last 18 months. This could be a good time to take positions.
All right, David Deast, wonderful to see you. Thank you, Managing Principal and Senior Portfolio Strategist at PBAC Private Wealth Management. Thank you. Coming up next, we'll discuss the outlook for Bitcoin after returning to the 30,000 level. Is the crypto winter over? What do we need to know? Coming up.
All right, SPY's just about ready to hit VWAP at this point.
Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding, technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcast and start learning today.
All right, watching SPY. Thank you, Corey. Yeah, I was looking at that too. SPY divergence on RSI on the 5-minute. Okay, we made that low, and RSI made a higher low and continues to push higher now.
When traders tell us how to make thinkorswim even better, we listen. Like Jack, he wanted a streamlined version he could access anywhere, no download necessary. And Kim, she wanted to execute a preset trade strategy in seconds. So we gave him thinkorswim web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on Trading Name.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to the watch list. I'm Nicole Fedelides. Time for our spotlight today, focusing on crypto. And for that, I'd like to welcome in Todd Groff, Head of Research, CoinDesk Indices. Thank you it's sort of held its ground. It's been less volatile over the last 52 weeks than some of the other trades. What say you as we see it move to these levels above 30,000 for Bitcoin?
Yeah, well, thanks for having me, Nicole. Again, it was a very eventful week, and that real
Trying to get through VWAP now.
level on Bitcoin is it's a real psychological barrier.
Tesla's starting to motor higher.
This week, we continue to see that trend that emerged post Silicon Valley Bank in mid-March. That trend continues to persist, and with that, we have positive momentum across the digital asset space. Not only Bitcoin, but some of the altcoins, Ethereum as well. It's been a very confirming of the core tenets of both Bitcoin and Ethereum. This week too was also very meaningful because we went through an update on the Ethereum network. It was called the Shanghai update, and what this basically does is we went from originally a proof of work mechanism, which had a lot of energy intensity about securing the Ethereum network. When we moved to proof of stake, what resulted in is, in order to secure the network, you needed to lock up capital in the form of Ethereum Ether token into these staking pools, which would secure the network. Well, this recent update allows users to stake or unstake their tokens, which improves liquidity for any sort of Ethereum stakers. And with that, we had a little bit of fear that when stakers could unstake as of Wednesday onward, that there would be a lot of people unstaking their Ether tokens, and that would be liquidated into the market. That did not. We went through the event, went through the update, and that did not come to pass. And so with that, we had positive sentiment leading into the event.
All right, IWM starting to gain some traction too. IWM, so the Qs. All right, the Qs showing some nice action here. Watch all the FANG stocks. All right, so a pretty decent afternoon session. We've got Apple, Microsoft, Tesla, Meta, Starbucks, Google, everything pushing back towards the highs.
What's interesting Bitcoin specifically is that we have to keep in perspective here. This is a relatively new asset class, and so with that, there's a lot of people that are sort of wait and see types. So we'd like to think when prices are lower, there's more demand as you want to buy on the dip. But really, what we have is we have people waiting and seeing, waiting for prices to confirm their belief in the asset and in the concept. And so with that, again, that 30,000 barrier is psychologically very important. With the Ethereum upgrade, we pushed past 2,000 on Ether price, and so those are really helpful. And what it basically does is everyone's starting to watch the space again. When we were down at lower levels, there was less interest. People had, for better force, unfortunately allocated at higher prices, and they didn't have the confidence to buy in at more attractive prices. As we move higher, we then start to generate more interest in the space, and everyone that was on the sidelines waiting for certainty to come about is having to buy at higher prices.
All right, we just tagged VWAP.
Any relation at all? You know, we always used to say, what drives Bitcoin? You know, there was a time we were watching it as the inflation hedge, then it was a risk on, risk off. You know, when the markets are off, it was off. And right now, as we are likely to see a little bit of a rising rate environment, this is, you know, consumer sentiment came in and showed inflation expectations markedly higher than expected. And so rates have crept higher. And so the question to you is, as rates move, what happens with Bitcoin? Can people sink their teeth into any part of this as far as how it moves? And is it something they should own for the long trend? I mean, who says what and why they should?
it's what we're finding, and this is
All right, Apple going here. Apple.
this year is that Bitcoin and gold are sensitive to real yields. So that's basically the nominal rate of interest, and then subtract out the inflation expectation. And generally, the market uses tips, the break-even yield on tips as a proxy for inflation expectations. What we saw in 2022 was the Fed increasing rates, market-based expectations remaining about the same, and as a result, real yields increased. When you have real yields increase, if you think of your capital allocation market line, you start to have lower risk alternatives to generating returns. You actually have fixed income. Fixed income reemerges.
All right, SPY beginning to push through VWAP.
Offer a pretty attractive yield with very low risk. And so when that occurs, you start to have a grouping of all assets that require higher prices in order to generate return, and then you have a reemergence of income, of inflation-adjusted real income. And so that was basically what happened in 2022 was Bitcoin, Ethereum, digital assets, SPACs, growth-oriented equities sold off together as investors rotated into income that had reemerged on a risk-adjusted and an inflation-adjusted basis. Now, looking forward to this is with post SVB, we've seen a change in interest rate expectations, which are suggesting to your previous guest, David, that we are towards the end of the hiking cycle. And with that, real yields are going to be roughly pinned at these current levels. And therefore, we're back into the tech trade, we're back into growth-oriented equities, and we're back into Bitcoin.
Todd Fromm, thank you so much. Head of Research, CoinDesk Indices. Thanks for being on the show. Appreciate it. All right. Still ahead in the second half of our show, the NBA playoffs kick off this weekend. And we will take a look at Pepsi, DraftKings, what the spotlight could mean for some of these big companies, very different companies, but big ones. As we head to break, take a look at winners and losers in the S&P 500.
Tesla. Nice move on Tesla.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert.
Nice evening session rally.
Even better, and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Before diving into the markets,
Morgan Stanley moving back up towards the highs.
newsletter, videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house.
IBM's about to go green.
U.S. economy. Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Welcome back to the Watch List. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. It's Friday, and market indices. 4132 for the S&P, Dow's at 33,847. Those are losing a third of a percent and a half a percent.
A little bit of profit taking, Tesla.
Nasdaq's down a third of a percent. And
190 is where all those calls were for today's expiration. I imagine many of them got taken off earlier. Was it Wednesday or Thursday? So we tagged 190 on Wednesday. On Monday, we saw a lot of Tesla 190 calls trading. So most likely those are out. They're out of those now.
Nowhere near as much as at the pump, right? We've seen that continued rise. AAA's been reporting, and I think keeping a close eye on it today, up to 366. A pretty regular trend to the upside, whether you're talking about up from yesterday, up from last week, up from last month. Now, we are still down from last year where we were, but I think a lot of the bid activity we saw today, Nicole, look at this, up to 82.53 right now, about 0.5% to the upside. But this week to 83.50. The bid activity, weak dollar, also the IEA, OPEC, and the EIA this week. But let's begin with the IEA. Today they said consumers are confronted by inflated prices for basic necessities will now have to spread their budgets even more thinly. They said this augurs badly for economic recovery and growth. They were talking about the OPEC cuts basically recently and how that's going to pull some of the supplies away. They said with demand rising, continuing to increase the remainder of the year, we're expecting renewed inventory draws and upward pressures on prices. They said that they were already expecting to see a shift into deficit in the second half of the year. Now with these cuts, that actually accelerates that. They expect that to happen much earlier. So again, I'm not surprised to see prices on the rise here today.
Meta trying to continue on this quest for higher highs. Meta. Higher highs, higher lows. Meta. Meta trying to get back up to those 222 level from earlier.
Similar situation with the dollar weakening. We saw gold benefit from that. This has been kind of in line with the trend. A lot of people keeping an eye on gold, supported recently around 1900, back up through 2000. But, you know, this bid really came into play. If you look at the chart, I mean, we're going back to there it is. I mean, the fall of last year, we bottomed out around 1630, 1640. Look at the V-bottom type pattern after selling off into those lower levels into the fall of last year. As rates have come off, ultimately, the U.S. dollar came off. I mean, when gold was down at 1650 down there in the fall of last year, that triple bottom we're looking at in the middle of the screen, we had the dollar up around 114. The dollar this week down to 101. I mean, so significantly, and through the middle of the range that we established last year, well off that 114 high. That's all going to support, again, as I mentioned a minute ago with crude, definitely seeing that with the gold prices as well. Nicole, the bulls want to see this thing up above 2,100, though. We have that all-time high up there from August of 2020. That's the next big hurdle.
All right. Thank you for that.
Just looking for Netflix to go green. We'd have all green otherwise.
Thank you. Now let's shift our focus and talk about basketball. Well, look, the NBA playoffs begin tomorrow. Let's go Knicks. All right, whatever team you vote for. But in the meantime, joining me right now to talk about some of the brands to watch, and this is the big stage, right? Justin Heller is with us, founder and president, Heller Private Wealth. Thanks for being with us. So, I mean, this is big business, and that's really what it's about. You have a couple of names to watch, and one would be Pepsi. Why is that?
Hey, Nicole, thanks for having me back. As you said, with the NBA playoffs coming up, it's the big stage, and one of the brands that we can expect to see a lot of is Pepsi. So Pepsi owns Gatorade, Pepsi, of course, Mountain Dew, Doritos. And based on what's going on right now, we've seen a lot of volatility. We've seen some positive signs, some negative over the last couple of days. Pepsi's just been a defensive company. They've been slow, stable, and steady through both some ups and downs. I mean, last year, roughly 7% return. This year, up about 2%. So, my opinion, I mean, I like to be in more of a defensive, stable name when there's a lot of uncertainty out there right now.
Yeah, and you know, Pepsi has shown its colors. I mean, some people would say it was a snack company because you mentioned Doritos, but the truth of the matter is they do very well with snacks. snacks, and these are somewhat type recession resistant, I guess you could say. But with the reopening of venues, that's got to be a good thing for PepsiCo. Final quick thought there.
Yeah, absolutely. I mean, it is. It's a snacking company. It's a cola.
IWM turning the corner, not quite there to VWAP. Whereas we had a nice rally in SPY to VWAP, got rejected 412. That's the call wall 412.
So another name that you're watching here is DraftKings, and as things kick off and the betting begins, tell me a little bit about this name.
Yeah, so DraftKings to me is kind of on the opposite side of the spectrum. So this is a name that we saw roughly 60% loss last year, and now up again roughly 60% so far this year. So a high flyer, expect to see a lot of ads from the sports gambling companies, and of course the big question mark for DraftKings is when are we going to get legalized in certain states? I'm based in Florida. I'm from Florida, and Florida is projected to be one of the best sports betting markets in the world once legalized. So there is a lot of upside there with DraftKings. I'm sure they're going to make a big push with the playoffs, but that is not quite so defensive and slow and steady like that of Pepsi.
All right, and look, yeah, you're right. I mean, it's up 66% this year. That's no joke. Everybody would be happy to have that kind of return. That being said, let's talk about any other names or brands that you're watching closely that could show up in the big games.
I don't have any other brands that we're focused on or watching closely. I'm curious to see if we're going to see a big crypto push this year. This point last year and years past, crypto is starting to take over in the advertising space. So after what's gone on, not sure if we're going to see some advertising from them, but we'll find out this weekend. And some other exciting news in the NBA world is the players and the league finally came to an agreement on a new collective bargaining agreement. So some new interesting details have emerged there. And then, of course, the most exciting part is the actual games. And your recent guest, Giannis, looks
IWM trying to push higher.
Oh, he's amazing. I mean, we absolutely love Giannis. We loved having him on the network. The truth of the matter is,
SPY trying to get through VWAP here. If we get through VWAP, we could see a nice little rally up. Earlier we had 415. That would completely change the complexion of what today's trade seemed to be saying. All right, so this looks completely different than it did earlier when we were down here near 41 or 4120 or so.
They have some new interesting things that they agreed on. There's supposed to be an in-season tournament, which I'm not sure how that's going to shake out, but if it's anything like the NCAA tournament, it should be exciting. They have put a cap or a restriction on load management, so if you want to qualify
All right, SPY trying to push through VWAP here.
65 games, which I think is also a good thing for the fans to see. And they've added some salary cap restrictions, luxury tax, things like that. So it's just good to get this out of the way. Now we know there's no lockout for another 7 years, and hopefully some of the changes are good for the league.
all right, Justin, that was great. Do you have a favorite quickly or no for the games?
I'm rooting for the Brooklyn Nets. Not your Knicks, but the Nets. I like the Nets.
No, I like the Bucks a lot. And the Knicks.
There, we can agree on
Justin
that.
Heller, founder and president, Heller Private Wealth. Thanks, Justin. Still ahead, we bring in our panel to discuss April's consumer sentiment report, the category that you may want to watch in there, and the demographics. What could be the prediction here that we need to know?
Still rejected at VWAP. Got to get above VWAP if we got to have any chance of rallying at all today. Apple and Microsoft trying to build a higher low and a higher high. Meta continues to press up against the highs of the evening session, and Tesla looks like it might want to go. Google is about to push again. Google.
Stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the Income Investing course and a whole lot more. Binge watch the market with TD Ameritrade Network. The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on TDAmeritradenetwork.com, all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and
Meta going.
the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is, how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish. So looking beyond direction to consider the impact of implied volatility.
SPY trying to go right now. SPY's trying to push through this level. I might buy some calls for a quick scalp. Maybe the 413s.
Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Welcome back to the watch list. It's time for our panel. We want to talk all about the consumer sentiment number, hot on the heels of this report that showed it edged up in April. But the thing that really grabbed folks' attention were the expectations for the year ahead, where the bets were 4.6% for inflation, and that was up from 3.6%. Pretty big move, and that spooked the markets. Eddie Young's with me, founder of Eddie Wood Grow LLC and co-founder of Category Pirates. Also, Ted Rossman, senior industry analyst at Bankrate.com. Thank you both for being with us. I mean, certainly that inflation expectation was something everybody on Wall Street was talking about. Eddie, what stood out to you?
Well, I think some inflation pricing is still lingering. People are still worried about it. I think we talked about earlier in the Nicole, that it would be a roller coaster with consumer spending. So you can see people feeling it with gas prices and energy prices coming down, as well as used car truck and prices. But food prices are still rising. Rent is still an issue. And so that's why we're seeing retail spending fell 1% in March. And I'm seeing other discretionary spending like TSA travel passengers is actually down a little bit in March and April, whereas it was up in January and February versus 2019. So it's a bit of a concern that we have to watch for.
And just when they start to feel better, they feel worse again. Ted, explain that.
Yeah, I think a lot of this tracks back to that K-shaped economy that was true even before the pandemic, but I think has accelerated during and now after the pandemic. I mean, it's something.
Come on, SPY.
Respects. There are definitely some recessionary behaviors going on now, especially among people with lower income.
Microsoft and Apple would certainly help the S&P if we do pop. Those two pop, along with Tesla, Meta, Google. Need to see the Meta. Google's still going here. Meta pushing up against the highs of the evening session.
I think that speaks more to higher income folks. You know, there is still some excess savings out there, but it's at the higher end of the income spectrum. Lower income folks, unfortunately,
Caterpillar.
on the newer things. So categories that are completely different that they haven't spent on before. Things we've seen like ChatGPT has gotten to 100 million users in 2 months.
Chegg.
Record.
That broke higher yesterday. Chegg. Starting to push a bit higher. Chegg.
Yeah, and as we look at the different sectors, Ted, what are your thoughts as you go sector by sector and where we might see tightening or growth?
I think services remain hot, so I still think there's a lot of pent-up demand for travel. Last year was kind of the summer of pent-up demand, but that's still there this year. And in fact, international seems to be doing even better than domestic this year. So there's still some room to run there. It really shows in the retail sales numbers that bar and restaurant sales continue to pop. Another sector, really the only other one that did well on a year-over-year basis in the latest retail sales report is e-commerce. That one surprises me a little bit because, one, we kind of thought that trend was largely played out, and two, we keep hearing about services and experiences and less about physical goods. So there has been a pullback on spending on certain physical goods like cars and electronics and furniture, but e-commerce is still strong. You have to wonder, maybe people are buying things that support all these trips and meals out. Maybe it's new clothes and luggage and things like that.
Right, understood. As you mentioned, luggage, I'm thinking about Louis Vuitton. I see the suitcases, I see the bags. A terrible occurrence abroad at the LVMH headquarters. That being said, Eddie, you mentioned some of the luxury goods, and LVMH specifically is something to watch. Why?
Yeah, no, they had
the industry is just not following through.
for them. One of the things that I did notice was that the CFO did say.
All right, Google's still going though. Google still going.
It would appear that the Chinese consumers are really driving their great Q1. So those consumers are coming out of lockdown and are spending maybe against some of that pent-up demand that Ted was talking about. The part that I am worried about as a harbinger of what's to come is Bain says that they had a forecast that personal luxury goods would rise 3 to 8% this year, which is down from 22% last year. So I still think that people are going to spend. I agree with Ted around services and experiences are going to be hot. I think things that are more digital in nature versus analog will probably also be hot as well, just because of all the things of courses that you can buy that are digital and transformation versus kind of physically being in school and education. These are the transformations that I'm seeing sector by sector. So services and experiences and digital versus not.
Right. Final thoughts here, Ted. As you mentioned, this mixed bag of reports, and the Fed is likely to raise in May. Where do you see the optimism?
I do think, unfortunately, that it's increasingly likely that we're going to get a recession later this year, hopefully a mild one. I mean, maybe there's a bit of a silver lining in there. And also the fact that that could finally break inflation once and for all. I think we are getting closer to the end, not just of this hiking cycle, but also, we did get some good news this week on both CPI and PPI. It feels like the Fed's medicine is working. Inflation is coming down. There are, of course, consequences to that, potentially a higher unemployment rate. We know all about high interest rates pinching credit card borrowers and the housing market, but hopefully we're starting to see some of the light at the end of the tunnel.
Yeah, final quick thought, Eddie.
Yeah, I agree with Ted. If the sooner that they can come down with interest rates, the less incentive consumers will have their money in savings accounts, they're going to go back and spend. So this is largely in the Fed's control. Hopefully they respond as quickly as they did rising it this time, which was a big change from the slowness that they had to respond to the first place. So.
Thank you for that. Eddie and Ted, always nice to have you on the show. Thanks so much. Eddie Yoon, founder of Eddie Would Grow, and Ted Rossman, bankrate.com. Thank you both. That's going to do it for us here on the watch list. Thanks for being with me every single weekday at 11 a.m. and 2 p.m. Eastern Time. I'm Nicole Petalides, live at the New York Stock Exchange. Thank you for watching, but keep it right here. Market on Close is next.
All right, Google's still going a bit more. Google.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast.
Google's still going, pushing higher.
Demo webcast tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to TDAmeritrade.com/webcast and start learning today.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street.
Google running like it did last week when we closed early. Markets moved higher, and Google ran.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then watchlist. When the default list appears, select the name box, then create watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watchlist, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then add to watch list. From the Scan tab, right-click a security and then add to watch list. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on TDAmeritrade.com.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Google's still going, trying to get through this 110 level. Would be nice, Google. Google looking very good end of day. Starting to push higher. Trying to get through this 109, 110 level.
Strategies is here. She says economists and the Fed predicting a mild recession are being very optimistic. Michelle Gibley and Kathy Jones from Charles Schwab will break down the latest economic picture as banks kick off earnings season. And I'll speak with the CEO of Family Financial LLC about where investors should be looking for opportunities right now, given the fundamental picture. With 1 hour left of trading, let's check in on the markets. We're seeing red arrows across the board. The Dow off 186 points right now, or about 0.6%.
investors were looking for any signs that banks were not granting or granting fewer new loans, and that would impact the larger economy by reducing the flow of credit to consumers and to businesses, right? And so already banks had lost depositors, banks large and small, by the way, had lost depositors to money market accounts because they were able to offer higher interest rates after the Fed fund rates had been boosted, right? But when it comes to these banks, some of them were higher on the better than expected earnings earlier today, and they actually came a little bit down. Some are in the negative now. They were caught off guard by consumer inflation expectations running wild, some hawkish remarks from a couple of Federal Reserve officials, and an overall rebounding in consumer sentiment earlier today. We saw the financials was the only sector up, but right now consumer sentiment, consumer discretionary has climbed since then, along with a few other sectors. But looking at earnings, PNC Bank was the first regional bank to report earnings earlier this morning. Earnings per share revenue came in, earnings per share above expectations. Revenue came in right at that estimate. Both of those measures were above last quarter and last year, and investors saw it as a good thing. Average deposits for PNC increased by 1.3 billion to 436.2 billion. When it came to JP Morgan, it was better than expected earnings as well. We saw earnings per share above estimates at $4.10. That was above last quarter and last year.
All right, VIX is trying to turn the corner.
$0.3 billion also above estimates. But just last month, only 1 month, JP Morgan took in $50 billion in deposits as some customers fled the regional banks. But deposits on a whole for the quarter fell about 7% for JP Morgan during that quarter. Net interest income, however, did see a slight increase, and not just a slight, it was actually up about 48% during that quarter. Let me move over to Wells Fargo briefly. The earnings came in better than expected, topping estimates as well. The earnings per share.
All right, no follow through on SPY or IWM yet. All right, a little profit taking there. On Google, a little profit taking.
Shares have been coming off of their highs of the day for banks. Right now, adjusted earnings per share came in above estimates at $2.19. Revenue also above estimates at $21 billion. Citigroup deposits were roughly flat from the year prior, but total loans were down, and net interest income saw a 23% increase. So as you can see with these bank earnings, most of them were considered better than expected, but we did see different expectations when it came to the net interest income and when it came to the amount of loans that these banks were actually able to offer during that quarter. And that may also make the difference as well when people are looking at these stocks longer term.
All right, thanks so much for that breakdown, Renita. So Kevin, obviously a lot to kind of digest here, but taking a look at the share reaction, Citi and JP Morgan quite a bit higher today. Wells Fargo essentially flat, basically a little bit negative right now, but PNC kind of took a turn or took a dive, even though it actually seemed pretty good. What happened there? And I guess, can you glean anything about these results as you look ahead to next week, especially as you think about the regionals? Because I know PNC is kind of a super regional, right? It's bigger, it's considered higher quality. So can we extrapolate anything as you look ahead to next week in terms of betting?
Apple's still trying to do something here. Apple's still trying to push above VWAP.
Smaller to bigger, Caroline. They're going from cash to money market, and that's the way the cash is traveling. What does that do to the overall banking system? It's hard to say going forward, but if you look from a macro perspective as we move into next week, the banks will keep coming. We still have Goldman Sachs, we still have Bank of America, we still have some banks at the beginning of next week.
Looking for Apple to push through this level.
Next week, today was the unofficial start of earnings season when we got the banks.
Wednesday will be a good name, but this is still a market where the macro and the micro are now combining. Right up until now, we've been dealing with the macroeconomic effects of this market, of this economy. Now we've got to do both, right? So when you look at this market from a macro perspective, the dollar's higher. If you look at yields, they started the week below 3.3. Now they're going to finish the week, over 3.5. That's tough on stocks. The dollar, which has been trending lower, is firmer today. That's tough on stocks. Crude oil has rallied from $70 to $83. That's going to affect the overall economy. So there's macroeconomic factors on the economy. Micro is the individual names. We'll get more next week. This is going to get fun, Caroline, and the pace of earnings is only picking up. So there's more to come. Some of the VIX might be a little Friday. I would expect the VIX to be higher on Monday as they take days out. It's a little Friday-Monday relationship between the markets and VIX, but all things considered, Caroline, we went from slow earnings and none. It's coming like a fire hose starting Monday.
All right, I'm tired just thinking about it. So, Renita, Kev mentioned, I think he said 67 other names are set to report next week. So it's not just the banks. So he mentioned Tesla. We'll be focusing on margins, of course, for Tesla, but Netflix.
All right, a little bit of selling in the day. SPY fading a bit. All right, so we got rejected at VWAP and we're pulling back.
Sharing crackdowns. Those will be the two major themes. And all for the past couple of weeks, analysts have been split on whether or not either of these things will translate into higher revenue or it would scare some subscribers away. UBS believes the first quarter is going to show some continued progress toward that reacceleration of growth, but he feels like Netflix is going to face some headwinds from the password sharing crackdowns. Now, Citi says that the quarter may be confusing because of crackdowns as well as that ad-supported tier, but believes that the password crackdown will not result in incremental revenue and that the ad tier instead is going to add about 65 million subscribers with average revenue per user above video on demand levels, right? But then Benchmark said something totally different this week, saying that the Netflix crackdown on password sharing will likely boost the average revenue per available member. So analysts are all across the board on what these two major things could do to this stock and how it translate into this next earnings report. We have it coming on Tuesday, April 18th, so I'll definitely be watching.
All right, thanks for that update, Renita. And Kev, we mentioned Tesla. Of course, I kind of gave away the lead by saying margins are, of course, maybe in doubt, in question. It's something that we talk about all the time, I feel like, on Fast Market. So tell us what your expectations are for Tesla. We're seeing shares lower today on news of additional price cuts in Europe and Singapore and Israel, right? So further calling into question what cost do those price cuts come?
Yeah, exactly. Here's the good news if you're watching Tesla. They still have the profit.
All right, so momentum indicators are turning over into the evening, late evening here. We got a little bit more than 45 minutes to go. And muscle and tick cumulative are starting to turn lower again. SPY rejected.
We'll see if that plays out, though, Caroline. There's a lot. Obviously, Tesla's earnings are on Wednesday the 19th, so that's coming up in the middle of next week. I expect that to be an action-packed day, Caroline.
75 basis points. All right. Thank you both so much. Renita Young, Kevin Hanks, appreciate you recapping today and
All right, so fading a bit more now. SPY fading a bit more. Get the bulls off sides. Rejected at VWAP. Rejected right at VWAP, the blue line. So we tested 410. We felt we could get down to 410. We did that.
Low ticker 9 is 800.
So dealers have to unwind their 0-day after 2:30, 0-day options. Dealers unwinding. So seeing this last 45 minutes, little dip now.
Extreme low ticker.
Yeah, I want to talk about that because you're essentially saying that a mild recession is wishful thinking at this point. Why? And what do you think is in store if it's not a mild recession?
I'm not necessarily saying that a mild recession is wishful thinking. I'm just saying a mild recession is not something that we should bank on because when we go into a recession, it's hardly ever mild. I don't know that people really recall a recession being particularly mild. And at the same time, what we're going through right now is a massive transition in the way our economy works. We basically have a lot of inflation after many years of having almost no inflation. We also are transitioning in terms of the way we work. People going to the offices versus working from home. And then on top of that, we have a transition in terms of quantitative tightening, also coupled with a fiscal drag, right? A lot of the stimulus that we've been having in terms of SNAP benefits, unemployment benefits have rolled off. So all of that put together, in addition to this mini credit crunch that we're getting in the banking sector, is not going to be very easy for the economy to navigate into a mild recession. But the good news on that is that after last year's equity moves, the equity markets have priced in some form of slowdown, right? A lot of this has really been priced into the market. And so I think that if you want to stay invested in the market, just look for what's priced it in, what's cheap, and ride it through. And I think that would actually be okay for investors. It's not going to be the kind of bull market we've had, but it's not going to be a terrible outcome overall.
So as you look for investment opportunities in the current market, what's cheap to you? What looks attractive?
In the U.S., certainly value stocks look attractive, but if you're willing to bear the volatility, small cap value is particularly attractive. These things have been really beaten down last year, continue to be beaten down this year. You're getting a lot of companies that trade in single-digit multiples here that actually have reasonably high-quality businesses. So that's an area that I would really encourage investors to look at.
So small caps, even if this economy is heading into what might not be a mild recession, wouldn't small caps get hit the hardest? Or you're saying that that's already been priced in with last year's declines?
Oh, so that's a great point. I actually think that that's already been mostly priced in with last year's declines. So when you look at small caps, one of the things that's really important is when you go into a recession, they can do okay. They can do okay. But what you really need to be careful of is the quality of these stocks, right? And so you need to compare not just are these stocks cheap, but are they stable? And so one of the best things that I think to do is to hunt for value in small cap, but at the same time pair this with a screen that basically weeds out the worst quality stocks. That's certainly something that we really advocate, particularly within small caps.
Okay, and areas to avoid, you say commercial real estate and banks. I'm curious about the banks call. Does that mean you think that there's more shoes to drop in that camp?
So I actually think that the commercial real estate conversation is something very interesting, right? I mean, I think if you looked at bank earnings this morning, all banks came out, all the banks that announced this morning came out with earnings surprises to the upside. And most of the shares rallied. I mean, you saw Citigroup shares rally, JP Morgan shares rally. And at first, Wells Fargo shares rallied. Then as you went throughout the day, that rally kind of petered out. And they were actually down for a bit of the day before coming back to relatively flattish. And if you take a look at, what is the difference there, there was a lot more focus at Wells Fargo, for example, on their commercial real estate loan book. So I do think there are more shoes to drop in the commercial real estate. And I think that the banks that are most exposed to commercial real estate could get hit in the coming quarters. There could be an extend and pretend, but at the same time, they're also going to have to be higher provisions for loan losses in that area.
So you'd be avoiding all banks altogether, or just those with more exposure to commercial real estate?
Definitely those with more exposure to commercial real estate. I think that those that actually have a managed book on commercial real estate have really, with the SVB, Signature Bank failures, a lot of banks have been, the baby's been thrown out with the bathwater, right? So a lot of these banks are trading at single multiples.
All right, VIX dropping off.
That don't have these kinds of exposures.
Google bouncing.
Those are reasonable places to invest for the long term. Reasonable places to hide out. I mean, we as a society need banks, right? We can't function without banks. These are businesses that have a place in our ecosystem. You just don't necessarily want to be in the ones that get stuck with a poorly managed loan book or a poorly exposed loan book at this point.
All right, appreciate you offering your takes. Kuei Win, CIO Equity Strategies at Research Affiliates. Thank you so much for joining us.
Thank you.
Coming up, we're talking to Dave Hardin. He's the CIO of Summit Global Investment, and he's a big fan of investing in ETFs. In turbulent times, we'll find out more when Market on Close returns. Stay with us. We'll be right back.
All right, continue to push a bit lower.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the options for volatility course, we explore what implied volatility is, how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish. So looking beyond direction to consider the impact of implied volatility can help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the education tab on Thinkorswim for the full options for volatility course and a whole lot more.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Welcome back to Market on Close. I'm Caroline Woods, filling in for Oliver Rennick. It's time to bring in Dave Hardin. He's CIO of Summit Global Investments. He joins us from the NASDAQ. Dave, thanks so much for joining us. Really good to have you here with us.
Thank you. It's glad to be here. I'm glad to be here again.
So, Dave, before we get to your investment strategy, I just kind of want to get your sense of the market right now. We're starting to see the pieces of the puzzle come together. We have inflation easing. We have banks reporting better than expected earnings. We have job growth moderating. You know, some of these reports that we were really anxiously awaiting. I guess, how are you looking at the market, the current landscape right now? Are there more reasons to be bullish or bearish at this point?
I don't know if there's more reasons one way or the other, but definitely you have to be cautiously optimistic, right? It's good to be optimistic. I think it's good to be invested in the market, but the reality is that you have to go in with your eyes wide open. There is definitely the Fed, and what the Fed's doing, they're kind of easing on one hand underneath the covers, so to speak, and they're tightening on the other. So there's a lot of uncertainty with the Fed. Yes, we had some good numbers from inflation, but let's face it, there's still some sticky numbers from inflation, right? So it depends on which one you're looking at. And I think that the big tightening and the raising of interest rates is behind us, but how long is it going to stay with us?
Plus 800.
Us even more. They say, keep raising until something's broken. Well, we had that happen in March. We all know that, and we all felt that. So the reality is there's still some negative things out there with earnings and with
VIX dropping off. VIX dropping off.
Fourth quarter that we had since the great financial crisis. So there's still some problems in the system that need to work themselves out. But I'm cautiously optimistic that now you should be invested.
All right, I want to get to reasons that you're cautiously optimistic in just a second. But first, given all of those risks, what do you think the biggest risk is right now?
I think the risks is the things that you don't look at, you don't understand. I think the more you understand the risks that are in your portfolios, the better your portfolio will perform as you hope and expect. So the biggest thing is the things that you're not aware of, that you're not looking at. For example, maybe investing in companies that you're not looking at the downside risk of those individual companies. Each company has their own individual risks associated with it. Are those risks good? Are they bad? And so we look at SGI at the factors that contribute to downside risk within these different stocks. And I think you have to be very careful of what you invest in, because you can think you own one thing and happen to own something quite differently.
All right, so given that you're cautiously optimistic and think you should be invested, how are you approaching this market right now? Where do you want to invest? Where do you want to avoid?
Yeah, I think let's talk about the avoiding, because you win by not losing, right? So one of the things you got to be really careful of, for example, is your financial exposure. You can think you're in high quality financials, which is really, really where you want to be right now, obviously, because if you look back into the great financial crisis when we had another banking failure, it started this time of the year. But, it really didn't explode until August and September and throughout the fall. So is there more, so to speak, things that can fall in the future, banks that could possibly get hurt in the future? The answer to that is yes. We're not through that. So limit your exposure to financials, because as your previous guest said, a lot of these financials are being sold just indiscriminately with everything else. And so you have to limit your exposure there. So you want to be underweight financials, or if not equal weight or underweight financials. And what you own, you have to own really high quality and probably larger financials. So where are you looking for value? You're looking for value instead of the Magnificent Seven in technology.
SPY still looking for this to get back above VWAP.
Higher a little bit with the NASDAQ 100. But
Give us a different look.
There's a lot of really good tech out there that you can own. So that's a place that you can look at. And then the other place that we've been cautioning clients to avoid or be very careful of is specific airlines. For example, like Southwest Airlines. Love the company. We've all flown on the planes, but there's a lot of people that don't know when they purchase the flights if they're actually going to fly on the flights. So they've had multiple failures over the last year. That seems systemic. They've tried to fix that, but we have oil prices maybe going up. If you're going to be in airlines, there's probably better choices than Southwest at this time.
It's interesting because I know you favor an ETF strategy, but you're almost making the case to be company specific. I think the banks are a good example. You take a look at JP Morgan compared to PNC, obviously trading in different directions today, despite both beating expectations, but also over the past year, they've traded very differently. So I think, why ETFs over company specific then?
Well, I think it's really hard for people to get the exposure they want to buy these individual equities. They can do it, but most people can't. And the reality is you have to have a lot of data to understand where to go from a macro perspective. ETFs are causing people and causing stocks to be sold and to be bought without any knowledge for the average investor. So having an ETF that can navigate that, I think, is really, really important. So we did launch these 2 ETFs. We're super excited about them. They're semi-transparent ETFs, meaning they can take the advantages of mutual funds and couple those with the typical advantage you already receive from ETFs and put them together in this semi-transparent ETF. So we're very excited. One is a dynamic tactical ETF. This really helps people be in the right place at the right time. And the other one is for core exposure into large cap stocks. But I kind of liken it to being in the S&P 500, if you will, minus companies that have a lot of red flags. So have that beta 1 exposure, but yet you get somebody doing a lot of research around downside risk and avoiding those companies that have that potential for blow up. So these are the reasons why we think they're very, very advantageous right now. There's not a lot of people that say clear skies ahead and that just want the pedal to the metal and really go for it. We see a lot of cloudy, skies out there, and the reality is that I think you want to be protected, be in something that is going to give you that exposure, but it's very aware.
Camp of the cloudy skies. I guess we'll take that over economic hurricanes, though, right? Dave Harden, CIO, Global Investments. Thanks so much for joining us. You're breaking it all down for us. Up next, it's time for Alex Coffey joins us to walk us through a couple of stocks with unusual options activity on the day. He's taking a look at NVIDIA and Citigroup. Market on close. We'll be right back, so stay with us.
Whether you're or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our portfolio management webcast series breaks down key concepts like retirement plans, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcast and start learning today.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. It pushes you to be even better. It just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Oh, yeah, take off.
You downloaded the TD Ameritrade mobile app?
Actually, I'm taking one less look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
I'm Nicole Fedelides, live on the floor of the New York Stock Exchange, empowering investors every single market day. Tune in to the TD Ameritrade Network.
Welcome back to Market on Close. It's time for Options Corner. Joining us for that is Alex Coffey, co-host of Next Gen Investing. Hey there, Alex. So good to have you here. So you have a couple of stocks for us with some unusual options activity. Let's start with NVIDIA. It's actually higher today, despite the fact that most of the chip stocks on my watch list are lower. So what did you see on the options front for NVIDIA?
Yeah, first off, there's a news story I thought was pretty interesting that maybe explains some of the optimism we're seeing today, Caroline. It was that one of their top GPUs is actually holding on demand even in the resale market. You're seeing some of these GPUs that retail for about, let's call it $36,500, which is pretty hefty price tag, are going up between $40,000 and $46,000 on services like eBay. So that report drops. We didn't see NVIDIA erase some of its losses. Around noon today,
All right, we got less than 30 minutes to go.
in NVIDIA, traders 28th, that is 2 weeks from today, 250 strike puts for a $3.20 debit. This is a massive trade because of the liability that this potential trader would have if NVIDIA shares were to go lower. They're basically on the hook here if they were to accept assignment of these, if the stock went a little bit lower, to buy, upwards of, let's call it, good 246,000 shares of options here. And so you start of stock shares here. So you're looking at a max loss potential here of over almost 61 million, $60.7 million. And because they're doing this for a credit, essentially they take in this premium. They're hoping these options were to expire worthless, and they would keep the nearly $800,000 in credit received here in options premium. This is often a strategy, and given the size of this trade, it's likely some sort of an institutional manager, a money manager of sorts here, looking to potentially establish a large trade position in a name like NVIDIA. So you sell the put premium below the market. If the stock were to sell off, you potentially
Looking for a rally here. Pressure's building. Feels like they're going to push this a bit higher in the last 25 minutes of the trading day.
Otherwise, someone with a much larger budget than me. All right, let's move on to Citigroup. Shares up about 5% right now after earnings. What'd you see there, Alex?
Yeah, obviously a pretty timely news story here with the earnings announcement coming out this morning. So not surprised to see some option activity tailing that. What we're seeing is actually a June trade come across the wire, which I thought was quite
Looking for a push above VWAP.
Obviously, we just got quarterly earnings, so we're not going to worry about the next one for quite
Still off $1.46 on the day. 15 handles on the S&P futures.
Pretty bullish trade, buying 12,000 of the 55 calls for 27 cents. So exactly
Cumulative trying to cross back up.
risk profile here. This one has unlimited potential profits. If this thing were to soar, well, this trade could potentially soar as well. But the break even is up at 55.27. So it's going to need some help from the market, of course, just to break even. But it has a relatively small, especially compared to the NVIDIA trade, max loss. And so that max loss is just simply limited to the premium spent on these options. So this trader looking for a moonshot type of a move in a name like Citigroup with their $324,000 bet.
All right, pushing back above VWAP. Here we go. Here we go. Here we go.
Potential, the ultimate bullish strategy, but maybe a little bit lower probabilities. They're going to need some things to go their way for this one to turn a profit.
All right, we'll leave it there. Alex Coffey, always a pleasure. Thanks so much. Coming up, we'll take a look at the move lower we saw in the dollar this week. Plus, we'll check in on the recent trends in crude oil. And Jenny Horn will give us an update on Elon Musk as he plans to enter the world of AI himself. That's next on Market on Close. We'll be right back.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box.
Keep pausing at VWAP.
Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies.
Okay, we're pushing through VWAP finally.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
High ticker plus 800.
Imbalance 326 million to the sell side.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective.
All right, so we probably just took out a few stops above VWAP, but other than that, not much on the way of follow through. No volume anyway.
Once you experience Thinkorswim by TD Ameritrade, there's no going back.
Welcome back to Market on Close. It's time for a developing story. Let's check in with Jenny Horn, markets correspondent here on the network and co-host of Next Gen Investing. All right, Jenny, Elon Musk is back in the news, and it's for something other than cutting prices on Teslas. What's he doing now, Jenny?
I know, maybe perhaps seen as a better headline because last Friday we did get the initial price cuts for the U.S. and then we've seen news ever since on Elon Musk. But I guess when is there not news on Elon Musk, frankly? But different news today. Basically we have reports that he is now throwing his hat into the ring in the AI space, starting a startup to then compete with the ChatGPT maker OpenAI, per reports we got from the Financial Times. Now, Musk is assembling a team of AI researchers and engineers and has also been in discussions with a number of investors in SpaceX and Tesla about putting money towards a new venture. Musk said he was acquiring the processors for his companies in a Twitter Spaces interview he had earlier this week with BBC, and said, to quote, "It seems like everyone and their dog is buying GPUs at this point. Twitter and Tesla are certainly buying GPUs." So we know that Microsoft, Google, as well as Meta and Amazon are among some of these mega cap names that have already entered the space. Actually, Amazon was one of the new entrants earlier this week, announcing that following Andy Jassy's annual shareholder letter. But we also know that Musk has pretty openly criticized some of OpenAI's features, actually, in March, signing a letter calling for the
Spy gone.
6-month-long halt on any research on AI models more advanced than OpenAI's GPT-4. He said AI is one of the biggest risks to the future of civilization, but also consider that he was initially a pretty big investor in OpenAI, but departed due to reported issues with direction, progress, and control. And then shortly after the fallout, Microsoft actually invested about $1 billion. So it seems almost like he is bitter at that point that that deal did not come to fruition for him, and it's clearly worked out pretty well for Microsoft. But all in all, not surprising to see an investor like Elon Musk now entering this space. Also not common to see him going back on his word, as that is sort of his spiel lately, it feels like. But also, it does feel like the space is getting very crowded. So while this has been called the iPhone moment, I also think this is somewhat of a wait-and-see moment, Caroline, because there's a lot of noise, and I feel like you actually need to see products outside of ChatGPT that are coming to market.
Well, I just wondered, is he trying to slow down these?
All right, starting to go here. Spy starting to move a bit more.
Because he wants to catch up.
That's a really good point, frankly. And I think that Elon Musk actually does want the best for society and humanity. You listen to him sometimes on earnings.
VIX dropping off.
For Tesla, and it does seem like he cares, but I guess that's looking at things maybe too optimistically.
All right, we'll have to wait and see, as you said. Thanks so much, Jenny.
Of course.
right, now it's time to talk futures with Todd Colvin, Senior Vice President at Ambrosino Brothers. Todd, thanks so much for joining us. Happy Friday.
Happy Friday, Carolyn. Thanks for having me on.
All right, so first let's talk about the dollar. I know you're watching that closely. What are your thoughts as it hit a new year-to-date low this week?
It did, but we did see a bit of a bounce this afternoon. So going back to the early part of March, dollar index was about 106. Ever since the bank issues came to the front page of every newspaper, we've seen the dollar getting whacked pretty good. Today, as you mentioned, getting down to a new year-to-date low. But once the bank earnings came out, we started to see the dollar revive itself a little bit. And while the big banks seem to be doing well, it'll be the regional banks that really test the dollar strength here as they start to put out earnings next week, and that will be the key. So I don't really see this as much of a Fed issue as much as it was a bank issue. And the dollar now just starting to get its sea legs back under it, but needs more confirmation from some of these other regional banks because the regional bank indexes really aren't taking off as initially after we got some of the bank earnings today. So.
Despite the fact that PNC beat to the upside, we're not seeing shares higher. But if we do in fact get more good news next week, especially from the regional banks, you're saying that this modest dollar rally that we're seeing today has some legs.
I think it does. I think if you go back to where we were at the beginning of March, it's a lot to get from 101 to 106 in the dollar index, but that's where we have to get back to zero, ground zero as such, and then we can start attributing any rallies from there to the Fed and potential rate hikes beyond May FOMC, which right now are sort of flirting in that direction.
All right, so let's move on to oil. Currently trading around 82.63 today, so higher, despite the fact that the recession narrative is kind of, continuing to plague markets, especially after those weaker than expected retail sales figures. How high do you think oil can go, or do you think this is kind of a good level for it to be?
Well, I think oil right now is still playing the supply side of that supply-demand tug of war. When the production cuts came a few weeks ago, we saw that big gap open higher, taking us north of $80. You see the dollar rally today, but that didn't really have an effect on oil as it did other dollar-based commodities. So I think at this point, you got to ask yourself, can oil go to 90 before it hits 75? I think if we dip back below 80 for any sort of sustained period, 75 is a target. But at this point, if you're going to continue to cut production, if you're going to continue to see, usage rates kind of flatten out, but production slow, $90 seems like a much more attainable level prior to 75. So it'll be interesting to see what happens if this economy can get itself running again. That's one thing, but right now, oil is really just watching the supply side of that equation.
Oil at 82, oil at 90 doesn't seem like it'd be very good news for the inflation picture. So what are the implications there? How inflationary would that be?
Very, and I think that's a concern of most consumers at this point. While we have seen CPI come in, we saw PPI come in this week as well. That's great, and that's the Fed doing its job. But some of these levers and pulleys, the Fed doesn't control, and the supply of oil is one of them.
All right, so let's also talk about Bitcoin because it's been having quite the ride. It is lower today, but still above 30,000. So what do you make of the strength that we've been seeing lately, and do you think it ever gets back up to, it definitely feels higher right now, but it's a long way away from those highs that the 65,000 level. Does it ever get back there?
Well, Bitcoin is up, 80% year to date, so it's at 50% from those March lows, so it's had a massive move. And if you look at what happened to gold today, gold got hit pretty hard back to 2,000. It is up only about 8 to 10% since those March lows. So Bitcoin is separating itself as it did years ago when it first was introduced and became more attainable, I should say, to consumers. And at this point, Bitcoin hovering at around 30,000. We're kind of waiting to see where the demand side of that comes in. Where do some of these investors come in and take a stab at Bitcoin moving from, as you said, 30 up to 38 or 40,000, or will we see a pullback back to 28? Those are big moves in Bitcoin, but right now it seems to be holding at that 30,000 level, despite the fact that we're seeing some of these shifts in gold. So it'll be interesting to see next week and actually over the next several weeks how Bitcoin can sustain this recent price gain. Because right now it seems that there's a lot of technical factors that are pointing towards higher Bitcoin prices, but reality is we could see a modest pullback here in the short term.
All right, we'll have to wait and see there. Todd Colvin, Senior Vice President, Ambrosino Brothers. Thank you so much for joining us. Have a great weekend.
Thanks, you too.
Coming up, we'll close out the market session
session with our panel. We'll take a look at this week's action.
All right, looking for a follow-through SPY.
Market on close. We'll be right back.
Let's walk through how to analyze a company's financials on Thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
The last conference in currently sitting at 66 million for stock price, putting for a final order. The last closing balance sitting at 52 million for stock price. That's the last closing balance of the NYSE. The last time it reached
Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy.
S&P 500, not the best chart, not the best day, I should say. A spinning top. This could easily drop a bit, but note the 9 EMA, 5 EMA, 21 day. We're all pushing higher up and to the right. So I'd prefer to see close higher near 4150 or higher.
So we gave them Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
We're back on Market on Close. We're just a few minutes away from the closing bell, so let's finish off the session with our panel. Joining me is Michelle Gibley, Director of International Research at Charles Schwab, and Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Kathy and Michelle, thanks so much for joining us. Kathy, let's start with you. Just first want to get your thoughts on the volatility that we saw this week following the inflation data. We've kind of moved our attention to bank earnings, but inflation was really the hot topic this week.
Yeah, we've seen huge volatility, particularly at the short end of the yield curve, because the market reacts to every report that comes out, especially an inflation report, and prices in either rate cuts or takes those rate cuts out this year. And so some good inflation numbers, and that helped the market rally, and then we see it come back as there's talk about somewhat firmer, perhaps economic numbers than have been anticipated, but also we've had a lot of Fed speak, particularly Fed Governor Waller this morning, talking about the need to keep tightening, that he didn't think we're anywhere close to where we need to be. And so those markets is veering from one end to the other, one end of the range to another, especially at the short end, on the pricing of where the Fed is going to go over the next year or two.
So, Michelle, you say that the Fed is more concerned about inflation than financial stability at the moment. And given the Fed speak of we're not, inflation's not anywhere close to target, even despite the fact that it's easing. Does this just secure that 25 basis point hike next month?
That would be my comment. I'm sorry, Michelle. That was my comment. I think that it's pretty clear. All you need to know about that policy at this stage of the game is that they hiked rates in the middle of financial condition being tightening rapidly, banking turmoil, and a record amount of demand for funds at the discount window.
Just sitting here and doing nothing. Spinning top doji on the daily. VIX continues to drop. The dollar and the 10-year are dropping.
would say that inflation appears to have peaked in most major economies, but it remains elevated, particularly on services. Now, we believe that inflation is likely to cool, but it's really uncertain by how much and how far it eases. And so when we look at global central banks, they're downshifting either by hiking in smaller increments or pausing. But just because central banks are pausing doesn't mean that they're done hiking, because we don't know how fast inflation will moderate. I think it's interesting if we look at the Bank of Canada and the market expectations for rates there. If you look back in February, the market was pricing in a rate that assumed 50 basis points of hikes by year end. In the wake of SVB, they were suggesting 90 basis points of cuts, and now they're expecting no change. So I think it shows that there's a lot of uncertainty and some lack of conviction by traders about how this is going to evolve.
Michelle, sticking with you for just a second, because as we continue to see
All right, a little fade.
economy decline, we're starting to see China really gain momentum amid the reopening. So what should investors
Caterpillar back to VWAP. Caterpillar. Up $1.82. Caterpillar.
If we look at the PMIs, the Kaishan level showed a 28-month high, and the official PMI showed a 12-year high.
Caterpillar trying to get above this 21-day and push higher. Turning the corner, Caterpillar. Right at the VWAP, trying to push higher, Caterpillar.
And then luxury spending also, before the pandemic, Chinese consumers were a third of global spending versus only 17% last year. So we think that the rebound is still in its early stages and likely to continue.
And Kathy, what about from a fixed income standpoint? What should investors be considering, given that the Fed is likely to hike again next month, but could be nearing that pause then? That could be the last of the cycle. Also, given the fact that inflation is still far away from target, and that the Fed is now saying a mild recession could be in the cards.
Yeah, so our view has been for a long time that you should start extending duration. If you haven't done it yet, we would recommend at least getting to benchmark.
All right, we got 4 minutes left to go for the closing bell.
The signal that it sends is that they're going to get inflation and growth down, even at the risk of recession, and that benefits high-quality fixed income. So we've liked 10-year treasuries for a while now. We like them better at 4%, but we continue to think that there's room for them to move lower. It might be choppy, but we think that longer duration, or at least intermediate to longer duration, high credit quality bonds, because low credit quality doesn't do well if we get a recession, is a way for investors to be positioned in this market.
Kathy, you talked about that inverted yield curve. We've been talking about that for quite a while now. It being a
Hilton, new high of the day. Hilton.
Obviously today retail sales showed a bigger decline than expected.
Hilton making a new high of the day. Looks pretty good. Close to the new high of the day.
So how much can we actually take that inverted yield curve as a recession signal at this point?
Mara reversal on Mara. Mara reversal.
So I would take it seriously. And you have to think about what's the mechanism that means.
Mara and Riot, both of those pushing higher.
So the Fed continues to hike and hike and hike, and that inverts the yield curve because it slows down economic growth. It sends a signal of lower inflation down the road, and it sends people to higher, to longer duration. And I think that that's the reason that tightening in credit conditions and in financial conditions is what triggers eventually the recession. It has been a slower process this time around, but we've been inverted 8 or 9 months. But typically between the beginning of inversion and the recession starting can be anywhere from 6 to 18 months. So plenty of time for that to happen if it continues in this direction.
All right. And then, Michelle, in terms of international versus U.S. stocks, what should we be looking for?
Well, we believe that there's, as I said earlier, still uncertainty about how global inflation inflation and monetary policy evolves, and that could mean more market volatility in the future. And so we believe that developed international market stocks will continue to outperform. And we're saying stay focused on quality, which includes international stocks with short duration. Short duration means that they have near-term cash flows rather than out in the distant future. So they have a low price to cash flow ratio. And
All right, folks, we're nearing the closing bell, seconds away. Hope everyone has a great weekend. The Sunday video will be out around 2 p.m. Sunday. So make sure you check for that. All right, that's a wrap. I'm your host, Cousin Vinny, coming to you from theclosingprint.com. Thanks for joining us today. It's Friday, the 14th of April. Close, just a reminder, Tuesday next week is the deadline for filing your taxes. So make sure you do that over the weekend if you haven't already done so. Otherwise, enjoy the rest of your weekend. Thanks for joining us, and we'll see you on Sunday. Take care.